think the announcement is being made outside as well. So, yeah, we should be able to start soon as we get everybody inside.
तुझको खुद से बेहतर मैं बनाऊं तेरे फ्यूचर के
A very good morning, ladies and gentlemen, and a very warm welcome to all of you on the second day of Business Standards BFSI Summit 2025. For all of you who were there with us yesterday, and for those of you who were not, yesterday we had the who's who of the BFSI sector join us and debate on the road ahead. We had the DFS Secretary, Mr. M. Nagaraju, who cautioned against complacency, credit lapses, and cyber threats. We had the Chief Economic Advisor, Mr. V. Ananthanageshwaran, who asked banks to treat digital arrests with urgency. We had RBI Deputy Governor, Poonam Gupta, who pressed for new sources of growth amid mounting global protectionism. Overall, we had thought leaders, bureaucrats, economists, and some 15 sessions on the opening day of the 4th edition of the Business Standards BFSI Summit 2025. For all those who may have missed any of the parallel sessions and want to know all that happened there, please do grab a copy of today's Business Standard, where we have extensively covered all the happenings of the first day of BFSI Summit. I promise you, today too, we have a lineup of power-packed panels, eminent speakers, and of course, a very engaging audience. Yesterday, our discussions focused largely on the banking sector. Today, we will turn our focus on insurance, fintech, artificial intelligence, and more. Let me not waste any more time. Our panelists have arrived, and we are starting the day 2 with our first panel discussion around a very significant tax reform that was undertaken by the government on the 3rd of September. As you're all aware, government had announced an overhaul of the GST framework, moving GST tiers to 2 main rates from 4. Since life insurance was seen as a critical area, the government exempted this category entirely. But will the GST waiver improve penetration? We will find out more in the very first panel discussion of our day 2. Let me start by inviting on stage Business Standards Banking Editor, Mr. Manojit Saha, who will be moderating today's discussion. Welcome, Manojit. I would now like to start by inviting our esteemed panelists, Mr. Ranu Bagchi, MD and CEO, ICICI Prudential Life Insurance Company. He's been with the ICICI Group since 1992, working across retail banking, corporate banking, and treasury. Let me welcome Mr. Mahesh Balasubramaniam, MD, Kotak Life Insurance Company. He has been in the BFSI industry for 30 years. Please give him a big round of applause. Our third panelist is the MD and CEO of Bajaj Life Insurance, Mr. Tarun Chugh. Again, he has nearly 30 years of experience in the financial services industry. He's also a member of the Governing Council of Insurance Information Bureau of India and also the Distribution Committee of IRDAI. A very warm welcome to you, sir. Last but not the least, please welcome Mr. Ratnakar Patnaik, Managing Director, LIC, India's biggest life insurer. In his 35 years at LIC, Mr. Patnaik has occupied important positions across many geographies. And with that, we have all our panelists seated. Over to you, Manojit.
Thank you, Ruchika. Very good afternoon, good morning to all the members in this hall. So, as Ruchika said, the government has initiated a significant reform in the recent times, which is rationalizing the GST rates. The insurance sector, including the life insurance sector, we will discuss today what are the implications of this reform to the life insurance sector. So a brief word on the life insurance sector to start with. India's insurance market is one of the fastest growing globally, and Swiss Re forecast says that India, which is currently at number 10, could be the fastest growing market in the G20 over the next 5 years. At the same time, the penetration needle has not moved. Insurance penetration is below the global averages, in fact, the life insurance penetration is 2.8% in FY25, slightly down from the previous year. Also, another fact is that the number of policies sold in FY25 was lower than FY24. So there is an issue there. So in this context, the question is whether the rationalization of the GST rates will make insurance sector more affordable and as a result will increase penetration. So what I will do is that I will request all the panelists to share their opening remarks, opening thoughts to the question we are asking, which is the theme of the panel discussion. Will the GST rationalization will lead to increasing penetration? We'll start with LIC. If you can, sir, share your thoughts on this issue.
Good morning to all of you. I would like to thank Honorable Prime Minister, Honorable Finance Minister and Government of India for this path-breaking tax reforms as far as GST is concerned. I agree this will help insurance grow, insurance will become affordable surely. But at the same time, in my initial remarks, I will say this much. GST waiver alone will not help in the increase of penetration as such. It will surely facilitate, but it itself is not sufficient to increase the penetration levels. And as far as other point is concerned, I will elaborate further when I get a chance again. It will be taking care of, we must take care of the protection gap to start with, which will further lead to the penetration, improvement in penetration. Thank you.
Protection gap, that's a word coming from LIC. Yes, Mr. Chok.
Yeah, so as Patnaik Saab has said, it'll surely help. When prices come down, it's obviously products become more affordable. So it'll surely help to bring down the price, to bring down, to bring up the penetration. But one thing we should all remember, that insurance is not a product which people will stand up tomorrow and buy. So assuming that, people will suddenly start flocking to your branches and start buying more is not necessarily what's going to happen. I would say for some time in September, it did happen. For a few days, it did happen because there was, milestone date of 22nd of September. And that was good. So that's a good indicator. But we will have to keep this alive in the mind of the customer, ensure that we take it to the steps of every household, let them know the benefits of bringing the prices down and what sum assured, for example, as Patnaik Saab said, how that can take a fillip. For example, in term life today, if you have a 40-year plan, and maybe you people can buy insurance to start with, just by bringing down the GST, 7 premiums of the 40 are now becoming free. So, but ये अपने आप नहीं होगा. We'll have to go and educate people, let them know that look, it's a lot more affordable. GST was a significant part, particularly for term plans, and we'll have to propagate that more and more. So I think that's something I'd like to leave here.
Yes, Mr. Balasubramanian. No, importantly, what Mr. Chuk is saying is that insurance is a push product and is not a pull product, and some innovations are required on the distribution front also. Yes, sir.
First, thank you for having me here. I think it's a landmark reform. In fact, the way I look at it is that the fact that it is exempt sends a very different signal in terms of the government's focus on this sector. I was born in 68, so 70s we had this movie Roti, Kapda aur Makan.
Right, right.
Then in the 2000, Bijli, Sadak, Pani.
Right.
Today I think it's Wi-Fi and Bima.
Sorry?
Wi-Fi and Bima.
Wi-Fi and
That's the
Bima.
way I would put it, right? Because it's a very essential aspect of life, and it's been forgotten that as though insurance is optional, it's a luxury, it's a lifestyle spend. It is not. It is a basic necessity of life. Before talking about growth, we need to preserve. Preservation is most important. So what is life insurance, term insurance? It's replacement of a person's lifestyle if the person is not there for these people around him. So I think the whole approach to insurance, I take it as an inflection point in terms of sending out a very clear message that, look here, this is one of the basic essential aspects of life, and therefore the government has made it 0% or exempt, you know.
Right.
So that I think the narrative has to be strong, saying that, look here, this is an inflection point which we all have to encash on, we all have to leverage and move forward. As regards converting from a push product to a pull product, I think having been in banking, and Anup knows this, see, in every financial services business, there has been one lead product, which is the customer acquisition engine. For
Right.
banks, it used to be current account and savings account, right? I think for the mutual fund industry, it is SIP. I think for us, the moment is term insurance. We have to solve for a lot of problems to make sure that term insurance reaches people, but can we make the term insurance product a 2-click, 3-click, instant issuance product, leveraging the risks which are there. There are underlying risks which we'll speak about. It's a very highly leveraged product in terms of 400 times. For instance, we have a 2,500 rupee product which gives 10 lakh rupees cover. That's 400 times leverage. So if we can solve for some of the fraud, some of the underwriting issues, etc., I think we should all look at this moment of 18%, which is the maximum on term insurance. On every other product, it's 4.5%, renewals, it's 2.25%. In pure term, it's 18%, right? So can we use this opportunity to seize the moment and say, okay, can we make term insurance as the feeder product where all of us acquire customers on the backdrop of term insurance and then see whether we can cross-sell, upsell, the way banking has done, broking has done, and mutual fund industry has done. So that's the way I look at it. So to my mind, it's a very important reform, very important moment in the history of life insurance in this country. And I hope all of us are able to seize the moment and grow the industry.
Thank you. So what he's saying is that Wi-Fi and Bima are the new Roti Kapra or the Bijli Sarak. And also he's indicating that GST exemption is an enabling provision, but they have to work more on that. Mr. Bakshi, what are your initial thoughts?
No, first of all, thank you for having me here. So I have read these reports of under-penetration. I'll just put a different perspective to it. And that we are a country of, let's say, 140, 150 crore population. The number of policies or the unique people who have had policies from us is certainly upwards of 20 crores. And 20 crores in a family of 35 to 40 crore families are there in India. And our insurance unique policies would be 22. So I don't think it is certainly under-penetrated from a premium perspective, but certainly not under-penetrated from a distribution perspective. So first thing is that. Second thing is certainly these landmark reforms. You know, we have lived long enough in BFSI. This kind of excitement and this kind of positive discussion on life insurance, I think is happening for the first time with this kind of intensity. And intensity has come because the affordability has improved. And affordability of 18% is a massive affordability change. And if you look at ticket sizes, and if you look at PMJJBY, for example, you will have tens of crores as the policy holders within that. And maybe, you know, GST alone will not be able to solve the penetration issue. The other penetration issue that we have to resolve is, you know, how do you get distribution more affordable? How do you get product innovation which are suited for the Indian consumers, because our per capita is not that high. And so if you see when we, you know, keep comparing this penetration data, I believe that we are higher than China. And the reason why we are higher than China or lower than some other countries is not because of anything else, but it is because of per capita actually. So we should be clear as to what variables are we driving and what will happen if we want to sort of push this. What Mahesh said is absolutely right. It is a extremely high 1:400 kind of a product. And so our ability to understand risk, our ability to price risk, because even PMJJBY for 436, when you get 2 lakh cover, that too in 1 year, it's a yearly product. It is 400 times plus. Okay, and so how do we reduce, you know, early claims? How do you reduce frauds? And so how do we bring more affordability? Because unless you do that, you cannot decongest the processes. See, in protection, I'm sure, you know, everybody will bear it out. Customers are only looking for 4 things. Aap chota premium, bada cover, turant issuance, instant settlement.
Right.
So instant settlement, I think यही चाहिए 4 चीजें, बाकी सब देखो ये सब हम बोलते रहते हैं. These are the 4 things that customers want. And which is why PMJJBY, if you see, chota premium, reasonable cover, turant issuance, and instant settlement. Now in instant settlement, I must say that the industry has really gone fantastically. You know, everybody is almost 99% plus. All of us, almost most of us, 99% plus in claim settlement. So that is not an issue. Actually, in life insurance, it is not an issue. The other things we have to solve, but this affordability and this focus and attention to the product is very, 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 very positive. And at least, you know, we are seeing, and I'm sure everybody is seeing. Then in channels which are not intermediated, which are online, where customers come in, we, all of us, I'm sure, are certainly seeing 30, 40, 50% kind of a increased traffic, which only says that there is a cost effect of this.
Right.
Different channels are behaving differently, but that I'm sure we'll discuss subsequently.
Yes, yes, but Mr. Patnaik, I want to know how important is increase in awareness and innovation and distribution front to increase penetration, because now we have enabling condition, the GST waiver, but what next steps should be followed?
Yeah, I agree with me all panelists. Awareness is very essential right now. For example, last year, entire industry, per death claim, we paid out hardly less than 3 lakh rupees. We are speaking at October 2025, and per policy, the average death claim settled was less than 3 lakh rupees. And I'm coming to again to this protection gap. Particularly, I have extensively worked in rural India. The awareness level for term insurance is something much more room is left for improvement. And an average agent of my organization is not very much well conversant with term insurance. Of course, the new millennial agents, those who are joining us now, they are very much aware. And I would put it this way, the same premium you have to pay, but you are getting additional to 18-20% coverage getting increased. So this is how we have started telling our field force, have the awareness, and if the average death claim is less than 3 lakh rupees, something we have to sit up and smell the coffee. It's not enough. Similarly, my second point will be to have intensive training program for the agents, the distributors. I would humbly admit here, as far as my organization is concerned, there is much room left for the training, particularly in the rural hinterland of this country. And we get more than 75% business from rural India. And more than 75% agents do work in rural India. So awareness level, training, these are going to help. And this is the sweet spot now. We have got the GST exemption. And this is the right time we should carry on, and so that awareness is growing up. People are approached for term insurance, and coming to annuities also, individual annuities. They are getting 1.8% of the big lump sum premium a customer was paying earlier. For example, 10 lakh rupees. He used to pay 18,000 rupees towards GST. Now at 10 lakh 18,000 rupees, his annuity will be much more than what he was getting earlier. So that way I can see the awareness for the field force particularly, and the intermediaries, supervisory cadres between the agents and the organization is very, very essential at this point of time.
Mr. Chuk, taking from what Mr. Patnaik said, do you think that this GST waiver presents a unique opportunity to industry to pivot to protection-oriented offerings? This is an opportunity to industry to pivot towards the potential protection-related products.
So the industry has, to quite an extent, already started moving. Now it all depends how big you want the pivot to be. Now, there are some realities of life. The median age of India is 29 years. Indians are not getting married earlier, they're getting married a little later. The HLV for a family to start coming in and then starting to, kind of wanting insurance is hence not necessarily coming down or age-wise coming down. It starts catching value only a little later. Of course, my panelists will say that they are seeing people coming in at earlier ages and trying to get this product. So I'm saying there are a few moving parts which also have to be taken care of. And lots has been said by Mr. Patnaik that We have to get the educational awareness there. Innovation, if you ask me, in all fronts, whether it is distribution, whether it is product, whether it is simplifying, because insurance, all said and done, is still and will remain not an easy product to understand. Unfortunately, it's not unique for India. It's there globally.
Right.
It still requires that face-to-face interaction. Anup talked about how people have already simplified settlements. We've already made a lot of progress on even fraud settlement, etc. How to handle frauds. All of those things are there, but there is a lot more to do for people to start valuing, and hopefully what Mahesh has said, Wi-Fi and Bima. I thought he was saying wife and Bima. So Wi-Fi and Bima. Wi-Fi is quite easy. Bima is not still so easy, right? So it's going to take a little bit doing to get it there. Yes, the biggest impact is on the price. But like I said in my earlier point, that it's not that suddenly people will start getting up tomorrow and start seeing the need for it. Anup mentioned the point on where we are on the per capita side. Normally the cusp for per capita, and this you will hear from most panels, and hasn't changed much over the last 10 years. I've been in the sector 20 now. The fact that it is supposed to be around $3,000, and you keep adding a little bit of inflation to that, not too much of India is there. For those people, really, this will become more important. Savings ka component significant rahega. So that's the long message to a clear point. The 29-year-old will want something at the end of a lifetime. One big thing that people really want is living benefits versus death benefits.
Right.
So death benefits don't come to us, right? They go to somebody else. Your loved ones, of course. Hence, you will be fine, but you will try to balance more on the living. So the day people start valuing the death benefits more, that's where plain term, starts going in more and more. I like to hear the other people also what they have to say.
Basically, awareness, you are saying.
Sorry?
Awareness.
Awareness?
Yeah.
Yeah. Yeah, awareness is critical,
Yeah.
of course.
Yeah.
But it's also a fact that a 29-year-old will value a living benefit more
Yes,
than a
yes.
death benefit.
Yes. Sir, so the same thing, do you think this presents an opportunity to the life insurance to move more towards protection?
No, as I said, protection is essential. How do we really package protection, taking from what Tarun said? If you have to really provide a meaningful answer to living benefits, I think the answer is value-added services and wellness. Because if you're able to engage with the customer regularly on something he sees benefits through the year, then I think the death benefit is something which goes to the nominee. So I think the wellness platform that all of us are trying to create, in fact, we have a small platform called Happy You, which is a wellness platform from the Kotak group. So if you're able to give wellness benefits and embedded it in our products, and let me tell you what it is basically. Basically, you're offering products which tracks the customer's health and wellness, both mental health, physical health, nutrition, spiritual health, etc. If you can really keep a person healthy, that's the best thing that can happen to an insurance company. While we love settling claims and we are here to settle claims, if you can delay the claim process or prevent a claim from happening on the health side, that's the best thing that can happen. So the conversations can probably move away from pure term insurance as a death benefit to a living benefit of embedding health and wellness. And as the customer engages with you through the year in terms of your health app and various other things that you're able to do, I think the engagement level with customers will go up and the interest in this category will probably go up. Otherwise, it's a difficult concept to sell because in the era of instant gratification where everybody is finding something instantaneous to do, thanks to Blinkits and Swiggies and everything, today everything happens in 5 minutes, 10 minutes. As opposed to a life insurance policy where I say, okay, pay premium for 20 years, 10 years, and we'll give you something after that, right?
Yeah.
So obviously the engagement level goes down. I think that's where if you're able to see value-added services coming in a big way, health and wellness platforms getting embedded, even for senior citizens, if you're able to provide elder care services as part of our pension and annuity products, I think the conversations will become more enriched and we'll be able to build better engagement with our customers, and it can be slowly converted from a death benefit to a living benefit, which will probably be a little bit more useful for customers to interact with on an insurance concept.
Right. Importance of value-added products. Mr. Bakshi, do you agree?
No, I would agree that insurance is not a very high frequency product, so you don't have an opportunity to go back to the customer again and again. And any product which is low frequency, you don't create engagement with the customer. If you don't create engagement with the customer, it is very hard for customers to come back to you again and again and again, because there is no reason for them to come back to you again and again. So that is the structure of the product. And so wellness or any other thing which increases higher frequency of touch will certainly help in upsell also, and certainly help in just going back to the customer to say, this is the policy that you have got and these are the benefits that you are going to get, so that they are there with the policy for a longer period of time. So 3 buckets I would put it. One is protection bucket. I think much has been discussed on the protection bucket. But within the protection bucket, I'll also say that once a per capita is low, essentially you'll see that the general financial sector and the need is towards taking a loan, because you don't have surplus earlier. If you're taking a loan, the loan also must be protected. If you're running an EMI, the easiest sell is that what happens if something happens to you, who is going to put the EMI? And whatever is the collateral will be taken care of if it is a secured loan. That is something. So it is not just retail protection that should be really sort of enhanced. I think the credit protection side is also as important and very relevant for a low per capita country like ours. Second one is an issue of annuity. I think the annuity is an important thing. No other financial sector gives annuity and guarantee for not just for life, for joint life, and then going for nomination. That is another area where one can move. And there we compete with other financial sectors which are fixed income in nature. For example, FDs, etc. Those are fixed income in nature. And I must say that government schemes which are above the normal and natural rates of government securities, those you compete with those as well. Because in India, while we say that there is no social security, actually if you really look at it, there is reasonable social security of a very large function of salaried people in government and state government and central government and PSUs and all those places. So they don't require perhaps these kind of things, which is coming through the NPS route. Then comes the pure savings, because in savings, you essentially compete with other sectors which are growth oriented. So you require growth, and you also require some kind of a preservation and a guaranteed products. I think guaranteed products work very well. On the growth product, there is a pull. So if you see, where does the pull essentially comes from? Pull essentially comes from growth. Because growth is something everybody look forwards to, because you get something more. And so this, I think what Tarun said, I think, when we look at our sector, we have to overlay what are the kind of demographics of the customers, what are the kind of pulls, and then innovation around that, and also distribution around that. Because more and more, at least we see in our place, if you look at advisors and agents, their underlying customers are slightly older customers. Because if you have to get more, because see, they have to also run their own homes. Okay, so they require a certain level of premium. And that certain level of premium can be given only by a slightly more affluent things. And so how do you do that? How do you create another distribution where you have larger volumes, lower margins? And so that innovation we still have to do. And if we put the risk parameters well, that you can do, law of large numbers in protection, like PMJJBY has shown to all of us that it does work if it is law of large numbers. Otherwise, frauds and anti-selection can hit you. Then if you have large numbers, then you can work on a distribution which is large numbers, where customers are already there and they can come in. So I think there is work to do. And affordability is a good impetus, I will certainly say, both on the saving side, on the annuity side, 1.8% going away, protection, of course, 18% going away. But there are other works to do. I think we should not assume that this is the only thing and automatically if we do nothing, things will... It will become better from here, but it will not reach our goals.
Right. The elephant in the room, however, is the insurers losing access to input tax credit. So, Mr. Patnaik, how you are navigating these challenges?
Yeah, our priority continues to be the customer, and we have passed on the entire benefit of the latest reform to the customer first. That has been the approach even today. Secondly, as far as the commission, GST on the commission, that also the corporation has absorbed. So that's how, because I believe all said and done, even today for my organization, around 95% of the business is sourced to my agents, 1.5 million agents. So I will come to Mr. Bagchi's point. Now we need a mix of savings, protection, as well as annuity. Particularly as far as the income levels of our agents are concerned, all said and done, life insurance industry has given source of income to around 30 lakh agents in this country. And the way penetration level, GDP of India is growing, it's a growth story. And penetration levels hopefully growing even by few notches. I'm hopeful in next 5 years, the commission generated for the agents will be multifold. So that's how we believe in, let the agents as a profession, 15 lakh agents are engaged with LIC. And they depend on, many of them depend solely on the income generated from their life insurance business. So we are very much keen and aware of, we are live to their requirements. And secondly, as far as the customers are concerned, as Mr. Chugh has rightly put it, the mean is being at 28, 29 years old, but at the same time, not only protection, we have got products where a person as young as 25 can think of planning his immediate annuities. Earlier, it used to be age at 40 and all. Now, even at 25, a person can think of planning his, and because we are aware of this fast evolving social conditions like mini retirements, early retirements, staggered retirements. These are the things our product department is aware of, and we are going to develop some products which will cater to the need of each segment of the society.
Thank you. Mr. Chugh, is there a plan to cap commissions, and how you are navigating the challenges?
On ITC.
Yeah.
So ITC was a little bit of a pickle, if I can just say. That benefit was available and taken away. But I guess as Chairman IRD, when he addressed the Bima Manthan, did say that it's the first time the Exchequer actually reduced their revenues. So it's basically already, the government is sharing much of the burden as well, while so is the sector. I think the responsibility is on the sector, hence, to figure out how to manage it. The way it is there are basically 4 stakeholders we are talking about. The prime and the most important is the customer. There is a manufacturer, which is the sector. There is a distributor. And the 4th is vendors who give us service, because it's not just about commission. Significant part on rentals, the GST and outsourcing, and a lot of other things, the services that we take, manpower that is outsourced, security staff, and a lot of other things. Particularly if you have a large distribution, like we have 600 branches. So all of those branches have to be manned by people of, staffing units. So I think as a company, we are very clear. I'm quite happy to say the sector has shown and acted in unison that to the customer, we will not pass on anything negative. I think that's where it is. That's where it has been moving as of now. And it's quite encouraging. We've got this significant hallelujah moment where, the government is also born. So हमारी भी कोई responsibility बनती है. So we've kind of absorbed it. But eventually, it will have to be the 3 other stakeholders who will have to take on. But it cannot just be the manufacturer.
Okay.
The distributor also has to handle it.
Exactly.
Those distribution discussions are going on. On that, I think it's very clear that LIC has said कि हम agents को pass on नहीं करेंगे कोई impact, which is good. Because all of us first worry about the agent, because that is where as Anupata said, उनका चूल्हा जलता है उससे. I mean, it's like their household is dependent on that. So, and if we have to do something, we cannot let the rookie agents or people who are getting into life insurance get impacted. Maybe some people who are able to negotiate better with companies, those are the ones we need to particularly talk to on how they can bear some of the GST impact. So net, it is the 3 stakeholders, vendors, manufacturers, and distributors, who have to, between them, figure out. And I think those discussions are quite actively going on. The CEOs are talking to each other. the letters that we've issued to large banks and other distributors, brokers, and so on and so forth. Now, the follow-through of that is happening. It is a situation which has been now suddenly come in. It won't just be like a switch on, switch off button.
Right.
It'll take a little bit more of effort, and that
Right.
effort, I think we're all, in fact, the three of us and quite a few among the large companies have been interacting quite regularly to see how we can talk to each bank, each broker, and each aggregator who possibly is bearing it. And I think that's where we have to finally come to. It cannot be all going to the distributor. It can't be all borne by the manufacturer. It can't be all borne by the vendor, but it has to be a, kind of parceled out, and everybody has to stand up and raise a hand and say, look, it is part of my responsibility to bear this lack of input tax credit that is there.
Right.
So I think, long story short, that's the message.
Right. Our dear Chairman, Mr. Seth, is also with us. Thank you so much, sir, for your time. We were discussing the GST reforms on the impact on the insurance sector, whether that will increase penetration. And right now, we are discussing the elephant in the room, how they are navigating input tax credit. Thank you, sir. So, Mr. Balasubramaniam, do you agree that all the stakeholders have to absorb some hit? Do you agree with that?
Absolutely. If we have to pass on the benefits to the customer, which all of us are committed to and already done it, I think the industry needs to tighten its. In fact, less is more as far as cost is concerned. I think one is the commission, which all of us are coming together to see how we can manage. Apart from commission, we have technology expenses, rentals. So I think the productivity and efficiency of the industry has to go up. All of us have to look at all our costs and hope that less is more should be the philosophy. So we will probably take some time to reorganize. I don't think this can change overnight. It will probably be a 6-month, 12-month process where we look at each of the items and see how we can optimize. And in all this, if the true intent of the government in terms of increasing insurance awareness and penetration goes up, we'll also get some benefit of economies of scale.
Right.
So I think it's a question of how much the top line grows to make it more efficient, and how we look at our own costs, look at more automation, look at more AI, digitization, look at many more things which goes into the entire cost structure of life insurance. It's an expensive business. We are a high cost industry, I must say. I think we need to get more and more efficient. And if you can save a lot of costs,
yes,
that will also help us. And along the way, we expect support from our vendors, we expect support from our technology partners, etc. But if you all come together for a common good, I think we will sail through this. And insurance industry has been through many changes in the past. We just had surrender charges last year. Right. Before that, expense of management. Before that, 5 lakh plus. So I think the industry has been through a lot of changes. And I'm sure this is one more in our stride. But this time, we're all excited because the customer benefits the most.
Right.
And if all our eyes are on the customer and helping to grow the sector, I think we'll come out of this as well.
Right. Mr. Bakshi, are there any operational or structural adjustment that can be considered so that the profitability is not compromised?
No, I will on this GST issue, I think first thing we should move on. I think we should move on with this GST thing. And I'll just give you a few examples with my own experience. I think if you go back to 90s, etc., home loans which were fixed rate, they became floating rate. You come to mutual fund which was upfront, it became trail. Service tax got absorbed. So while we are living in this phase, we sometimes forget, that these kind of things have happened in the past. And the only thing that really matters is the growth of the industry. Growth of the industry is the only thing which mitigates all of this. If there is no growth in the industry, GST, no GST, nothing can get absorbed. The first thing we have to focus that how do you give more to the customer, more to the customer, more to the customer. And more to the customer, like I said, in protection, they require only 4 things. See, we can keep talking 4 things. Chota premium, bada cover, turant issuance, instant settlement. These are the only 4 things. So
right.
Everything that we do across IIB, across operations, across cost structure has to move this needle, number 1. Number 2, we must also understand that much of our distribution caters to the slightly more affluent part of the population. And if you again look at other industries, where the growth is coming from alternate distribution. You will see in mutual funds, the online distributors, they have grown certainly very large. Okay, you will look at banks. your mobile and internet penetration has grown very large. When I look at our own sector, I think we have a lot of work to do in that. I would say that we should focus, take focus away from GST, and I think, whatever those operational adjustment we have to do, automatically through pulls and pressures, it will happen. But if we don't get growth out of this, whatever we'll do, nothing will happen. And first is give full benefit to the customer, make it better for the customer, create this product as a magnet for the customers to come. We sometimes take eyes away from that and we start discussing many other things. I'll say customers first, efficiency second, and because it's a risk business, let us work together to reduce the risk of the business. Take only good risk, do not take bad risk, do not take fraud risk, do not take adverse selection risk, do not take anti-selection risk. And we have seen in PMJJBY, see, the number of, so it is not a loss-making product.
That is a clarification I want. I mean, you have just said, Elias said in the beginning, the entire benefit is passed on to the customer. And will the private sector also do so?
We have already done
it.
Okay.
So first of all, not just benefit, I'm saying not just GST benefit. Continuously, we have to make our products better and better and better for the customer. We must not forget, we are not sitting in some island and in oasis. We compete with other savings pool. And in the other savings pool, A, we have to be competitive. B, when we are competitive, we have to communicate this to the customer so that they know that it is competitive, and we give more value, more value, more value. In fact, one of the things I would say is, we should benchmark our sector year over year. Have we given more value to the customer, less value to the customer? And lastly, just one last point, how do you get capital out of this? See, 25 years has happened in this sector. Okay, the ROEs are still very low. Where do you get capital from the sector? And I think some work is happening and very good work is happening in IDEA. If you optimize the capital for the correct risk, so this is the risk, this is where you put capital. If you optimize that and you release capital, you get reinvestment. Just to quote some numbers, the total net worth in our industry, life insurance sector, is 2.5 lakh crores. In banking sector, it is 25 lakh crores. The largest banks individually has 2.5 times more capital than the full sector alone. Now, how do you gainfully deploy that capital to get growth? I think that is the question that all of us collectively should ponder upon.
I like to add one point.
Just one point.
Yeah, just what Anup is saying.
Very, very briefly.
Yeah. So I think we are focusing a lot on GST and premium, etc. I think the most important thing is manage risks. See, Anu spoke about it, I spoke about it. We are a very high leverage industry. We take risk, unless like opening an account or an SIP, right? The risk there is more in what you call KYC risk. Here we are actually taking a sum assured risk with a leverage of 400 times. I think if we can create a wonderful risk management ecosystem, like I remember in 2006-07, the credit score became a very important inflection point for the entire retail lending to grow. I think if we can all come together, create an insurance score, if I can write risk better, without losing money, by eliminating the frauds, etc., I think our ability to do what Anup said in terms of issuing a policy instantaneously, chota premium, bada cover, instant issuance, can happen if we can all manage risk better. I think if we can all focus on that element, that will probably give us much more leverage. Because that is a problem. While price benefits have been given, the risk is not eliminated because it becomes cheaper. The risk is still there, and we need to work on bettering our risk.
Thank you so much. I mean, I think we have just few seconds left. Insurers agree that we are at an inflection point. The GST reform is the inflection point. I will take one question from the audience. Anyone? Please, can you please give the mic? Very short, please, quick, because we are completely out of time.
Good morning. I'm Praveen Dwivedi. I work for Evoke India Foundation, which is working in the area of financial literacy with RBI and SEBI. Just one question, I think, to any one of you is that how is Bima, awareness we spoke about, like in mutual funds, banking, we do depositor education. How is Bima, Har Ghar Bima, how are we reaching out to the hinterland, and how this will happen, that penetration will go up? So if any...
I think we have discussed that issue, but anyway, if anyone wants to...
It's not something that will get sorted out in a day. And it's not that one entity or even just the sector by itself will be able to do it. It's got to be a lot of stakeholders that need to come. I think if I might just take the liberty of saying this, I think Mr. Modi has been the biggest proponent after PMJJBY. You saw how many times it was mentioned on this panel, to actually become a marketeer, right? The GST benefit coming down and लाल किले से जब 15 अगस्त को जब बात होती है, so मतलब it's got a meaning, right? That this has come down and it will help. Now it starts from there. I think everybody else needs to join in. The benefit, I think the regulator is doing its bit, needs to do more. Maybe we need to do more. Our distributors need to do more. We need to work with state governments. For example, IRDA has come up with a state insurance plan. I think that's a brilliant thought because ultimately ads don't make a difference. An education plan doesn't make a difference. Ultimately, you have to get the horse to drink water, right? At the pond. There's a horse, there's a pond. अब खरीदेगा वो तभी ना अगर वो at the time of sale, if the person is motivated enough, because this is also a product which is locking you up for 5, 10, 15, 20 years, because a short-term bima doesn't make any sense, right? So, so from that perspective, there is a whole lot that needs to be done. I think there's got to be a lot more reform around the distribution side.
Right.
And the moment you're doing that, there is practically every household. See, एक time था जब every family used to have an LIC agent, right? Any large family you'll find an LIC agent. So, but has agency really grown? No, it's come down. That's a fact, relatively. You already heard that as well.
Mr. Chugh, I think
Yeah.
the point is taken. We have taken the point. But
We love our voices, don't we?
Yeah. But thank you so much. We have a very exciting discussion where they were very candid on what are the steps they are taking. They have also assured us that they have passed the entire benefit to the customer following the GST cut. Thank you so much for the discussion. Please, a big round of applause for the panelists.
Thank you to the panelists. Thank you, Manojit. May I please request for mementos? Manojit, if you can please hand over the mementos to our panelists, and also request the panelists to please gather for a group photograph. Wi-Fi and Bima are the new Bijli Sadak or the new Roti Kapda, as was very aptly put by Mr. Chugh. Some very interesting points being made. How the young generation would prefer living benefits over death benefits, and that GST alone is not sufficient to push penetration. There's a lot more that needs to be done in terms of pushing wellness and value-added benefits. As one of the panelists pointed out, that this is a push product and not a pull product. And of course, all the tax benefits are being passed on to customers, which is great news, but a lot more needs to be done. And the under-penetration, an important point that was made, is from a premium point of view and not from the distribution point of view. Thank you so much to all the panelists for sharing such wonderful insights with us. All the people who are standing in the back, please take your seats because we are going to jump right into our next session. We have heard from the industry and it is time to hear from the regulator. We are highly honored to have amongst us Mr. Ajay Seth, Chairperson of the Insurance, Regulatory and Development Authority of India. Please give him a big round of applause. I'd like to invite Mr. Seth, and I'd also like to invite on stage Mr. Shailesh Dobal, Editor, Business Standard, to welcome Mr. Seth.
Very good morning, everybody. On behalf of Business Standard, I extend a very warm welcome to Mr. Ajay Seth, Chairman, Insurance Regulatory and Development Authority of India, to the second day of Business Standard's BFSI Insight Summit, which has become the destination and platform for almost the entire Indian financial sector to come together to discuss, debate, and deliberate on issues that India and the world faces at this crucial time. Mr. Seth needs no introduction to this audience, but I'll do that nonetheless. Mr. Seth is a 1987 batch IAS officer of the Karnataka cadre. He joined as Chairman, Insurance Regulatory and Development Authority of India on September 1, 2025 for a 3-year term. Before that, as the Finance Secretary and the Secretary of Department of Economic Affairs at the Ministry of Finance, Government of India, Mr. Seth played a key role for 4 years in shaping India's macroeconomic and fiscal policies. His career in the government spans over 3 decades, and he has a deep expertise in public finance, taxation, and social sector administration. Mr. Seth has a BTech in Mechanical Engineering from Indian Institute of Technology, Rupee, and an MBA from the Ateneo de Manila University. Mr. Seth played a pivotal role in transforming Karnataka's commercial tax administration, an achievement that earned him the Prime Minister's Award for Excellence in Public Administration in 2013. Soon after taking over as area chairman in September, Mr. Seth launched the official website of the Bima Sugam India Federation. Mr. Seth at the launch termed the launch a critical step towards creating India's digital public infrastructure for insurance and an initiative that will empower policyholders, deepen insurance penetration, and ensure transparency and fairness across the value chain. Many thanks, Mr. Seth, for agreeing to be with us and the trouble that you took to travel from all the way from Hyderabad this morning. I may now invite and request Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard, to please come up on stage and start the fireside chat with Mr. Seth. Over to you, Tamal. Thank you very much.
Very good morning. What Shailesh did not say is this: Mr. Seth is a sport. This is his first appearance after he took over, first public appearance for such an interaction. There's one call and he said yes. Other things Shailesh did not say in his illustrious career, which I get to know because I am a frequent traveler to Bangalore. When he took over in 2018 as a director of Bangalore Metro Rail Authority, it was full of strikes and strike threats and all. But he managed so well. Nobody, there's no disturbance whatsoever, despite strike call almost every day. So, gentlemen, from the insurance sector, you know what to expect from him. I could see that the body language of all the people who were there in the panel, the change, voice also raised the moment he walked in and talking about how they are ready to serve the customers and everything. So let's hear the regulator, because still there is no clarity about the GST cut. And in fact, whatever little for a couple of minutes you heard also, they're looking for some excuse or other. Let us feel the pulse. Let us see the pitch. How do we pass it on? Customer is the king, all good, but balance sheet also there. So what's your expectation as a regulator? How should they react?
Thank you, Tamal. First of all, my thanks to the entire Business Standard team for this invite and an occasion to interact with the financial sector captains and stakeholders here. As a regulator, this being my first appearance, I would like to assure that I have an open mind. Based on data, based on analysis, based on the perspective which I hear, then I reach a conclusion. But nothing is done without extensive consultation, generating discussion, building consensus, because I draw my strength from what the Parliament has mandated. Protect policyholders' interest, other side of the coin, regulate, promote, and orderly development of the industry. Orderly development is what is important, and that requires building consensus around any reform which is needed. Now, coming to Tamal's question, which is around the GST part, where we are coming in, let me share my perspective. And also being associated with some of that conversation before the present job which I have, what the government has signaled here, as far as this sector is concerned, look at the tax rate on insurance products, 0. Food items have 0, unprocessed, processed as 5%. What is the signal which I draw from here? As a matter of fiscal policy, government is equating or as placing, not equating, putting it as important as something which is essential for life. Food, the most basic of the entire thing. And then is saying that fiscal policy, maximum possible support will be provided. Now, this is a huge opportunity for the sector, that how do we bring focus on the consumers. And as one of the comments came in here, Anu perhaps mentioned that point, and Mahesh mentioned the point that we are a high-cost sector. Are we content with that? Content with serving top 10% of our population? No. We should be rather following it up, C.K. Prahlad, bottom of the pyramid. That is what the most of the growth will come in, 140 crore people. Now, that is a moment where government has said maximum possible support. Now, do what you can do. And there the question from the regulator comes in, that where are the question of economizing our own cost? go from a high cost to a moderate cost, good quality services, and be very clear that C.K. Prahlad never talked about a poor quality product or services. Good quality, but a very efficient sector. That is where we have to move in. And I find there are several pieces in this entire sector where there are possibilities of economizing on the cost. And just I cite one data point. Commissions, which form a very significant part. Or let me talk about first the overall expenses. Life is about 20% of the risk pool is cost of procuring the risk pool and managing that risk pool. And that too, a significant part of that risk pool is not really the risk pool, it has a lot of savings also. Think of any financial sector where the cost of managing a savings and risk pool is 20%. How is going to grow that sector? Non-life, 30%. I'll cite one more data point. Commissions to corporate agents, and that includes even the banks. They are also work as the corporate agents. The most efficient, I'm not talking about LIC here. LIC is not a player or is not on the corporate agent. They don't use that channel. The largest among non-LIC player, they pay 4% of their premium towards the corporate agency, get half of their business through that channel. The second largest also gets roughly about half of its business through that channel, pays 17%. Now, look at this wide variation. Is there any scope for economization? Yes. So we have to move towards that direction. Who has to do that is a matter of discussion, etc. There are several points coming up. So I see, Mr. Tamal, that aspect, this is a golden opportunity for us to just grab this opportunity. Make the products much more affordable, much more efficient, much more attractive to the people. And another comment, we can bring horse to the water. Here, consumers are not horses, but nevertheless, unless they see value, the sector will not grow. So we have to create value and make that happen.
Absolutely, absolutely. Very clear message from the regulator. But now, just from the other side of the table, on behalf of industry, I have a question to you. Now, if you look at the insurance sectors over the past 5 years, first the tax on ULIP it came, then the COVID, which is nothing to do with regulations, but it's an event nobody can ignore. Then you have this, again, tax above 5 lakh premium and all. Then you have that expense ratio tweaking and all. And then working on the surrender charges, and then the GST. Now, industry feels in private, they said that, look, there is so many things, it's very, they suffer from a sort of instability. They're looking for a stable few years to put their acts together. So, as a regulator, sir, can you tell us that there'll be more such thing? I'm not calling it shocks, but certain things which will actually, every time they go back to the drawing board and redraw their plan, or they can expect a sort of stable few years during your regime.
Again, correction. There's nobody's regime here. It's always a...
During your tenure, okay? During your tenure. Sorry, I correct myself.
Relay effort. One gets a baton, does one bit, passes on the baton. And that is how it happens. Private sector, public sector, it happens in all those sectors. But coming to our aspect, insurance sector, and if I can talk about a little more detail, health insurance is an unstable equilibrium at this point of time. Life side is a low efficiency equilibrium happening, but competition, other channels which manages savings pool of Indians, they are giving a tough competition to insurance, life insurance companies which provide insurance cover and also the savings management aspect which were to happen. So this aspect that is status quo is the answer to move forward. If you want to live with a low-level equilibrium or an unstable equilibrium, status quo is the answer. But does it require shocks? No. It requires an orderly transition to a better tomorrow. That is where it has to come in. And where I find it is starting from, say, the shareholders, and this aspect came in. Are we the best user of capital there's a lot of scope to improve upon that capital. Some of it is arising out of what the prescription regulator might have done. That itself is one area to improve upon, what allocation for various risk events will have to be provided for. Similar manner, distribution, if I were to mention it, that the biggest piece which requires attention in this sector is the distribution piece, the kind of a distribution reforms which are needed. And that doesn't mean, I talked about commission, but ultimately there are various segments from an agent to a corporate entity. How does the economics work for each of those entities? Because the one factor which requires a conversation is needed based on data, not based on impressions. Improve the economics of the sector for each of the constituents of the sector. That is what it would help in moving in that forward. So no shocks, but status quo is also not an answer. A orderly transition to a better tomorrow is the answer.
Absolutely. I think the industry has got the answer. Early this year in one of the conferences, Finance Minister spoke in London that India is on track to become the 6th largest insurance market by 2032, growing at a compounded annual growth rate CAGR of 7.3% between 2024 and 2028, highest among the G20 nations. And one of the things that I think government has been banking on is the change in the act, 100% FDI. So it's a couple of things related to that. If you can throw us some light, sir, what's happening to that insurance act? Now 100% FDI will take care of the capital part, but the distribution which you just highlighted, it's a different ball game altogether. So capital is taken care of, but how do we take care of distribution? That's point number one. And point two, it also spoke about composite license. Now globally, I think Singapore is probably the only market where the composite license worked, nowhere else it worked and all. Because there are two different products. One is for 30, 25 years, one is for 1 year. So how do you manage the treasury? It's a very difficult task. So is this the way to go forward? Is this one umbrella organizations and which will have two wings, which is one life and one non-life? Is this the way to go? And how does it work, entire thing?
First, this aspect of announcement of opening up the sector to 100%. I'm sure that in those changes, legislative changes will come. At due point of time, I will not be in a position to comment about the exact timeline, but that alone will not be in a position to take care of the capital requirement. Just given a perspective, my data, insurance industry today, the own capital is of the order of about 3.5 lakh crore, not 2.5 lakh crore, both life and non-life put together. FDI is welcome. All those players who have come in are welcome. They have provided a contribution. But still, the significant part is the domestic capital. Out of 3.5 lakh crore, total FDI which has come to the sector is about 90,000 crore. And all is not in the balance sheet of the insurance company. That's have gone to pay the previous shareholders, etc. So domestic capital is equally important. Now coming to those aspects that what will...
how do you take up the distribution? Capital is there.
The distribution...
And the composite one.
The distribution and the composite aspect. First, look at the person who is interacting with the policy holder. Is that person is getting enough income out of it? Today, an agent getting 10,000, 12,000 rupees a month is not one can sustain a family. Is an agent in a position to get 30, 40,000, meaning more volume, lesser income. So when one can be a lesser volume and more income, more margin kind of a thing. Similar manner, sharing the resources. Say resources not in terms of the money, instead of being a uni-product. It can be a multiple product when an agent or a corporate entity were to reach it out or a broker reaches it out that provide for multiple products. Some experience have been good, some have not been good. For corporate agents, open architecture was facilitated in 2022. Commission rates have not gone down thereafter. Now, that also has to look at where the economics has not worked out. So we have to look at that aspect. When one is talking about getting to bottom of the pyramid, or to put it, from top 10% to the top 50% of the population. Leave alone the bottom two. We will not leave alone in that sense. For them, there is a different product is needed, different services are needed. Even to get somebody who is earning roughly about per capita income of 2.5 lakh rupees. When that person is being touched upon, the affordability, the conversation has to get into the affordability and the reach. So distribution reforms, to my mind, objectives are two. How do I expand reach? Today, the capital markets, here, we are sitting in Mumbai, which is the market here. Most of the growth is coming from tier 2, tier 3 cities. Insurance sector getting into tier 2, tier 3, and thereafter smaller towns, and thereafter getting into the rural areas. Affordability has not come in our conversation. And that is a value proposition for the people is important here. So these are the objectives, but we do expect to generate discussion papers before we get into a formal consultation and thereafter getting into that what needs to be done for the sector.
Yeah, Mr. Seth, you're just deviating from insurance sector per se, but something very related thing. Yesterday, there was a banking day, so we were discussing about how the bank's credit growth, where the money is going, and the bank can't afford to be in the infrastructure sector because of the asset liability mismatches. They have their average period of 1.5 year deposits, and infrastructure is much longer term and all. So insurance segment is one where the long-term money is there. But going by the insurance law, the rating must be either AAA or AA for infra projects to get any insurance money. It's very difficult. I mean, we can't count on hands that how many there with AA and AAA. So as a net result, actually the long-term money is not flowing into insurance money, not flowing into infrastructure, which we need because to give the economy a real push, all of us know that there has to be focus on infrastructure. So is there any way we can change the norm or to just bringing it down the rating to get insurance money there, or some kind of, say, credit enhancement facility, credit default swaps? I don't want to get into all the technicalities, but there are ways of handling it. Is it on your table?
Tamil is being nice to me, that not getting to technicalities from his opinion pieces, he gets into fair amount of technicalities and explain it in a very easy to understand for the entire readers of Business Standard and beyond. But coming to this specific topic, out of a total AUM of asset which is being managed about 75 lakh crore, 7.5 lakh, 10% is infrastructure sector. Yes, it's a small one. But is the law, the regulations in the way? No. Regulations do allow for not more than, or at least 50% in the government securities, rest can be in other corporate bonds, and even in non-fixed income securities also can be there. And then whereas the general category got 15%, but where we are, just about 2%. So here is a question of both push and pull factors have to work in. Today, insurance industry is looking for a good quality paper. You may ask that everybody say AAA, is that AAA is only available there? Fair amount of work is needed in terms of the pull factor, and wherein as an insurance regulator, my job to work very closely with SEBI chief, with RBI governor, that how do we create conditions for more mature, more deeper bond market in the country. And now that is a piece which is needed, and there the role of the credit rating agencies also becomes very important. Like today, if a paper is rated A and there's a deterioration in the quality, how quickly the investor gets to know about it? Where is the secondary market to take an exit at the right point of time? So that is a more of a pull factor. But the push factor, also the insurance industry, a conversation is needed. What kind of a return, what kind of a push will get generated? It's not by regulations can say, hey, you can invest up to a particular percentage in a product. It is when the consumers say, hey, you are giving me X return. With a similar kind of a risk profile, somebody else can give me X plus delta. Why you can't provide for it? So that kind of a pressure also has to come in. If any guardrails are needed in terms of getting an area which is relatively, I won't call it less safe. There are various, because it's a continuum one is talking about. We are ready to look at those guardrails, like getting into an unlisted equity through AIFs, InvITs. Some of the insurance companies have started, some are reluctant to get into those areas. What kind of a guardrails are needed? What kind of a track record of those managers are needed? That conversation is needed to get into an area which can provide, given a risk profile, good returns and still be clear that shareholders will not be asked for any default to happen.
Thank you, sir. In India, I mean, past few years and now, the moment you talk about insurance, in your mind is come just two words, Bima Trinity. Bima Trinity, all about Bima Trinity and all. So I don't want to again talk the same, repeat the same thing, but only one aspect of that Bima Sugam, which is a sort of UTI movement for the insurance segment. I'll call it a UPI movement and all. And now, it's been notified. You also got involved in that website and all sorts of things, Bima Sugam and all. Website you launched, etc. So can you give us a sort of progress report only on that aspect of Bima Sugam?
The big piece next to distribution reforms, if I have to cite one, or the mention one, would be the DPI, Digital Public Infrastructure for Insurance. And we have not really made even a beginning on that, or we are just about making a beginning. Look at banking sector. The way banks could expand their reach, Jan-Dhan accounts, increasing the balance in those accounts, providing the services, thereafter the UPI moment coming up, capital markets. In spite of COVID, they could expand very significantly because they had adopted, they were ready for DPI. DPI in insurance, and perhaps Mahesh talked about, insurance history of people. What is just like akin to a credit rating, or perhaps Tarun mentioned about that aspect. So that next piece is digital public infrastructure for insurance sector, wherein in the regulator, we see Bima Sugam as an entity which is consumer facing, and at the back end are the insurance companies. That kind of an efficient platform to be ready. They have made a beginning as the products and their services should be coming in the market in the next few quarters. Second piece I see it there is a market infrastructure of market infrastructure entity, which is a IIB, Insurance Information Bureau. Perhaps owned by IRDAI or in the public sector for sure, as a custodian of data, which provides that information to insurance companies. So there the consumers are insurance companies. At the back end is the insurer. At the back end is the IRDAI. So these two pieces, one, a market-facing entity, which is the Bima Sugam. Another one is a provider-facing entity, which is infrastructure agency, insurance infrastructure agency, which is IIB. And that kind of a combination is providing for using technology and the efficient way of managing the sector in an efficient manner.
Okay. Just some time back, I spoke about finance minister in London talking about the insurance growth and all. Prime Minister has been spoken about by 2047, it's an insurance for all, right? Now, globally, if you see that when you talk about the insurance penetration, the yardstick or the benchmark is this, measured as a cost of premium to GDP. But India is a very different story. I mean, here, how many people are covered? That's what is important, not at the end and all. So again, then the intermediation comes. Do you agree that's the way it should be? It's not a premium to GDP, but more and more coverage in terms of population coverage.
Now, I'm glad that you asked that question. For an investor, or how globally this industry looks at it, they look at penetration, premium to GDP, or density, premium per capita. We are at 2.5 lakh per capita, about $2,800, $3,000 per capita country, 140 crore people. While those parameters are important when one is talking about to shareholders, or especially the foreign shareholders. But for the sector's growth and serving the purpose, what is those parameters of people covered, life covered, some insured cover, when it comes to the non-health, non-life, those are the questions which are important. Premium per unit of risk covered as proportion to per capita income. These are the parameters. We have not even started tracking those ones. This is the conversation we would like to, from the regulator, we would like to start conversation around it, because these are the parameters which are equally important or far more important for our country, where the current level of reach is rather limited.
Exactly, exactly. So one more, warm water. One more thing is this, apart from the business, penetration, capital and all, IRDAI also started that the lot of things to take care of the risk. The risk-based capital norms have come, and compliance with the international reporting, financial standards, transition to risk-based supervision are underway. Everybody is waiting for that. Can you just give us a sort of update on that?
In the past about 4 years, there has been a good conversation. I'm saying past 4 years, post-COVID, there has been a good conversation between the industry and the regulator. Various gap analysis, where do we stand, what it would take to reach there, that exercise has been done. In terms of sequencing, you talked about 3 pieces. Moving towards IFRS or Ind AS, let's talk about our own standards, Ind AS. In terms of sequencing, I'll require that, I'll mention that as the first one. And that's a larger piece we have to do it, and I see today the preparedness is move to that one in about a year's time. May not be 100%, but bring significant pieces around that, and then provide a glide path to others who may require time to reach there, because that may lead to some amount of, everybody will not be ready. Bigger companies would be ready, smaller companies will require some time. So that's the first piece to come in on the move over to Ind AS. You asked about composite license. This is one of the enabler, meaning that this is a prerequisite. Without this being there, the transparency on the balance sheet and P&L account, one can't be getting into a composite account. One can't be creating those compartments, will not be there.
Absolutely.
And the second piece will flow from there, the risk-based capital. Now, the risk-based capital is, again, where is the efficient use of the shareholders' capital? Rather than saying that in regulator we feel this is a risk, so much percentage has to be allocated. No, it has to be much more efficient piece. So second piece arises out of risk-based capital. But risk-based capital will help few companies, will be challenging for others. So there we have to think it through, that how do we provide for that kind of a glide path or give them a longer period to reach there. But the journey has to begin. As long as we are taking a step and we are sure of our path, we will end up there. Third piece, you talked about risk-based supervision framework. There will, I'll say that one piece where we have to spend a lot more time, and I would like to have that conversation with the sector, is getting into the corporate governance. Risk-based supervision framework requires a much more solid, robust corporate governance. And that is a conversation with the insurance industry. Not that there is any major issue coming up over there, but the moment we talk about a framework, that is a prerequisite is happening, and then a structured discussion around the corporate governance is needed.
Thank you. A lot of clarity. Actually have many more questions, but I'll just only ask one, and then after that, one or couple of questions, all that industry from there we can ask. So one just from my side, last question is this now, if I'm not mistaken, is there are now 57 insurance companies in India, 24 life insurance, 33 non-life, and 1 national reinsurer. Now, if you talk about the kind of penetration by Indian yardstick, not the global benchmark that we discussed, everywhere it has to go, certainly we need many, many more. There's no question that many more insurance companies and all. Now, my question to you is this, do you see a merit we go the banking way? What I mean banking way is this, there's universal bank, and then a decade back, Reserve Bank of India started with, look, everybody does not have to be insurance in universal bank. It could be small finance bank, payments bank. Payments bank not exactly succeeded, but small finance banks are there, and then new are coming, and some of them are getting upgraded to universal bank, etc. Is it possible to replicate this kind of experiment in insurance segment also? You have a separate capital requirement, have a smaller insurance companies for region specific, and then later they can upgrade them. It will help penetration. After that, a couple of questions we're running.
Certainly, more companies are needed for sure. More customized companies are needed for sure. So national level, multi-line, national level, monoline, depending upon the business model they want to do, or a geographical concentration if somebody wants to address there. So as a regulator, we are ready to provide for a differentiated level of business model. But you talked about a smaller capital requirement.
Yes.
Now, capital requirement, that is a tricky part. Now, here the limit is minimum 100 crore.
This is what in banks they have done, 500 crore for universal, 100 crore for, or 200 crore
But this is only an entry level. Talk about a bank which is operating at 500 level. The moment its business grows, it gets an asset-based CRAR kicks in. Today, out of 77 or 73 companies which you mentioned it, just about 10, 12 have their capital deployed of less than 1,000 crore. Everybody is above that. So even the beginning one, more capital is required. 100 is only an entry requirement coming up. So this part, the younger companies are finding it difficult to differentiate themselves vis-a-vis others. Now, there lies the challenge that how do we create conditions, and there the distribution reforms and more efficient of the capital will help them also to compete with more established players. That is a piece which is needed.
Thank you. We have 10 seconds, but 1 or 2 with the permission of the House. You are just taking a couple of minutes more. Is that okay? So 1 or 2 questions. Yeah, this gentleman here, and then from Acha, sorry, here. Okay, please. And then here also. Please introduce yourself and very brief question, no comment. Thank you, sir.
Yes, sir. My name is Sachin Seth. I am chairman of CRIF High Mark Credit Bureau. You did talk about insurance bureau also. What we have seen in the banking side, that the 4 bureaus have played significant role in building the infrastructure for the lending, which is one of the growth agenda. While on the insurance side, is still the dependence on IIB and the quality of data and the customer grievance, etc., it still remains far behind compared to the credit bureaus. So is there any proposal or is there a possibility that would you like to also privatize it and let people run it like a professional setup instead of being just an organization, run by a government or maybe the consortium of the insurance industry?
Thank you, Sachin. Yeah, sir.
Be clear that we have something now, DPDP Act, personal data. Now, first, we have not a beginning. When you talk about IIB doesn't have a complete set of data. So what kind of a product, what kind of a services are needed? As far as credit information bureaus are concerned, there's a separate act regulating them. Insurance sector, there's no equivalent at this point of time. It's not a question of legal anchor being there. At this point of time, getting the DPI right, get one repository, not repository is a full market infrastructure agency. Then we go on to say that how the consumer of that data, which are the insurance company, will require it. So that is an evolution path. That will be my answer.
Thank you. There's one gentleman here. Just, again. Okay, yeah. And then please get the microphone here because he's, okay. Quick.
Hello. My name is Sachin Deshpande. We work for the NGO. We work for, which works for people or children with special needs. So we'd like to know, are there any products which are specially designed for that? Because mainly the families which support them, they have a hard time when they grow up and their health insurance costs got very much, unbearable. So these are the demands which comes from many of the families. It would be great if you're talking about the bottom of the pyramid.
Thank you, sir.
See, specifics, I will not be in a position to comment upon it, but any ailment for the special children, that my sense is that would get covered. But the risk pool, how does one create? Expect other people to pick up the risk of this pool will be a difficult one. So this is a specifics, will I have to have a separate conversation with you.
Thank you. This is the last question because we are running, we have already run out of time exceeded. Yeah, please.
Yes, sir.
Quick.
This is Sanjay Panda from the insurance now in the tech sector. Now, 2 things is expected. What is the steps being taken for the advisor side? Just like composite insurance for advisors. Okay, they can sell multiple insurance companies product. One. The second is that how we can retain the advisor, which they are exiting very soon from the industry. The third, the customer side, are we creating a kind of civil score for the pension score in the insurance industry?
Thank you, sir.
Okay, I'll just say that when you talk about a CIBIL kind of a score insurance history, which some of the captains talked about it, that's really an idea to know the insurance history of the individuals or the entity to decide the next cover. Your question of advisor, financial advisor kind of a thing, this is a piece where a conversation among regulators is happening, and it's not just happening now, it has been happening for quite some time, a function-based regulations. A primary regulator for any entity or any intermediary may be one regulator, but the functions can be across. The services can be provided to different sectors. So that is something, a piece of work which has to happen through a better or rather a conversation among the regulators and reach. That's the one piece which is needed to move much more strongly.
Thank you, Mr. Seth. I think we have come to the end. So I would not have a very long conclusion. Simple part, I think in a very clear term, regulator has conveyed his message to the industry that yes, he wants to go forward along with everybody. Each step will be taken along with you guys, hand in hand. And I'm just quoting one thing, thanks to AI, I picked up, and correct me wrong if I've got it wrong. At some place in one of the economic conflict, you says that financing development is like a relay. The taxpayer ran one leg, the investors another, and people are the final. Our job is to pass the baton efficiently. So I think even in insurance segment also, you are saying the same thing. Am I correct?
Anyway, Mike. Don't trust AI blindly. Don't trust the AI blindly. My quote was that for development in our country, we require 3 engines to fire. Taxpayers, the ratepayers, and the next generation. All 3 have to fire, all 3 have to support. That's the context. It has a mix-up.
Anyway,
passing the baton is from one individual to another individual, and that's how, or from one institution to another institution.
So that remains the thing, right? Yep. So that's the end of it. If you have liked it, so give him a big hand. Thank you, sir.
Thank you so much, Mr. Say. Thank you, Kamal. All 3 engines have to fire. Please present the memento. I request Kamal to please present the memento to our guest. And let me also thank Mr. Seth for taking out the time and sharing his thoughts, providing so much clarity on so many issues. May I please request the audience to please remain seated because we are going to jump right into our next panel discussion. Mr. Seth has made some very interesting points on how government has placed insurance at par with food when it comes to 0% GST and so many other interesting points that have been made. May I please request the audience to take their seats because we are going to begin the next panel discussion right away. There is no break that we are taking. Ladies and gentlemen, please remain seated. Ladies and gentlemen, the stage is being set. We are just about to begin in less than a minute with our next panel discussion. Please take your seats. I know you want to greet our guests, but there is so much more that we have in store for you today. There are more panels, more very interesting speakers that are lined up. You do not want to miss that. Please take your seats. ladies and gentlemen who have moved outside to check the stalls, I assure you we will give you a long enough break to take your time and explore the stalls that we have outside. For now, we are going to begin with the panel discussion. Please, everybody, I request you once again to please take your seats. All right. We're taking forward our discussion on insurance in our next panel discussion, which is all about managing the new age risks and changing role of general insurers. I'll just wait for that noise to settle. Let me once again invite on stage Business Standards Banking Editor, Mr. Manojit Saha, who will be moderating this discussion, and also invite our panelists, starting with Mr. Yashish Dahiya, co-founder, chairman, and group CEO of PB Fintech. He co-founded the company in 2008, and IIT Delhi and IIM Ahmedabad alumnus. Mr. Dahiya was the MD of ebookers.com, a leading pan-European online travel distributor. He was also a management consultant with Bain & Company. A very warm welcome to you, Mr. Dahiya. Can we please have you on stage for the panel discussion? Our next panelist is Mr. Naveen Chandra Jha, MD and CEO of SBI General Insurance Company. Mr. Jha has been associated with State Bank of India since 1994 and has held various important functional and operational roles during his tenure. Please give him a big round of applause. I would now like to invite Mr. Anup Rao, MD and CEO of Generali Central Insurance Company. In the last 15 years, Mr. Rao has held key positions like Chief Distribution Officer at HDFC Life Insurance, the post of CEO at both Reliance Nippon Life Insurance and Edelweiss General Insurance. A very warm welcome to you, Mr. Rao. May I now invite Mr. Tapan Singhal, MD and CEO of Bajaj General Insurance Company. Mr. Singhal started his career as a direct officer in 1991 with New India Assurance Company and has handled portfolios as varied as accounts, IT, underwriting, claims, marketing, sales. The list goes on. It is over to you, Manojit.
Thank you, Ruchika. The contours of the general insurance sector is evolving fast, driven by technology, environment, lifestyle changes. Some of the new age risks that has emerged in recent times are cybersecurity threats, climate change, insurance for the gig economy, work from anywhere insurance, and so on. So the question is how the insurance companies are managing the new age risks. We have a fantastic panel today. So first what I will do is that ask them to share their opening remarks, opening thoughts on the issue of on the issue of climate change first to start with. So we are asking that with climate related disasters are becoming increasingly frequent, how is India's general insurance industry is evolving to manage these new age risks? Can we start with Mr. Tapan Sinal?
No, thank you. It's a very important question. When you look at climate change, it's not only about natural disasters, also about illnesses, new viruses, new kind of illnesses, what affects the work environment. If the heat goes up, the gig workers can't go to work. It's a wide spectrum of risks which come together. But the question is more deeper than just asking the general insurance industry as to what they are doing. If you look at a catastrophic loss, the economic loss, if it is 100, the entire coverage, which would mean what is the payout from the insured bit of it, and the government, what it pays out in terms of the national disaster schemes that would be there, would be less than 10% of the total loss which happens. 90% still be uncovered, which obviously has a far-reaching consequence. It is a 2% GDP impact on the growth of the country. It pushes the state where it happens much below what it is. When you're looking for a Viksit Bharat, this has to be addressed. Now, for this to be addressed, it will require government and the insurance industry to come together to address it. It will require different modes of looking at catastrophic bonds, looking at a solution in which you have tiered level solutions in which government puts in a layer, then the industry puts in a layer to do that. The problem is big. I don't think that we are comprehending the magnitude of the problem and the ability to solve it. If I put numbers, then we shall realize that if I look at, let's say the last year, losses, it runs to lakhs of crores. And in terms of putting together the solution for it, I don't think anybody has a clear answer on it. But is the roadmap there? Yes, we have examples of Japan handling this position. We have examples of UK handling a situation like this. Examples in Australia, the situation like is getting handled. We have solutions like CAT bond in the international market, which is there. So we have to put all that together to be able to make it foolproof. So good that you raised this point. It's a very, very important topic.
Right.
And it requires many players to come together.
Yes, Mr. Dahiya, your thoughts.
I think Sir's already covered. Sir's already covered the fact that it's a very important area. Frequency has been increasing. I just read that in the last 10 years, we've had more catastrophic events than in the previous 100 years. And all of these are having a negative impact. Now, talking about solutions, I think the insurance industry and the government really need to come together on this and align interests along with the consumer. And what do I mean by aligning of interests? Aligning of interests come in the form of encouragement or mandation. It's not hard to mandate if you really think about it, right? If people are living in houses and they're paying electricity bills, it's not a very difficult thing to mandate that anybody living in a house must have a certain amount of insurance cover for that catastrophic event, were it to happen, because there is a social impact. A single insurance company may or may not be able to carry that risk entirely. So freeing up reinsurance is an important critical aspect. But I think, look, I'll just share one anecdote. India has the third highest incidence of cyber fraud reported, right? It has so much of DPI, so much of possibility, but still the penetration of internet users who can pay for cyber insurance is something like less than 1%. I know, covering a slightly different area. What is that telling you? unless mandation in some form or some form of payment along with another product happens, actually, see, in our country, people are just starting to buy health insurance and term insurance, which is so critical for families.
Right.
Getting people to actually buy catastrophic cover or buy cyber insurance for themselves and actually take out money and do it just for that event is a very hard task. And I think more than financial support, where the government can help is exactly this mandation point.
Right. Mr. Rao, apart from how insurance are addressing these issues, can you also throw some light? What are the changes being implemented, in underwriting practices, risk modeling, and claim management?
So let me look at risk and claim management slightly differently. I think let's step back a little. Fundamentally, when the claim is made, when I'm talking about CAT events, I don't think anyone's happy if an incident happens. The customer is definitely not happy, right? Because the customer has suffered losses. I mean, nothing can compensate. Insurance can't compensate for what you have lost at the end of the day. Let's face it. There's a psychological damage and other aspects to it. As an insurance company, paying out claims obviously means, a financial impact on them, and also on the customers finally in terms of reflects in terms of future premiums, so on and so forth. So we talk about claims and underwriting related to CAT events or climate change. I think one of the things we need to do is to make sure that there are a system of incentives wherein a customer is incentivized for certain behaviors to prevent losses from happening. So, the generally, for instance, has a tie-up with UNDP, United Nations Development Program, wherein small businesses especially, in case they take steps on two aspects. One is making sure that their assets are secure. Second, in reducing carbon footprint. They get benefit in terms of premiums and in terms of coverages. So I think underwriting has to move just beyond the technicals to make sure that the risk is shared between all stakeholders and promotes behavior and in the sense creates a virtuous cycle wherein the price of the risk keeps going down every single year. So that's my take on underwriting and claims here. Thank you.
Right. Thank you so much. Mr. Jha, your initial thoughts.
Good morning to all of you. I think climate change has become a reality. Last 10 years back, we used to hear that we have to save water, we have to save environment for the next generation. And now it has come the reality. Today we are seeing rains happening in Mumbai in the last week of October, or the Montha cyclone coming. This is the fourth cyclone during this year.
Correct.
In India, which earlier used to have once in 4-5 years.
Right.
So it has become a reality. And one thing is very clear, as our chairman IRDA also said, that we need to increase penetration to protect. The protection is our job as insurance company. We have to make sure that awareness to the ground should reach, and we should provide protection to maximum people. Second thing, once these kind of things are happening, we have to make our underwriting more sound. As earlier, what we used to do, the actuarial model, whatever happened in the last 25 years, we used to look into it accordingly. We price our product and we make such kind of product. We have to make sure that it should be dynamic. We need to use your satellite imaging or the AI models, data-focused approach and other things we have to do and make sure that it should be more dynamic, more precise, more predictive analysis to be done so that the underwriting should be up to date. Also new products like parametric insurance. I can say that this is a very good product to take care of climate change. Last year we did with the Nagaland Disaster Management Authority, where it is the claim is based on certain climatic parameters to be reached. Suppose there is the temperature goes beyond say 35 degree or 40 degree, there is certain claims are being done. So it has been very successful and we are also reaching to many other state government for this.
Correct. Mr. Sinil, do you think that given the growing severity and recurrence of climate-related catastrophes, do Indian insurers currently have sufficient capacity to underwrite the risk independently?
See, I think Yashish mentioned the issue of insurance is pooling of risk. Capacity gets created. I don't think capacity is an issue for anything. The more risk you write, that's how capacity gets created. So if you look at, let's say, and this is a very interesting question I asked my friends, when they're in US, they have a householder insurance, they have a home insurance. When they're in India, the same person does not have a home insurance. You can try it here also. In audience, if I ask how many people have home insurance, hardly any question, no hands would go up. No, it is. In fact, if I ask this question, insurers also very few hands would go up. No, why is it so? It is because in US it's mandatory to have this cover. No, and that is Ashish mentioned that. So if Florida has a hurricane, 95% coverage of insurance is there. Claim payouts happen, and the GDP growth of Florida actually moves up because money gets deployed to rebuild the state. When in India a catastrophic loss happens, the GDP growth goes down because the money is not there to put that on. Now, if you put that, and everybody starts putting it together, sometimes I tell, and I've spoken about it in a lot of forums also and to the government also, I'm not talking about give it to insurance companies. Like if you look at government health scheme, some state gives it to insurance company, some keep it as state, as trust and manage it. I'm perfectly fine. Issue is big. It has to be solved. So let us say SME, MSME. 94% of SME, MSMEs are not covered in India. Imagine when a catastrophic loss happens, 25% of them become bankrupt. 25%, it's a huge number. Now let us say if an SME, MSME is setting up business and insurance component is negligible, it's a very small component, is made mandatory. If the state feels that they want to keep it, let them run it as a trust, let them keep the premium and pay off when a claim happens. If they want insurance companies to manage it, they can do so. So the capacity management is not an issue. The issue is the risk gets spread across, then it gets managed. So the point we have to think is how do we increase the risk coverages,
right,
and how do we build that together?
So Mr. Dahiya, do you think the answer really is government-backed risk pool to ensure adequate coverage?
Eventually, that's the answer of insurance all the time. And Sir is absolutely right. I have a house in the UK. I cannot not have insurance for it. It's impossible. I have a house here, which is actually very close to pine needles, which can catch fire. I sell a lot of insurance policies. I have a platform that sells insurance policies. Do I have home insurance for it? No, I don't. That's the reality, right? And I think it's very easy to do. It's not hard. Somebody has to hear it. It's about risk pooling, right? And all you do is, like you get electricity connection, like you get a gas connection, like you get everything, you make it a utility. You must, and keep it competitive. I would say, the government has this fear that, okay, this will benefit private entities, private companies, et cetera, et cetera. Basically, just say, you have to have health insurance if you want electricity.
Is the mic working?
Sorry. You have to have health insurance. You have to have catastrophe insurance. You have to have home insurance if you want electricity in your house. It's as simple as that. And you can buy from anybody. There are 53, there may be 200 more insurance companies tomorrow. You can buy from anybody you feel like. But the point is, it is mandatory. Just like you have for car insurance. You have it for car insurance.
Right.
But you don't have it for home. You don't have it for health. And that is why penetration doesn't happen. That's where risk selection happens. That's where all those issues happen. And that's where capacity does not get created.
Right, right. Now coming to the cyber risks that we are facing, how can the general insurers innovate their products, Mr. Rao, to offer a comprehensive protection from corporate data breaches, ransomware attacks to individual level risks such as digital frauds? So how can insurers innovate to give a solution?
So I think the reality is that cyber risks and cyber attacks are going up every single day. We see that in all companies. We see that, there are a lot of cases that, all of you have covered as well. A lot of organizations, including banks and insurance companies, have got breached. I think the real tragedy we see is that, to an extent, I think institutions, even if they are breached, they're protected because most institutions understand the need for insurance. I think the real issue is that at individual levels, when people fall prey to digital scams, There's really no recourse. Of course, there's recourse in terms of going to the law, but it's simply like any other product which is not motor or not health. The non-motor, non-health piece, be it house or be it, I mean, for example, I have a dog. I mean, overseas, if you have a pet, for example, you need to have third-party liability insurance. And here, your dog bites somebody. I mean, you know, frankly, I mean, there's no recourse. But similarly, I mean, just to make a point, the fact is when it comes to cyber risk, I think the focus on building a retail franchise or for individuals to make sure they protect themselves is minimal. It's not that products are not available. It's simply that there is, there's no appreciation for the fact. And this despite the fact that, you know, you see it all the time in the media that, you know, a lot of people have fallen prey to scams and somebody's account has got hacked, somebody's clicked on a link, so on and so forth. A lot of it is sheer carelessness and lack of education. But the fact is there's no appreciation at an individual level. I think that really could be an opportunity for the insurers to go after. Of course, I mean, you can't mandate something like this, unlike, say, cat events, household, or other forms of insurance. But that's where I clearly see a gap as far as cyber and digital is concerned.
Right. Mr. Jha, innovation to provide a comprehensive offering for these cybersecurity risks.
Again, it's a very, very important risk after you discuss our climate risk. Yesterday, I was just hearing in some conversation, and we came to know that the total cyber fraud, the loss due to cyber fraud is 0.7% of GDP. And that person also said that 2/3 of the frauds or the crimes are not reported. So that means we are losing 2% of GDP on account of cyber frauds.
Correct.
So again, very, very important matter. And when we look at the number of UPI transactions, 600 million per day, 490 million of people using UPI. The kind of even our SBI YONO, 10 crore customers are on SBI YONO. So the kind of, the way we are using the internet and digital platform, I think the risk has similarly gone up, whether it is for individual, whether it is for the organization. And we also need very, as I said, different way to underwrite such kind of risk. At the same time, the insurance companies are also coming with a lot of new products to take care of individual risk. I have seen many products which has come, even if we are sharing your password, even that is covered. One of our product is like that. And if you look at the earlier times, people used to keep money in their home. But then some burglary, some dakati and other things happened. People shifted to banks and other places. So similarly, the kind of cyber fraud happening, the larger people have started losing faith on financial institutions.
Right.
So it is very important that we should keep on making new product, new ways to protect it. Even in the organizational fraud also, the insurance companies are providing not only just for the financial loss, they also give the complete roadmap how to take care in such kind of things. So I think these new risks which are coming, we are also making new steps to take care of that and protect the citizens.
How important is partnership with the tech companies, with technology?
It's very important because, as I said, the ways the cyber crimes are increasing, they are always 2 steps ahead of whatever any financial institution thinking. So unless until we are also having collaboration with much better tech-enabled companies, we are not able to take care of those things. So I think it's very, very important.
Right, thank you so much. The other area I wanted to touch on is the growing popularity of electric vehicles in India. So how is the motor insurance segment evolving? Mr. Sinal, you can start.
See, if you look at motor is an interesting thing. It has a lot of different components, hybrid, EV, EV, if you see, the moving parts are less, the requirement of servicing is less. The battery is very important. How do you take care? That is a major component, and if that goes wrong, it catches fire, it builds it up. So what we did in India was that we looked at markets which already had very strong EV component there, and how are the risk pooling happening there? What are the challenges that the customer is facing there? One, we picked that up. Then secondly, we also looked at the Indian market, what is unique to Indian market, and what are solutions that we have to give to customers. So what we realized is, along with providing solutions for accidental related, which typically an insurance job is, it also provides solutions to infrastructure related solutioning, right? In terms of be it charging station or battery swap happening, or battery runs out on the road, then you provide assistance to customers. How do you get them back on board? If I look at the today's scenarios, the EV insurance has evolved to an amazing extent to provide support to the EV vehicle. It has picked up all the components and is doing pretty well. Though internationally, I see that now some countries like China have a concern on the loss ratio on the EV vehicle which is there. US also had an issue of the liability claims on the EV vehicle coming up. The third point which would come to India later is that if India has self-driving cars, then if an accident happens, then who is responsible? Not the owner, it may be the manufacturer. So then the liability part starts coming in. So it's a very fast evolving insurance, and it's a very beautiful piece. And I enjoy it a lot. But today, if I look at the solutioning by the Indian insurers to EV, it's pretty good.
So motor insurance has different layers. So
it's very the way you look at automobiles complexity. The insurance of automobile also is pretty complex.
Very complex.
But it's interesting. And I would say that currently the EV solution provided insurance is pretty good. I'm waiting for the time to when self-driving cars come in, then how do the liability gets fixed on that, and how do the court looks at it, is what would be the next phase in the EV space.
Right. Mr. Dahiya, your thoughts on motor insurance?
So very quickly, just some data points. About 5.5% of the searches that we receive now are EV. Which is growing. It's about 55% up over last year. The battery product, which is basically catering to a kind of breakdown of the battery, now has almost a 70% attachment, 67% attachment rate, which means that's becoming a very critical area of concern. Clearly, there is also an intent issue here. My belief is that things like third-party losses on EV could actually be much lower, simply because it's a different consumer set who's starting to buy EVs, and maybe the sort of fraud element may be much lower. I think that could be something that can be looked at. But yeah, on the whole, this is an area that's going to grow over the next 10 years on a stable basis.
Right.
And some of the liability points really need to be understood, whether it's going to be, who's liable for what.
Right. Claim handlings in EV era. Mr. Rao, can you share your thoughts on this? In the EV era, electric vehicle.
So claim handling in the EV era, look, I mean, I don't think it's going to be any different from what you're doing for other products. But I think, I remember this when there was the Berkshire Hathaway AGM, somebody had asked this question of Warren Buffett about EV specifically. And the question asked was that, again, what happens in their autonomous vehicles? What happens when you have EV and there's not really clear about how the underwriting and the loss ratios are going to pan out? I think there was a very interesting response saying that finally you need insurance. And where does the liability go to? It goes to either the manufacturer or to the user. But the liability is still going to stay with someone. I think it's, as Jashish pointed out, it's still a revolving piece. I think we have to somewhere understand that the liability, the way it pans out over a period of time, could change. But in terms of underwriting principles, again, it's the same. It's going to depend on, the kind of data you get. I mean, what kind of pattern recognition you see, how do you see this growing and how it's proceeding over a period of time. I don't see how it's going to be any different compared to any other line of business.
Right. So now I will focus on the recent reforms which I also talked in the life insurance panel, is the rationalization of the GST rates. So the question we are asking here is that with the GST waiver on health insurance premiums, will it make policies more affordable and accessible to the larger section of the population? Mr. Jha, if you can start with you.
I think yes, absolutely yes. Insurance is based on three principles: affordability, accessibility, and awareness. The three part very, very important. And this, when we have completely waived off the GST on health insurance, this is increased in a big way the affordability part. Now, not only affordability, the kind of media coverage it has got, it has also increased the awareness. Because now everybody is thinking that yes, health insurance is affordable. So that has increased the awareness also. So now it is our turn as insurance companies to reach to the last mile, to the tier 2, 3 cities, to the rural segment, to the under-penetrated areas, and make sure that the volume increase. So take care of whatever input tax credit hit we are taking in the first phase. So if that is what we all are working towards, to make sure that the volume should move up and penetration should move up, and we should take care of accessibility and awareness part.
Right. Mr. Rao, input tax reverse credit impact on distribution commissions?
Of course, I mean, there is the offset issue is obviously there. So, but you know, the fact is that because you are not charging GST, you can't, you know, obviously take the benefit on the commission side. Having said that, look, let's understand the math. The fact is that, you know, it's 18% cheaper for the customer, effectively, or about 16% cheaper in case you use 118 as a denominator. The thing is that, you know, you don't have to really increase prices to the fullest extent just to make good. You can, I mean, so the customer is still going to be better off mathematically, all things being same. Just to add to what Mr. Jha said, there's one more point I wanted to make is that it's not just about new business. The fact is, a lot of customers, and I'm sure it's true for all insurers, we have suddenly discovered that the renewal premiums effectively are lower than what they paid last year.
Right.
Right. So what it's also hopefully going to do is going to improve retention for our customers.
Correct.
Right, because you do understand that, you know, there's a drop-off, there is porting, there's migration, there are a lot of things, and there's sometimes there's sheer, you know, lethargy that you don't go ahead and proceed with it. So, and that's another factor, which is another factor is massive. The fact is that most of the health insurance business any single year has a larger proportion of renewals than new, and I see a great positive uptake there too.
Right.
We're already
right.
seeing it.
Right. Mr. Dahiya, what kind of impact you are seeing due to the GST cut and ITC reversal?
So I think, first of all, there's renewed interest from the consumers. So you're seeing much higher growth rates. When I say like, and it's continuing. The interesting part is it's continuing. So even as of yesterday, as of day before, it's on. Now, do I believe this will continue 1 year from now? Maybe, maybe not. Very difficult to say if 1 year from now we'll still be talking about GST, because these things, there was a time before GST, there was a time that's going to be after GST, and it's going to be kind of something that happened at one point and people forgot about it after a certain amount of time. I think there's a lot of media interest specifically in, you know, what happens to various things. I think it's time, and I'll make a different point here. I think it's time, and somewhere Anup referred to it. You know, insurers carry the risk and nobody else does. We as distributors don't carry the risk. The service providers, whether it's garages, hospitals, nobody carries the risk. And what that does is it pits the insurer against everybody at the point of claim. Because, you know, think about it. A distributor loses nothing by selling to a customer who's likely to have higher claims. In fact, would like to sell more that way, right? And a hospital or a garage gains when a claim happens. And I think this is the biggest flaw we have. It pits everybody against. And somewhere, we all need to become partners in risk. It doesn't mean the insurer is absolving itself of the responsibility, but it does mean it starts to become a shared responsibility. And I think our thinking, quite honestly, we've had too much conversation on what is commission, what is expense of management. We need to move on. We as an industry have a job to protect the consumer and operate at an operating ratio which makes sense for our shareholders. So the conversation really needs to come down to combined operating ratios. And that is where the partnerships will evolve.
Right.
So if one distributor can do a much better job than another distributor in risk selection, commission is just a part of it, whether it's called commission or expense ratio or whatever. And I think we made a change in our industry by moving from commission to expenses. And I think now we need to make a change of moving to operating ratios,
right,
where we all become partners, including with our service providers. Because without that, the alignment will never be there, and people will keep working towards different purposes. I think GST my personal opinion is 6 months from now, we won't be talking about GST.
But so the pain is short term, you mean to say, for someone like policy?
I genuinely don't think there is pain. Let me kind of just share the numbers with you, right? We were growing at 60% before GST on health. I think, yeah, we are large and we grow quite fast. We are growing after GST at 102% year on year. That's more than an 18% growth.
Okay,
right?
so the volume will...
But the interesting part, and I'll share this also, I'm just being very specific about numbers. Our combined operating ratio for our partners is at 93%, which is much lower than their combined operating ratio on other channels, right? So I think that is where the story is going to go.
The volume will make up for the margins.
I am not actually interested in the volumes alone.
Okay.
I'm interested in becoming partners on operating ratios.
Okay.
Because that is where we become genuine partners. And that's where we know we are aligned for the long run. Because if we are not there, if I have a book which is at 150% claims ratio for the insurer, how does it matter whether the insurer pays me 0% or 2% or minus? It should be charging me 50% for doing that business.
Right. But Mr. Sunil, will it move the needle on the penetration by making it more affordable?
So I think Yashish gave the answer. Like he said, from 60% growth has moved to 100%. Now, will that move the needle on penetration overall as a country, if you look at it? To some extent, but not to all. So the problem statement is, how do you get everybody covered for health? I think that's where we're starting from. I think now, but where discussion points have come to, I think first and foremost, I'm very thankful to the government for the GST thing. It's been a long-standing demand of the industry. I think we've been asking for it for a long time because health is not a luxury thing, and that, for that matter, no insurance is. No, so I think health has been taken care of. Why not automobile? Why not home insurance? Why not? That's the first thing. It's not a luxury item. It is a necessity. That is what is the first relation. The second thing is that how do we take care that everybody is insured? Now we have the schemes of the government which insures people below poverty line. Now we have for above 70 years of age. That's taken care of. We still have about 40-50 crore people who are uninsured. What impact does it have on the economic growth? It has an impact of 1.2% in terms of fall in the economic growth. If all were covered, India would be growing at 1.2%, much higher than what is growing currently. Right. Now, how do we solve this is what the bigger problem statement is. One way is, if you look at some developed nation, they have it mandatory that every employer has to cover their employees. It's mandatory for health insurance. You don't have an option to employ somebody, not cover them for, which I think is very, very logical. But it is your responsibility as an employer to ensure that your employees are taken care of. So why can't, let's say in India, we have this mandate? Now, if this mandate happens, then the question can be, people can say that the cost of business would move up. Now, how do we solve that? If you look at a government health scheme, the average ticket size, because of law of large numbers, where the affordability starts coming down more and more, is about, let's say, 3,000 to 4,000 rupees for a year for a sum insured of 5 lakh rupees for a family floater cover with pre-existing disease covered. Very ideal. Imagine, So let us say if I have house help and if it's mandatory for me to cover every employee, even let's say as an individual, and if I have to pay 3,000 rupees a year, I don't think it is going to be so expensive. And if the government says on that you get tax rebate also from your personal income tax, the government also loses no money. As an organization, if I get the liberty of showing it as a CSR fund money, nobody is losing money. But India's economic growth happens at 1.2% faster. Everybody is taking care of healthcare, which means that the healthcare infrastructure starts building up because they have more pays coming in, which leads to propulsion of growth of the economic activity happening around space. And affordability happens because the numbers are covered is now everybody, right, which is about 140 crore Indians, which is there. So when we look at a problem statement, I think we have to go beyond the micro nitty-gritties of things and start looking at how do we solve the real problem and how do we take a structured basis which does not cost the government exchequer, which is the taxpayers' money, but at the same time does not hurt anybody's pocket, but it solves the problem overall in putting it together. I think that is how insurance should be seen.
Right. The other important issue which the industry is facing is that, and mainly the customers, the tussle between the hospitals and the insurers. So since you are also a chairman of the council, so what is the root cause of this problem?
No, I think in most of the statements, I always try to de-link. I said, forget insurance companies. No? Let's leave them aside. Let's look at, again, the problem statement, the bigger problem statement of what is to be solved. Now, if I look at, and this is a Niti Aayog report also, which said that about 10 crore Indians go below poverty line every year because they can't afford healthcare. Now, that's a Niti Aayog report, no? Which again comes from a WHO report which is mentioned there. Fair enough. Now, the next statement, if I see, is that the medical inflation is 3 times the average inflation.
Right.
Okay? Now, that's also a commonly available statement. Now, we all know the compounding impact which is there. No? And I think the mutual funds and the investment guys have taught us that the compounding impact of putting 100 rupees every month can lead to crores of rupees. Right. Now, if you have 3 times the medical inflation of the common inflation, and your salaries are linked to inflation, all your DA-linked salaries are linked to inflation, what does it mean for healthcare affordability in a compounding basis 10 to 15 years from now?
Okay.
So if today 10 crore Indians are getting poor because they can't afford healthcare, now the compounding impact of a 3 times medical inflation to normal inflation would mean that this would go out of control. So we have a huge problem statement coming up, no, in the near future. Are people watching that? Now that is a problem statement. Now let's look at the industry. From the industry, what did we say? We said bring in transparency in healthcare expenses. How do you bring in transparency? The government had set up a national health exchange under NHA. It's a government setup, not an insurance industry setup. Government spoke to us, spoke to hospitals. Every insurance company immediately went and logged into NHA and said we are part of it. Did hospitals come on to board? No. Why? It allowed transparency of payment and payer coming in, 1. Second, the regulator told us, set up common empanelment so that you can look at efficiencies of scale, you can look at fraud management, and look at standardization protocol. Now we set up common empanelment. Now 1.5 years negotiation with different associations. Did anybody come forward and say, let's do that together? No. So then we started now, but I'm happy to say about 4,000 hospitals, which are at the lower end of the chain, the middle end of the chain, have already lined up for it. We already have over 100 signed up for common empowerment. It has started now. We'll get there.
Right.
So the issue here is that what is that we are trying to solve, and why it is important for the country that it should be solved, and what is that we leave behind and not doing so. Now from there, frictions will come, negotiation, discussions will happen, but on the table we should always bring in that what is that we are trying to solve, and that has to be worked on.
Right, right. We don't have much time. I would like to open it up for the audience. Are there any questions from the audience? Can you give the mic? Yes, please introduce yourself and very brief. Keep your...
Good morning, everyone. My name is Prachiti Sathe. I'm from Sydenham College of Management, and I'm from MSc Finance batch. And my question is, when we are talking about new age risk, how is data being implemented, or how is predictive analysis is being implemented in generalized insurance?
Right.
Yeah. So, very good question. You understand that data scientist, as you term it today, and data analytics, as you term it today, the industry which has been using it for hundreds of years has been the insurance industry. We do nothing without data science. And the term for this data scientist was actuary, which is still existing today. In fact, I told in an actuarial conference, there's time to redefine the way you call yourself, because that is the data scientist is there. Insurance industry cannot work without analytics and data science. That's how you understand the risk. You put it together, analyze it like you asked me, I have a dashboard which I look at every year. The moment I step out of this conference, I'll look at a dashboard. I have to keep on seeing data at a constant basis to keep on evolving to new risk, underwriting it, seeing how it's evolving, look at things, how do you solve it. Any insurer that you meet, you speak to him on data. You look at this panel, everybody gave you some data point. They're all wired to think on data. It is the basic construct of insurance industry. Now that's how it is.
Anyone else? Yeah, can you pass the mic?
Sir, this is Sanjay. So my question is that...
you are from?
I am from insurance industry, now into tech side, tech industry.
Okay. Please be brief with your question.
My question is very brief. Sir, do you think that insurance industry is expecting a health insurance regulatory sector, otherwise there is cost of insurance, health insurance product are increasing because of substandard.
First and foremost, good to see you, Sanjay, again.
Yeah.
Second, one of our demands has been to the government to have a health regulator. So we've spoken to the ministry also.
Yeah.
The challenge the government faces is health is a state level subject.
Yeah.
So what they're saying is a regulator has to come from a state level. So now we are going to talk to state chief ministers and say there has to be a regulator. Health in terms of the hospital management, no?
Yes.
Is hospital regulator has to be there. See, insurance regulator is there, which is doing a good job, be it health, be it motor, be it any line of business. There's no regulator for hospitals, where the problem statement is. So we're asking for a hospital regulator. Since a state subject, it has to go to state level.
So every state has a separate regulator for the hospitals.
Hospital regulator. So we have to now speak to state. That is the problem statement. See, that's why I say a lot of times you don't understand the bigger problem statement. And then we keep on making rhetorics. We have to get down to understanding problem statement, solving it on by way. Now we're going to talk to some CP. We've already started the conversation. And we're trying to see how do we reach to a state level hospital regulator. Because once that starts in the country, then the semblance, the question we are trying to ask gets answered, Sanjay. But happy to see you again.
Thank you so much. I think we have come to a close to the conversation. Our time is up. Please, a big round of applause for all the panelists for explaining things so lucidly and candidly. Thank you so much.
Thank you, Manojit. Can I please request for the mementos to be presented to our panelists? I hope everybody enjoyed that discussion. It's so good to see this hall filling up. And as I had said at the beginning of the day, we have a very engaging audience. So thank you for your questions as well. From dog bite to home insurance, climate change, cyber risks, the world has increasingly become a riskier place to live. And for insurers, it means more efforts to improve penetration. As one of the panelists said, that the awareness has improved, but the onus is also on the insurers to improve the penetration in the Indian market. We will be moving on to our next session in just a minute, so please remain seated. Our next panel discussion is also a very interesting subject. We will be talking about how UPI's success has inspired Indian payments banks to move out of the Indian shores and expand abroad. So please remain seated. We are just setting up for our next panel discussion. Well, the success of UPI is no secret. The government has expanded UPI beyond Indian shores, and the success of UPI has not only been acknowledged in India, but also by countries outside who want to replicate UPI in their countries. No wonder government has taken UPI beyond Indian shores and into other countries as well. And that is an ongoing exercise, and we are seeing expansion of UPI. In fact, during G20, the whole discussion on digital public infrastructure gave example of the success that UPI has been in improving financial inclusion in the country. And even the International Monetary Fund, the World Bank, in various reports have acknowledged this success of India as none other in any country in the world. So it is quite natural that the success of UPI would inspire Indian Payments Bank also to expand and look at foreign shores where there is a lot of opportunity for such services. We will be now starting our next panel discussion. May I first start by inviting on stage Business Standards Senior Correspondent Ajinkya Kawale, who will be moderating this discussion. Hello, Ajinkya. Our first panelist, may I please invite on stage Mr. Harsh Gupta, Chief Revenue Officer, Cash Free Payments. Welcome, Mr. Gupta. Our next panelist is Mr. Rahul Jain, CFO and CHRO, NTT Data Payment Services, India. A very warm welcome to you, Mr. Jain. Our next panelist is Mr. Arif Khan, Chief Innovation Officer, Razorpay. Please keep the applause going. We have a very, very distinguished panel here, and I'm really looking forward to the insights. And our last panelist, may I please invite on stage Mr. Sanjay Tripathi, co-founder and CEO, BriskPay. It's over to you, Ajinkya.
Thank you, Ruchika. Good afternoon, everyone. We have a very interesting panel and a very interesting topic for discussion today. In the past decade, India has become the blueprint for digital payments innovation. We have seen how UPI has redefined how a nation transacts, that is instant, interoperable, and inclusive. But once a technology matures to this level, the next big question naturally follows. What's next? And increasingly, that answer seems to point beyond India's borders. And for that, we have an exceptional panel from India's finest fintechs, builders who are taking India's payments blueprint and creating global opportunities for us. I would like to start with you, Mr. Gupta. With India's, largely if you look at broadly the India's payments market, and we keep hearing about low payments margins, etc. Just want to get some sense, how much of everyone's international ambition comes from the search of, viable unit economics. Are foreign markets, the search for foreign markets, the new testing ground for, sustainable revenue models? If we can start with that.
So I think, yeah, that could be one of the reasons, right? I think in Indian market with UPI at almost no cost, it's very difficult because there is cost of innovation, there is cost of compliance that you need to follow, right? And at the same time, everybody is eyeing for profitability. So of course, you look for more opportunities where you can monetize and make more money, right? And cross-border especially is one area, especially global expansion also, are areas where there is monetization, right? If you look at US markets, APAC, SEA, the margins there are much higher than the Indian market for sure, right? Of course, there are pros and cons of all this. Indian market, if you look at it, with UPI, there is much more financial inclusion. It has reached a much, much higher penetration than cards. So there are pros and cons of it, but yeah, globally, if you look at it, you make more money, and with cross-border flows opening in India, I think that's a very good opportunity. And of course, because you have proven in India, you have built a very strong tech stack in India, you would want to take it to the global markets, right? And UPI has done that, right? Low cost, fast payments, secure payments, right? Of course, there is an opportunity outside India, and a lot of other countries are adopting models based on UPI. If you look at Pix in Brazil, if you look at Pay Now in Singapore, if you look at Fed Pay in US, all of these are built on similar models like UPI, right? So I think there is a large opportunity on the basis of the technology we have built out in India. So yeah, I think those are some of the reasons.
Right. And Mr. Khan, he spoke about taking the tech stack globally. Razorpay has expanded to Malaysia being one, to Singapore. The same tech stack, the same economics, do they work similarly in a market like Malaysia or Singapore? Or how different can the process be, like the systems being placed there? How different can that be?
So I'm not too sure how deep you would want me to get into a tech stack, right? But typically the railroads, for example, cards and real-time payments, they have a lot of commonality in terms of authorization, settlement. You use a lot of terminology, right? But it's not true that it's exactly the same. There's a lot of configurations, local rules, local data center rules, and those kind of things, right? But yes, it's a good, like let's say 75–80% of it would be common, right? So what it means is that if I'm in one geography, can I go to another geography? I need not necessarily rebuild from scratch. I can actually build it out from here, apply some changes and make it live maybe in 3 months, or maybe the second country you do in 6 weeks and so on. So I think it's relatively easy from that point of view. I think the bigger adaptation comes in is when you have to start adopting to the local payment methods over there. So the equivalent of a UPI over there will have its own nuances, which are non-standardized.
So I think that's where you have to put effort. But obviously you put in effort where you see an opportunity, right? So for example, Malaysia for us is a separate license. Like how you have a PAPG license in the country in India, you have a specific license over there, you go to the regulator and there are things to be done over there. There's an entity called PayNet over there, which is somewhat similar to NPCI. You integrate with them and do a bunch of things, right? So that's how it actually works out. Coming back, and I think somewhere the question links back to UPI, right? So UPI, I think the way, just to step back from what Harsh said, that UPI is two parts, right? One is the UPI protocol, and one is, let's say, UPI for an easier understanding, the payment instrument. Right. What is happening right now is when NIPL goes and ties up, it enables Indians to shop with their UPI instrument in that country. So that's what we did when, with Singapore, with Pay Now. Some of it was done in Bhutan and a couple of other countries, and they're expanding to many more. I think the real value of technology comes in if they start adopting the same protocol. Right? If they adopt the same protocol, then the Indian fintechs, for example, let's take an observed country, like say Argentina. I know it's very far, we don't do a lot of business with them. But anyway, if Argentina tomorrow underline pins it and say, look, we will use the UPI protocol, the Indian fintech ecosystem will be really a winner over there because we've built a lot around that protocol. So then by natural, you are like, it's like when, let's say, HTTPS, someone in US did it. So you'll always find internet first companies coming from there, right? All the e-commerce bubble, everything happened over there. So if Europe did the initial GSMA, stuff, the technology, you'll find all the hardware providers coming from that part of the world, right? And similarly. But if you look at, if I make a parallel, if UPI gets as a protocol exported somewhere else, as a standard, right? For example, we have standards like ISO and so on. Just to give a parallel, right? Then we are a lot to gain. If that doesn't happen, then the typical thing would be that, okay, where do Indians travel more, right? And can I then plug in UPI for that? So Indians do travel. I think Malaysia is the 4th or 5th highest country where Indians travel for a holiday. Maybe they come up with 1 or 2 movies which are Malaysia-based, the travel will go up. Yeah. Like, so you have to come with some movies like they did on Spain and all those sort of things, right? Right. So that would help. Coming back to the question is, do we see an opportunity? Because the learnings you get from India, the maturity, because India has a, there are different statistics. People like you publish 75%, 80% digitalization and so on and so forth. And every country is looking for a real-time payment to do P2P to start with and do to P2M. There is a winnability option over there. And because in India we operate at such a low margin that we've learned to live with that, right? Right. See, very often we compare and we say there is more money to be made overseas is because somewhere here we are used to, thanks to our large population, right? We are used to that very thin margin. So anything which is a little higher than that seems very appealing to us. So obviously you'll chase it. So it's like a typical business where you want to export your stuff outside, you go and set up something in some way or the other. But one needs to understand these are regulated entities. It's just not that you go and set up business over there. Correct. The local regulation is which you really need to sort out, which will be very different from the Indian flavor. I hope that gives you clarity.
That's very interesting. In fact, taking a cue from your discussion on UPI Pay Now linkage, for example, in Singapore, I'd like to ask Mr. Jain, you recently signed an MOU with NIPL, which is NPCI's international arm on taking UPI to Japan, if I can say that. And that is again from the perspective of Indian tourists being able to use UPI as they transact in Japan. Mr. Jain, how different is our payment systems in Japan, and what is the strategy to scale homegrown payments in something like a different country? And that again coming from the perspective of Indians traveling to a different country.
See, we recently signed an MOU with NIPL for making Indian travelers to transact in Japan. And the whole purpose is to look at, because currently the travel from India to Japan has been increasing substantially. Maybe Arif mentioned about a movie, I don't know, but mostly the Indian people are really exploring the new geographies. And one of the purposes is to look at Japan being one of the developed market, the penetration of QR is really less. And since it's a developed economy, a lot of people are on cards or on the tap and pay payment methods, like Apple Pay or some of the other tap and pay modes. So what we want to enable is obviously any Indian traveler going, and if he goes to an Indian local curry shop or a restaurants, where most of the Indian restaurants where you find it very easy to make the payments through UPI, that's what we are currently enabling it. But at the same time, when you look at the Japan market, it's not very conducive at this point of time as far as the QR codes are concerned. So the PayPay is the #1 acquirer as far as QR codes are concerned. Our own company, Docomo Pay, is the second largest QR acquirer in the country. The young generation is pretty much open to use QR options. But still, Japan is very different geographies where people, in terms of their spending, they want to rely on their card points accumulation, loyalty programs. So they are pretty much onto it at this point of time. For them to move from this loyalty program to an QR-based method, obviously they are still living in 2026 as far as QR methods are concerned for India. So now, lot of new age apps like PayPay or Docomo Pay, we are trying to penetrate with some sort of an incentive program so that the penetration on the QR goes up. At the same time, when you look at the large merchant places, they typically are, the integrations are very different as compared to what we have it in India. So that also creates another issue with respect to the penetration of the QR codes, because they are not fully integrated with their billing system at this point of time. Our purpose is to look at, because one, we are also integrating a lot of government systems for the country. So Interbank Japan has a system which is called KOTRA, which is a QR-based system. Even while we were talking with NPCIL and the Government of India, Government of India has offered to Japan saying that why don't you don't have a very stable QR system which is interoperable, everyone has their own separate QR codes right now, to offer India's UPI stack to Japan. But obviously, you know, these are very bilateral discussions. How it goes, you really don't know at this point of time. But the KOTRA is the one which Japan has selected, which is an interbank system. But that system still not interoperable. The way we find it very easy to use it in our country, it's right now it's not so easy in Japan. So, but to make Indian UPI available, that is easier right now, because it comes as another payment option within the ecosystem. So it becomes pretty easy for people, those who are traveling. And the current purpose for National Payment Corporation is they are trying to ensure that we are available at the places where majority of the Indians are shopping.
Right, interesting. And also, Mr. Tripathi, from the perspective of cross-border payments, broadly we have today, you know, global payment majors. For example, we have someone like a PayPal, etc. And we also have increasingly large volumes happening on cross-border. This is again from SMEs, enterprises, freelancers. You know, how do you sort of compete, and how do you sort of strengthen presence in that sort of a market again? If you could give some color on that.
We are the youngest out of the lot over here.
Yes, that's right.
Just 30, just 2.5 years old.
Yeah.
So that's a good way to say, no? Like, you know, why should I tell my age? Okay, so what we realized when we came and, you know, look at the gaps, what we realized that while domestic payment is very, very competitive, you know, almost in few bips, very few people have, you know, a double-digit profit margin in most of the transactions, but international payment is primarily driven by either banks. But for the MSME segment, which is MSME, to give you a perspective, India does around $850 billion export. Out of that, 50%, close to 45 to 50% is MSME or the small businesses. Banks charge anything between 2 to 3%. Card network charge between 4 to 6%. And interestingly, the players like big players, international players like PayPal and all, who does close to $2 billion business, they charge all the way up to 8%. So that means just someone is moving $100, he basically get $92 worth of converted money. So that's where we saw the opportunity. Like, you know, I always say that example when I'm pretty old, like he said, and when I was young, I was going to, my father used to give me money to go and give money order. Money order used to charge 3%. So that 3% is today 0. Because when I'm sending through UPI. So I always believe payment cannot be at a 8% level. It can really, really come down. So we started the company thinking that what we can do so that, bring it close to the domestic payment kind of thing, both in terms of cost, speed, and in terms of accessibility and availability. So speed is something today, most of the people do the weekly settlement kind of thing. Bank also does settlement in 3-4 days. And accessibility, unless it is cited in your Nostro, bank will not give you any information. So today someone is saying that, let's say you are sending money, sending some goods. The other guy will say, okay, give me your bank account detail. He'll say, okay, I'll give the SWIFT instruction. I've given my bank instruction, but you don't know till the time it hits your bank. So that's the area we saw an opportunity. We said, can we really bring it closer to the real time in a bank-to-bank transaction? So that is where we tied up with the international payment rails, which is like with the Visa and multiple currencies. So what we offer is like a local account in that local collection account in those geographies, like 6 currencies or 7 currencies, we give a local collection account. So what it means is that, when your party is paying, he's not paying your HDFC bank account. Let's say it can be depend on which bank we have tied up or my partner has tied up in those geographies. It can be a Citi account, it can be a Barclays account in UK. So your party pays locally, so that money comes to you immediately. In my app, it shows immediately. I bulk it up, and in one transaction, I bring it to my bank Nostro, and my bank send it back to your HDFC or ICICI account. So it becomes faster, your visibility becomes better, and at the end of the day, cost can come down. So for example, I'll give you a perspective that $10,000 and above, we have now bring it down to 0.25%, which is pretty close to almost like a domestic transaction kind of thing. There are opportunity to bring it down further, depending on how my business goes up in terms of I can have better deals with the bank, my payment partners and all. Cross-border payment is growing, but unfortunately, in India, less than 5% is done by Fintech, which is one of the lowest in the world in cross-border payment. While domestic payment, we are highest in the world. Cross-border payment, Fintech penetration in India is the lowest in the world.
Right.
Among the same geographies which I'm not comparing with, let's say, against African country, I'm comparing with the similar countries. All the players, including PayPal and all, are less than 5%. So that's the time, one of the last Fintech in the same place, GFF, when Mr. Modi came. He came and visited our stall. His point is that, can you really bring it down, bring it up to 20-25%, all Fintechs like you? It is quite possible, because internationally it is 25% goes through Fintechs, but India it is less than 5%. Why? The entire thing is done by the bank, and bank, the problem is the experience across the layers are very different. So today, if you go to ICICI Bank here, vis-a-vis, let's say, Bank of Baroda branch, vis-a-vis Union Bank of branch Baroda in Azamgarh, all the places experience is different. It is pretty manual, and import is the 100% manual. There is almost no Fintech available over there. Import only, the subscription payment is something which all the players like Razorpay, Casperis are doing. So I think there's a huge opportunity for Fintechs like us and together to really bring in the speed, access and the cost down in those aspects. So that's what we are working. And if you look at India has a dream of doing $2 trillion export by 2030. And if the 50% goes through this, it is almost like a $1 trillion opportunity for the Fintechs to really look at.
Right.
Even if you get 20% market share, it is almost like a $200 billion opportunity in 5 years' time. So that is where we are coming in. And coming to other point, so it is not that, we operate in B2B, C2B, B2C, one side there has to be B, we don't do P2P. And also another opportunity, the infra, which we can take global. So what has happened, because we made the wallet kind of technology with the Gift City license, now I can give that infra to the players like Razorpay, Casperis and all, who are operating on only PA, domestic PA. Let's say, I'm not saying about them, I'm saying like people who are concentrating on domestic business.
Correct,
They don't want to really spend that much time in cross-border rails, but they want to get access that. I can give that to other banks which don't have the, AD1 licenses, like cooperative banks and payment banks and all. Even some of the large banks came to me because for the collection capability, because I can do it faster than to the SWIFT network. So it's an alternate to the SWIFT network which you are working on.
Right.
So I believe the opportunity is not in India. I can take the same technology like he talked about when he talked about Malaysia. If you look at payment has gone through multiple layers. There is one is application layer, one is the infra layer, then one is local layer. So it is a regulatory layer, then a bank license. That is the point which you need to change. See, for example, if I take my infra tomorrow to Thailand, I can start, as long as I've got a license, I've got a partner who has a license, depend on whether I am a licensed player or I am a TSP, and whether I've got a bank partner or a distribution partner. So if I have those things in place, it'll happen. But the primary important thing which you need to make it happen is the compliance. So that's the basic difference between a domestic payment versus cross-border payment. Today, everybody struggles because the compliance across countries or across instrument, across players are very, very different. So when the money has to move, money has to just not move faster, it has to go with all the information which looks as a genuine payment. So that is where also need to be strengthened to make it faster.
Right, right. Mr. Khan, if I could ask you on the challenges in scaling cross-border payments. I think we were also discussing this before our conversation right now. You know, what are the most pressing challenges right now as you scale them?
Yeah, see, I don't see in the near future cross-border having the same efficiency or the cost of a domestic. Firstly, because as you rightly mentioned, right, if you do anything domestically, it's one regulator. It's all under one regulator, one entity like NPCI gets centrally managed. It's much more simpler. But the moment the jurisdictions are different, for example, I was in a different forum. There were regulators across 2-3 different countries. So the language, the choice of words, right? For example, you mentioned wallet, right? The definition of a e-money wallet is very different in India, what it would be in a Singapore, what it would be in the US, right? So I don't think the regulators speak the same language, and rightfully so, because they are first, the reason they are there is to protect the domestic national output, right? And also we need to understand that when we talk about payments, see, payment is an after thing. You don't do payments for the sake of payments. You do trade. And if you, and I don't know when was the last time you picked up a trade agreement, right? The trade agreement has so many things that talks about invoices and product and controls and quota and rations. And when it refers to payments, even if you look at trade agreement between our country and some other country, right, which we call friendly country, payments is just a mention in a very generic way. Right. So all of this is based on earlier railroads that existed, right? None of them have been actually adopted to the new digital money railroad that is there. So I think that challenge is not going to go away. It's going to be there for a long time. One of the things again is look at it, look, whatever we do to cut costs, right? Whether it's tech efficiency, experience efficiency, or success rate efficiency, the underlying issue or a challenge, whether we like it or no, is eventually the money moves through SWIFT.
Right.
Whatever you do, the money, the settlement is through SWIFT. One of the reasons, like, again, he mentioned about opening accounts in overseas corridor, which is I'll call it a hack, I mean, which we also do, for a lack of a better word. What it allows us to do is move the money in bulk and allows us to give visibility that it's reached an endpoint, right? Why do I move it in bulk? Is because the cost of SWIFT is per transaction. If I use the entire bulk, it helps
Right.
me save money, right? So I think I'll keep going back, right? If it really needs to be, if you want to have this railroads which is as efficient as domestic, then I think it's too much of idealism. It's not going to happen.
Right.
You know, I hear a lot nowadays about multilateral or interoperable. These are buzzwords nowadays. Right? Everyone talks about interoperability, multilateral, and all those kind of things. So there are 200 plus countries. I forgot my geography, right? 200 plus countries in the world. Actually, if you look at it, there are 8 or 10 countries that are significant for us as India. 8 or 10 make up 90% of our, you know, either our travel or make up our trade businesses, right? They cover 90%. I think we should look at how we could do bilateral with these countries.
Right.
Getting 200 geographies, 200 regulators with all the geopolitics, trade wars, it's not going to happen. You crack at least 2-3 corridors, 2-3 very specific countries, right? I think that's what will pay for us to become the trillion dollar economy. Unless that doesn't happen, we are going to struggle. And someone needs to, and again, you know, when I say someone, all of us need to figure out how to, what I call manage this animal called SWIFT. I mean, it's a great solution, works, but it's a standard that not been set by us. It is bloody expensive.
Right.
The banks love it because, you know, there is a passback that comes to the banks through that. But from a fintech point of view, there is no passback for us. I mean, we don't like to talk about it because you don't want to take out the big giants. But one of the things we are supposed to do is take on these guys. And I think SWIFT is a big, big challenge for us, right? You know what happened to Russia when there was a war.
Yeah.
Suddenly they're out of SWIFT. That could happen to anybody, right? With all these trade wars happening. So I think the deeper solution is on that front, but I don't see that happening in the next 3, 4, 5 years, maybe even the next 10 years, right? So then you say, oh, what do I do next? Then you have these tighter corridors between the next 5, 6 friendly countries where you have a lot of trade happening, you have a fair bit of travel happening, and sort it out, right?
Right.
I'll give you one more example and end over there, right? And I think it's a mix of both regulation and the way money moves, right? You spoke about Japan, right? So, okay, when I go to Japan, I'm going to take, say, local cabs or local metro or something like that, right? Let's say Uber, Grab equivalent over there. I'll do maybe in dollar terms, a $3, $4, $5 transaction value per ticket. These are all LRS transactions.
Right.
LRS, every single transaction is reported. For every single transaction reported and money transfer, there's a cost. Let's say the cost is $1, right? More or less, it should be in that rate. Right? So imagine I've done a $4 ticket, I've done a $4 travel, local travel in Japan, and for that there's $1 being spent just to transfer that money over there.
Correct.
That's 20%.
Right.
Correct? Can I say that, okay, can I have LRS for cab and my transport clubbed together as petty cash up to $100 limit, and there'll be one transaction fee, $1 or 100, vis-a-vis $1 for every $3, $4. It just doesn't make sense. So I think these are the challenges that we, the regulator and the industry, specifically the industry, has to come together, maybe get NPCI and IPL involved and solve for this. Because that's how we start unblocking some of this. But without that, this $1 trillion dream and all is, you know, it's like a mission Mars, in my view.
Right. Interesting. And also, Mr. Gupta, Mr. Khan mentioned about tapping into those 3 or 4 corridors who would give you the volumes that you would require. Again, tapping into them in the first place, are there any bottlenecks that need to be solved, before this? And that includes, bilateral agreements, arrangements, and also on the processing side of things, any specific bottlenecks that are left to be solved?
So I think Arif mentioned those challenges quite well, right? And while a lot of those things are changing. So for example, taxation, right? Taxation becomes a big challenge when you are collecting from India or you are remitting funds outside India, right? Then risk and compliances, right? When you think of cross-border payments, I think the first thing comes to your mind is risk, compliance, taxation, speed, cost, right? Today, the cost of moving funds is quite inconsistent within the countries, right? As in, unless you have very well laid out trade agreements and everything is well written down in regulations, all of these things are quite ambiguous at this point in time, right? So I think those are some of the things that, of course, need to be addressed first, right? Then if I really look at some of the other challenges, today, if as an ecosystem player, I want to streamline for an Indian consumer to invest in the US markets, right? It's very complex and cumbersome, right? There are different kind of flows which are laid out, right? There's LRS, there are capital accounts. They are still not streamlined for an Indian consumer, right? And for an ecosystem player like us, we also face challenges in streamlining some of these processes, right? Because there are taxations in terms of a consumer who's investing outside India, what taxes they'll have to pay outside India, and when they bring back the money to India, what other taxes they need to levy, right? Plus, bringing that money back to India, there is another cost of bringing that money back to India, right? Investing itself is a challenge, right? Because there is, you have to go to a bank, or you can only work with your bank branch to move funds outside India. You can't make it seamless like you have in UPI in India, right? You can't use UPI to invest outside, right? So those are some of the challenges. Then I think there have been guidelines around TCS, right? So if you are traveling outside India, you do a transaction through your credit card, the online travel agent will deduct a certain amount for TCS, right? Those are very, very ambiguous things that are coming up, right? So I think those things need to be streamlined. Only then I feel it will scale to a level what we see in domestic transactions.
Got it. Right. Interesting. And there's something I'm personally very curious about is stable coins in the context of cross-border. And maybe we can start with, the kind of opportunity that there is with stable coins, and can fintechs sort of take the leap of faith when it comes to scaling that bit. Maybe we can start with you, Mr. Jain. How do you see that very briefly, and then we can go to the other panelists as well.
Yeah, I think from a stablecoin perspective, our ecosystem still, from a regulatory perspective, is not adopting to the stablecoin. We have our own CBDC, which we are trying to penetrate at this point of time. In one of the speech, finance minister talked about being adoption of the stable coins. But for me, I think it looks still far off for us as a country to adopt to the stable coins, because one, it is not backed by the central bank. What we need, what we are trying to look at it is in globally, majority of the countries are looking at CBDC. Maybe 80% of the countries are currently looking at to look at their own CBDC.
Right.
Few of the countries like us has taken a good lead in terms of the deploying the CBDC model, but still the way the trade has to happen on the CBDC, those flows still has to come in.
Right.
Stablecoin becoming popular for us on trade, in the near future I don't see it, but for global transaction it is becoming a good mode of payment as far as the real-time payment transactions are concerned.
Right. Mr. Tripathi, your view on stablecoin?
I think, so as Rahul said, like, and I think what our regulator is comfortable is CBDT, because we believe that, that is the way forward kind of thing. But globally, many regulators, including US, Singapore and all, they have started accepting stablecoin as a movement. Why stablecoin? Obviously, it is faster, like, because it has opportunity to bypass the SWIFT network, and basically it's basically wallet to wallet, and you can do it. Whether we have the capability, yes, we have the capability. Tomorrow, if our regulator allows stablecoin, I can move money in stablecoin, because in my wallet, it's a multi-currency wallet. I can get USD, I can get GBP, I can get AUD. Similarly, I can get stablecoin, and it can show stablecoin. So the advantage is faster, but the problem is, like, we also have to get the compliance information, right?
Correct.
When a fiat currency is moving, I get all the details, whatever SWIFT has that, the ISO standards, I get certain information. So stablecoin has to give that information. And stablecoin also has to, like, when I'm converting here, there has to be a mechanism to convert. See, the problem is, like, I can always keep stablecoin in his wallet. But if my current regulator is not allowing to convert it to the fiat currency, which is Rupee, so, and that rate is not available on a regular basis, then, that obviously I can always bring in, it'll be staying in a wallet, but I can't convert it in the real time. So there are multiple regulation, and at the same point of time, rails has to be there to make it happen.
Right.
The countries which are doing it, they are taking a progressive stance. I believe whether it is a stablecoin or CBDC, it is going to come. It's just a matter of time. Because that's a way we can actually save money. That's a way we can make it faster. At the end, that's a way we can actually make it, cross-border payments much more transparent and, much more faster. And eventually, it's a benefit of all, because you are basically saving money in the ecosystem. Just imagine 5% today. I was on another panel. SWIFT is saying in 3 years' time, they're looking at bring the cost down to 5%.
Right.
So 5% on a global trade of $1 trillion. You can just imagine how much money my MSMEs, exporters, or the people who are sending money, how much they will save.
Right.
Again, it will be plowed back to the business.
Correct.
So it is definitely in interest of the country to move to that kind of rails.
Right. And Mr. Khan, how much would regulation how much would the success of it depend on regulation?
See, my co-panelist answered like a CFO and a compliance head, so I'll skip that part, right? I think everything is not compliance in my view, but it's extremely important, because as a country, we have not. But having said that, I yet have doubts as to, let's talk about stable coins, right? So what's the new fancy about stable coins? Yes, it's happening a lot in US, it's pegged to $1. I'm trying to think through what changes for me, right? In the current context, can we do it? I think tomorrow, if there's a regulation, we can probably do it in the next 48 hours. There's not a big thing to do, right?
Right.
I think my worry is whether it's stable coin or there is a talk of Ethereum, there are a bunch of this, right? Technologies and all. See, the underlying fabric on this is distributed ledger. We need to ask ourselves the question, as a country, are we ready to handle distributed? Are we there on that? For example, I'm not advocating for it. I'm certainly in no way advocating for it. But if you look at the use of distributed ledger and then Bitcoin, it makes a lot of sense to me. Because if you replace anything with Bitcoin, anything else,
right,
then one of the biggest thing is, I usually see this as a way to surveillance, right? And I see that a lot happening in the Europe and the West. In India, we are yet blessed. For example, the Indian CBDT, it's more as a tool to enable and to do for things like DMT, benefit transfer and all.
Correct.
So it's more a tool to aid to reach the, the poor or the tier 3 citizens of our country. But the same thing in the US and all would be used as a weapon to do surveillance.
Correct.
That one.
Yeah.
And whether it's stable coin or some other coin, I wouldn't care much about it. I think the underlying fabric of distributed architecture in a world where everything is centralized, that's going to be a challenge.
Okay.
But yes, what it brings to you is, because there are distributed nodes, if one understands that, the availability of information is at every particular node, right?
Right.
So in a typical trade transaction, let's say shipping dock, wet ship, lease, landing on a port, it all moves sequentially.
Right.
That all information can be in a single place available to individual basis they need.
Got it.
So I think that's great about the technology.
Okay.
Having said that, I really don't think stablecoin is going to make a lot of difference in an average citizen or a country's life right now, other than create more. It's going to be pegged by a dollar, so the dollar wallet is yet there.
Right.
Eventually, you'll do settlement in SWIFT, so the cost of SWIFT is going to be there. Then you'll have one more wallet. Then there will be a question in US, the wallet is interpreted somewhere else. We are interpreting something different, so it will only create chaos. We have something as small wallet, big wallet, low KYC, big KYC. They have something different. So that's not happening.
Okay.
What's going to really work is if in two corridors, we have a way of saying that this is the definition of things, right?
Okay.
Otherwise, it's not solving for anything in my view.
Got it. I think we are running out of time, but we can take a audience question. Anyone would please raise your hand? Yeah. Please identify yourself.
Hello. Yeah, I'm Sunil Mehta. Just wanted to understand one of the speakers said about this LRS. Now, as far as, and tax component on that. So, like there are people, particularly MSME, somebody referred, who are transferring money and suppose it goes beyond a limited threshold of 7 lakh rupees, then their TCS applicable. So, if people, in that case, even bank says, okay, our limit is 7 lakh rupees. But if I remit, say, 20 lakh rupees through 3 banks, how system tracks it or take care of it that there is no non-compliance at the stage 1? And if wrong happens, how it is treated or how it can be corrected?
Maybe I'll take that one. And maybe Arif, if you want to add to that, right? So I think today the way it works is when you are doing an LRS transaction, and LRS typically covers your travel, healthcare, investments. These are the 3 education as well. These are the 4 categories which come under LRS, right? So whenever you are doing a transaction under any of these categories, you have to provide your PAN card as a consumer, right? Now, when you provide a PAN card at the back end, RBI has a system where against each PAN card, you sort of keep a reporting of how much money has moved out of India against that individual, right? However, all of that system is today very, very manual, right? So today, if I go on to Make My Trip and do a travel booking for, say, Japan or US, right? I will provide my PAN card to book that ticket. Now, that LRS check does not happen on real time. It happens at, say, a T+1, right? So those things are still manual in nature right now. So did I answer your question? Sorry.
Okay, maybe we can take the rest of the conversation offline.
Yeah, like just if you want to continue, sir. The thing is like, okay, it might be done at T+1 level. Now, most of the payment made through different credit cards also. So my question is just how does things get integrated? So either party knows that this is the wrong they have done it? Or?
I'll make it shorter and we can have offline.
Sure.
So yes, there is a backend system. As Harsh said, it's on a T+1 or some kind of timeline. But you need to understand in all this, the declaration is on you as a consumer or the individual. At the end of the day, when you are signing your IT form, it says, are you declared to your honesty? If you don't, then you're going to get in a mess. So it's your responsibility as a citizen. Yeah, it's left more for the regulatory bodies and the tax authority to figure out and then come back. But as an individual bank, right? Like for example, wallet limit 1 lakh, you can have 10 wallets. How do I know? So what we do as entities or individual banks, we do to the best of our knowledge, best of our information we have captured or declared by you. But in the end, eventually it will come back to the individual or the business that what have you done. That's how it works, in principle.
Okay, thank you so much, everyone. Thank you so much for joining us on the panel. The opportunity really is that we discussed today, and really grateful for the conversation. Thank you. Thank you for joining us.
Thank you, Ajinkya. Thank you so much, panelists. May I please request for the mementos to be brought up for the panelists? And thank you to the panelists as well for sharing those insights, covering this subject so well. Of course, there is opportunity, as one of the panelists said, there's better profitability in global markets compared to the thin margins we see in the Indian ecosystem. And there are ambiguities in regulations which need to be clarified. There are challenges, but there is a lot of opportunity as well in this particular area. And as the group photograph is happening, I'd just like to inform the audience that I hope you're all aware that our next session is a fireside chat with former chairperson of SBI and chairperson and CEO of Salesforce India, none other than Ms. Arundhati Bhattacharya. So we will be gathering here in just about 10 minutes. So please be seated back in your seats. This is going to be a very interesting discussion. Take a 10-minute break. Please be back here by 1:20, definitely before 1:20. Please be here. Thank you. Check. Ladies and gentlemen, our guest has arrived. May I please request everyone to please be seated. May I please request the audience members standing outside near the stalls to please come in and take your seat because our guest has arrived. We are about to begin with the next fireside chat in just 2 minutes.
The future is exciting. The prospects are bright.
Please come inside and please be seated. We are about to begin with our next session, which is a fireside chat with Ms. Arundhati Bhattacharya.
Calamities which are inherent in every business are unpredictable and unpreventable. GIC was incorporated as a holding company on 22nd November.
As you're all aware, this has been the biggest business standard BFSI Insight Summit to date. We've had the most number of panels, nearly 25 panels. We had 15 panels just yesterday. The highest number of individual speakers. And overall, we have had more than 115 speakers taking part in the summit today. And over the course of these 3 days. And of course, we have had a lot of repeat guests here as well. So you are aware how big and better the BFSI has become. And the hall that we are in is also quite significant. It has been chosen to be called Chintaman Deshmukh Hall, which is named after the first Indian to be appointed the governor of RBI in 1943, which was the pre-independence India. And it was during C.D. Deshmukh's tenure, Sir C.D. Deshmukh, that the Banking Companies Act of 1949 was also enacted, that laid down the framework for the regulation of India's banking sector. So there's a lot of significance to it. We're really looking forward to our next guest joining us any moment now. So thank you for your patience, and I can see more people walking in. Please take your seats.
Celebrating 50 years of service.
You come and take the seats in the front. It's all unoccupied. Backbenchers. Come on, move on forward. I see some are waving to me. I can't see you very clearly, but please move on. You'll have a much better view and much better sound. Thank you. Thank you so much. We have also taken a look at all these news items that have been displayed within the walls of this Chintaman Deshmukh Hall. There are a lot of important pieces that have been written by Business Standard journalists over the years, significant ones, and some very interesting pieces as well that my colleague Veenu had also pointed to yesterday about the mudras in the markets, SBI at 70. That's quite appropriate actually right now. And yeah, a lot of state bank stuff here, and all over, if you take a walk, you will find some very interesting pieces and timelines that have been curated for this hall. Ooh. Thank you. On her way to the hall, so she should be here any minute now. Please put your hands together for Ms. Arundhati Bhattacharya, Chairperson and CEO of Salesforce India. It is my honor to invite Ms. Bhattacharya to Business Standard BFSI Summit 2025. She doesn't need any introduction, but still, let me say a few words. While inviting Ms. Bhattacharya for a fireside chat, may I please invite ma'am to join us on the stage. Ms. Bhattacharya was the first woman to be appointed as the chairperson of the country's largest bank, the State Bank of India. Yes, that deserves a huge round of applause, please. And this year, she was conferred with Padma Shri. Please keep the applause coming. One of India's highest civilian honors for her exceptional contribution to the field of trade and industry. Throughout her 40-plus career in the financial sector, Ms. Bhattacharya has earned a string of accolades to her name, which include the world's 100 most powerful women by Forbes, the top 50 globally most powerful women in business, and world's 50 greatest leaders list by Fortune. During her tenure as the During her tenure as the chairperson of SBI, she introduced sabbatical leave for women bank employees. She has been nominated by the government to be a part of the select committee, including Lokpal search committees. There are other committees such as the Padma Awardee Selection Committee, SEBI's Mutual Fund Advisory Committee, and National Coal Index Committee. A very warm welcome to you, ma'am. May I invite on stage Business Standard's Executive Editor, Ms. Nivedita Mukherjee, to carry the fireside chat. Over to you, Nivedita.
Good afternoon, everyone. Thank you so much, Arundhati. I'll call you by your first name. That's so much easier. We'll begin by talking about technology because that's where you are right now, and then we'll go over to your previous stints. So technology, how do you look at the world of technology really after coming from SBI? You've been here for 5 years already, since 2020.
Yes. So first and foremost, thank you for having me. It's always great to come to a business standard event. And in a way, I miss it. In my 4 years in SBI, I was a constant. But since I have gone over to IT, I don't think makes that much news. So probably media doesn't cover it as much. Which means that we really need to go up in your, in your estimation so as to make the papers more frequently. Now, how do I look at IT actually? Even while in the bank, there was one belief that I had, and I hold to it very closely even today. And that belief is that any organization that's not taking IT seriously is not going to sustain beyond a particular point of time. It doesn't matter whether you're a mom and pop shop, it doesn't matter whether you're in the area of, say, HR, or in the area of logistics, or in the area of manufacturing or services, whatever way you look at it, a strong IT backbone is very, very important for all organizations. And if I look at IT itself, the technology itself, and the way it is evolving, the speed is, I would say, supersonic. Means every single day we come up with something or the other that has evolved, that has changed. If I look at agentic AI, which is what we are working with today, this was announced in our company last September. And from September to this October, that's 13 months, the distance that we have covered is now we are declaring agentic enterprises. Now, this speed of change, of evolution, is something that is unprecedented, even in the world of technology. And therefore, I think, it's something that people really need to take note of, really need to lean into in order to reap its benefits. Because if you don't lean into it, it's something that's going to overwhelm you at some point of time.
You mentioned a very interesting thing, speed of technology evolution, AI, agentic. So from the world of State Bank of India to this speed of technology, how has the transition been? Has it been Has it taken you some time to settle down here, or was it a smooth transition?
So, you know, one good thing that the SBI teaches you, they teach you to sort of lead as you learn. Okay? I think that's the speciality of people in SBI, because they transfer you on a regular basis, and they transfer you to a different location, to a different vertical, to a different community, to a different team. And I used to say that the rule of thumb in SBI is very simple. For a woman like me, the moment I get a good person to cut my hair, that is a good hairdresser, and a woman who will, or a person who will stitch a proper blouse for my sari, I know the time has come for me to be transferred. Okay. That's precisely the amount of time that SBI would give you in any place. You know, just as you get settled in, they will think of something else that they want you somewhere else. Now, that gave us the ability to sort of learn on our feet. And I think that stood us in very good stead. The other thing that I learned while, trying to sort of go through, navigating through all of these changes is that as you become a leader, what you need to do is start adding value the moment you land. Now, that's a difficult thing to do, especially when you are coming from an entirely different field. But that's, again, something SBI taught us to do. That even when I went from, say, retail banking into treasury, how do you start adding value? Similarly, when I come from finance into technology, how do I add value? Because believe me, respect is not something that is a given. You cannot demand it. It has to be earned. And people will not give it to you unless you earn it by adding value. So adding value and how to do it is something that we learned from a very early stage. And I think that has stood me in very good stead in the transition from being a 40-year banker to somebody who works with people who are almost 5 generations my juniors. And yeah, it's a different world altogether, but I think it's okay.
As an industry leader and as a woman leader, how has the journey been, if you have to describe your journey as a woman leader?
So as a woman leader, I have never really thought about it in that precise a way. One thing is, of course, if you're a woman in India and you also have a career, you have to continuously sort of calibrate how you take care of certain other family responsibilities as you go about taking on newer and newer responsibilities. Now, the thing is, there will be times when you feel that it's not worth it. There will be times when there will be dissension either in the workspace or in the home space. But you need to sort of accept that this is the way it will be and try and find a way that will enable you to still get ahead. And yes, there are times when you get pulled in different ways and you still have to make up your mind as to which way you will go so that you are doing the best possible under the circumstances. But in respect of one area where, a lot of women have asked me, do you have problem in getting your juniors, if they are male, to sort of respect you or listen to you? I must say that I have never come across that problem. Either I've been lucky with my male colleagues and they have been really, really nice, or they may have talked about it behind my back and it never came to my ears. It could be either way. I don't know which way it was, but I never had an issue about having a lot of juniors who were male. I could still carry out my agenda. And I think the main thing that worked, was my ability to communicate what I thought, which excited them as much as it did me. And if people are excited about something, if people believe in something, then it doesn't really matter regarding the gender of the person who's leading, because they know that they can contribute a lot. They know that they can also be successful. And to that extent, yeah, it works.
In her introduction, Ruchika mentioned that you had allowed sabbatical leave for women at SBI. Was there anything else that we do not know that you did for your women colleagues?
So most of you know what all I did. One, of course, was the sabbatical, which I was hoping, by the way, the rest of the PSBs or rest of the banks would follow. They haven't. I still hope that they will. It is very useful. For the women colleagues, I did one or two other smaller things that I remember. One was, you know, when I had gone to a gathering of some of these younger women colleagues, I found that most of them had taken on platform roles, okay, and they were not in the operations, that they were not in the branches. Whereas their male colleagues were out there doing their rural assignment, their branch managership. And as you know, in the banks, you have to have 2 years as an independent assignment and 2 years in rural service in order to qualify for your next promotion. Now, obviously, if women were not doing these things, then they would not qualify for promotion and they would start falling behind. So I gave them a lot of gyan, you know, about why they should do this and do it immediately as soon as they got confirmed. And one of the youngsters stood up and said that, ma'am, it's not like you think. It's not as though we are taking the easy way out. We have an actual problem. And I asked them what it was. And she said that in many places, in the rural places, if you place us there, we are not able to commute. We need to stay. And people there will not rent out their places to a single woman. It's not considered proper to rent out places to a single woman. Now, this was a fact that had never even struck me. And I was amazed that, yes, society could be like this and that I was not aware of it. So I came back and we decided that we would identify certain rural branches where women could be sent so that they could either commute, or we would locally take a place in the name of the bank with, say, 4 or 5 bedrooms, and we would house the rural branch managers there, and they could commute to the villages nearby so that they could complete this assignment. So we called it a chamari, and we started it, and a lot of women started taking up these assignments, and some of them said that being in that kind of a, you know, mess or whatever you call it, was some of the best years of their lives, because they really had a great time, you know. They would take turns cooking, they would be in amongst people of their own kind, and they could get to the rural branches, finish their rural assignment, finish their branch managership, and be on the way to their next assignment. So that is one thing that we did. The other thing that we did was also cervical cancer vaccination for all our women staff and their wards, because that's something that's very easily done, it's easily preventable, and yet there's very little awareness about it. I also tried to ensure that in all of our bigger centers, we had at least one lady as either a gynecologist or a pediatrician, because that would enable a lot of the women to not have to go out and get these appointments, but they could get their problems solved in the banks itself, and that saved a lot of time. It also allowed the women to, to be a little more free in their minds, especially if there was a child that was unwell at home and you needed to take the child to the doctor, you could bring it to the office and have the pediatrician look at the child. So that's another thing that I did, which I think also was quite useful. So yeah, little things like that.
That's a lot of things. My last question on women in banking. There was a time when we had so many women CEOs across banks, not any longer. What really happened?
Actually, I really won't be able to say, because I left, and I don't know what happened thereafter. But as I left a very strong pipeline of women behind. And as you know, many of them have really gone on to do a lot of things. For instance, the lady who was my CFO is still currently the CFO of the World Bank. Okay? Another lady who was there with me, Padmaja, she went on to head, I think she headed Indian Bank, and then she headed NSDL. So the ladies that I left behind as my deputy managing directors or managing directors, they were really, really strong candidates. They may not have led the banking sector, or they may not have led SBI, but they have led in various other places. And I think that's still happening. However, having said that, this is not a glass ceiling that's very easy to break. It is something that will take time and effort, but I'm sure it's going to happen. Even today, you do have various banks, I think 1 or 2 banks that are headed by women. But yes, they haven't come together like the time when we were there. We were very fortunate because at that particular point of time, whether it be PSBs, whether it be private sector banks, whether it be foreign banks, there were loads of women leading all of those. And I especially remember one reception that was given by the then RBI Governor, Dr. Rajan. And actually speaking, in that one room, there were more saris than there were suits. And that was really, something that I loved, to see the color and everything else besides. And I found that we had one single drink. All of us, were drinking this thing, your plain soda with a slice of lemon. That was the standard drink for all women, it seemed. But anyway, the thing was that there were a lot of women in the room, and I hope those days come back.
Yeah, we hope those days come back. As a banker earlier, how do you look at the banking universe right now from the outside? During your tenure, you had to see a lot of challenging things like stressed assets, etc. So do you think things have changed for better? And how do you also look at the regulator's role in resolving issues?
So, the regulator obviously has a very large role to play in all of these matters. If I look at the banking sector today, in fact, I was just saying this on the way up in the lift, that I think me and my successor, we both had the rough end of the stick in respect of, NPAs and things like that. Now, having said that, does that mean that the banking sector isn't faced with challenges today? Not at all. The challenges are different. The challenges are definitely there, but the challenges are different. Now, what are the challenges? One of the biggest challenges that the banking sector has now right in front of it is technology. How do they make use of technology in order to deliver better and better services? And not only that, how do they reconcile with the fact that a lot of the work that they are doing now through people can actually be done by an agentic layer? Okay, agents today, as you know, digital agents, they can not only think, they can not only generate, but they can also act. Now, how are they going to make best use of this technology in order to ensure that they are delivering better services right down to the last mile? And the last mile, I mean in the 600,000 villages that we have, where we still haven't been able to get across the kind of financial literacy that can really enable us to unlock the potential of the entire country. And unless they come along, Viksit Bharat will still not really be Viksit Bharat. Because even yesterday, somebody was telling me that while it seems like a rubber band, the way the Indian economy is, but it seems that the front end of the rubber band is moving much faster than the back end. And that doesn't work. We must move in tandem as quickly forward as possible. That's only possible through technology. So it's the same in the banking system. And by the way, I would definitely say that the BFSI sector is by far the most digitally mature sector. Okay? So being digitally mature, they have more of a responsibility to absorb what is being put out over there and use it in their daily work in order to ensure that they are delivering the best to the customer. Okay? So the BFSI sector can not only benefit from it, but has a responsibility of trying to benefit from it and showing the path to other industries. And that is, I think, the biggest challenge in front of them today.
During your SBI tenure, you had taken several steps to bring in technology. It was called Smart Bank. SBI was called Smart Bank. But was that enough? Looking back, do you feel that you could have done more?
See, on the digital front, I think we did what we could. Okay? At that point, many of these things that are available today were not available. And therefore, I don't really see how we could have done anything more. Frankly, the YONO, when it came out, was by far ahead of anything that even our private sector or even our foreign banks had. Okay? The kind of risk management techniques that we started using, the amount of technology that we started using in credit underwriting, the amount of technology that we used even to ensure that we were getting to the right people, whether it be through financial inclusion or otherwise, the variety of products that we could bring to them. I think we did what we could at that point of time. What could we have done more? Maybe we should have looked at how to become a little more agile, more nimble, because the ages going forward wants us to be more agile and nimble. And you cannot be agile and nimble when you are working with systems that are very stodgy, that are rooted in the past, that are a lot of legacy. So there is a lot of technical debt, by the way, in the system. Now, how do you work on that in order to still become agile? How do you put a wrapper on all of that in order to make yourself more agile? Because you can't write off all of the technical debt that you already have. So yes, maybe I could have looked at those areas. How do you bring forward what you already have into the new age? And that is something probably I am now talking with hindsight. Hindsight because I know a little more about technology now than I did then. And that's what is prompting me to say this. But I think with the kind of knowledge that we had at that point of time, we were trying to do our best.
Other than technology, do you think there was something that was unfinished and that could have probably...
So, if you talk about unfinished business, the one unfinished business that will forever remain unfinished probably is customer service. Okay? You can never get to a position, and I've tried very hard, and that's why I'm saying this, to ensure that customer service is really at the level that customers would want to be at. Okay? Just take technology, for instance, customers want to be safe. And therefore, if you put in 3 layers before they can get into their account, they start grumbling. On the other hand, if you can get into the account very quickly, yes, it's a convenience for them, but it's also a risk. And should the risk take place, then they're really, really upset about it. So, bringing about that balance between convenience and security is very tough. It's different from person to person. And therefore, it is even more tough. Okay? Similarly, if you're looking at customer service, you have to understand one thing, that when you are going digital, you are actually creating a lot of risks in the system. Okay? Anything new will give you risks. And in respect of any risk, the weakest link in the chain determines how secure it is. And the weakest link in the chain in all of this is normally the customer. Because the customer is a person who's an individual, and they are not as well aware of what is going on as maybe the institution is. Okay? Because the institution has institutional knowledge and various people, checks and balances. A customer, an individual, doesn't have those checks and balances. Now, what can the organization do? The organization can create far more learning for the individual. So I think what we could have done much better is customer literacy. Basically explaining to the customer and getting them to understand hands-on as to what are the things that will keep them safe. And yet to maintain the convenience of ensuring that they are able to access their accounts, they're able to do their banking in whichever way possible, they're able to get the right kind of guidance at the right kind of time. That, I think, creating these things, creating these balances are something that is very, very important for us. And I think everybody, every player in the market has a responsibility for this. Even the regulator has a very big responsibility in respect of this. And that's something I would like to be seen more frequently, you know, in the media, in the papers, and maybe, you know, individual initiatives as well, local initiatives maybe, to see that the customer is being trained constantly on the kind of things that can happen in the cyber world. We've been hearing a lot about these digital arrests and things like that. They've started coming in the papers and all. But imagine the status of that poor customer when they're not able to make out what is right and what is wrong. And obviously, all of these crimes are normally aimed at the more vulnerable section of the population, the old and the young, who don't really understand what it is and who are afraid. They simply are not secure enough. So we need these initiatives to have more legs. At this point of time, I think it's a kind of a one-off. It's not something that happens very regularly. And there are no forums that pursue this, you know, with a lot of focus. It would definitely help if that is focused upon.
It's important that you're talking about digital arrests. Yesterday, the chief economic advisor was here and he raised that point and he said bankers have a huge responsibility in managing this. So yeah, a very, very important point there.
Yeah. But as I said, you know, along with bankers, I think regulators also have a responsibility.
Yes, correct. Can we take a couple of questions from the audience?
Sure,
yeah.
sure.
Any question?
Yeah.
Yes.
Hello. Yeah, hi. Very good afternoon, ma'am. I'm Hitesh Dodia from Vishtel. You rightly pointed out that, you know, it's very important that people need to be informed about...
Can you come to the question, please?
Yeah, question. So I really appreciate that you mentioned that it's important that, you know, now AI, now we are at the enterprise side of the AI, you know, and 1 year back you were just mentioning about the AI being launched. One question that I wanted to understand, how did you confide to the clients where, you know, there is a lot of ambiguity in terms of the safety of the data, as you rightly mentioned, that if the customer's data is quickly accessed, he or she will react in a very weird fashion. So how soon you access the data or how late? So what is the right time and how did you confide the customer to accept that kind of technology where currently AI is on the forefront and leading and learns, acts, and does to the last mile, you know, going forward? Thank you.
So, you know, basically the question of data privacy and data security is very central to everything we do. It's very central to every IT organization, okay? If you look at my own organization, the one that I'm in now, trust is our foremost value. We have a few values, 5 values that everybody knows in their sleep. It's trust, customer satisfaction, innovation, equality, and sustainability. Those are the 5 values. And if I am not able to provide you data security and data privacy, then the question of trust doesn't arise. What does trust mean if I don't have the trust of my customers? So everything possible is done in order to ensure your data privacy and data security. Having said that, you know, I remember when I was when I was chairman of SBI, I had a GM of a large private sector company call me at 10:30 in the night after having shared his OTP 11 times. 11 times he had shared his OTP. This was a general manager, mind you, of a public sector unit. He was a graduate of one of the leading schools from India, and yet he had shared his OTP 11 times. After the 11th time, he decided that there was definitely something wrong, so he called me, okay? We could hold back the last 3 payments, we couldn't get the rest, all right? Now, if somebody does something like that, what is it that I can, you know, give them in the way of comfort? I can't. Every OTP message that goes to you has a line that says, please don't share this with anybody, and especially on the phone. Every OTP tells you that. Do we listen to it? We don't. We read it, we ignore it, and we share it. Okay? So we have to be careful about how we do things. And when I'm talking about customer literacy, I'm talking just about that. I have people who have, you know, who have wanted to connect with the branch, they've gone on Google and looked up the branch phone number, which was that of a fraudster, and rung that number, and the fraudster took them through the whole routine and cleaned out the account. Now, why should you go into Google in order to look up your branch's phone number? Either you have it written somewhere, or you go on the SBI site in order to look up the branch's phone number. Why do you just Google it? So the fact of the matter is, these are simple things. When you are looking at a site, you have to be careful about the way that that particular site name appears. There are some simple indicators that tell you this is a genuine site or not a genuine site. And now with AI, these things are going to become more and more, common. In fact, there are a lot of thought going on regarding AI and generated content, that every generated content should either be watermarked, or in some way it should be made clear that this is AI generated content, so that people are not barred from the content, but they know how much they can rely on it and how much they can't. You have deep fakes today where, a deep fake of mine, for instance, could sit in on a video conference and tell my guys to do some things which are not right. Now, my people have to be, aware enough to know that this is not right, what is being said, and question it, and call for confirmation that this is what was said. So every time you have to be less naive, you have to be less trusting, you have to be less, just gullible. You have to understand that the world out there is changing every day, and you can't trust it implicitly without really questioning it.
Right. We have time for just one last question. The lady there.
Yeah, that's
Hello.
nice.
Ma'am, thank you. Ma'am, my question is, you've changed industries very late in your career. What were some of the challenges and how did you overcome them? Thank you.
First and foremost, this is something that's been asked of me a number of times, so I'm sure, if you look through any of my other interviews, you'll get it. The challenge, of course, was that I had to learn a whole new set of vocabulary, okay? What I knew then and what I know now are different. The second challenge was that I changed the side of the table. I was a buyer and now I have become a seller, okay? So that was also a different learning. Third, of course, was the fact that in State Bank of India, when I had gone in at that point of time, the average age of the population of employees was 47. It came down. By the time I left 4 years later, it was around 42 or so, but still 42. In respect of this organization, their average age was below 30. With me joining, it became 31 probably, okay? So yeah, there were very, very many changes. And of course, if you're looking at the public sector way of doing things and the private sector way of doing things, it's very different. One thing that the private sector does is it tries to equate your performance with your incentive. The public sector has no such leeway. If once a person enters, unless there is a malafide, you can't get rid of them. So you have to really, spend your time and effort to understand where on earth can I fit this person in so that they will be productive. But those are lessons that I have taken into the private sector and I have benefited from it. It's not necessary to get rid of every person who's not performing. Just change their roles and look at them, they will perform. You have to understand what are their strengths. You play to people's strengths, not to their weaknesses. So there are ways and ways of doing these things. I will say that I have really benefited from being on both sides of the table. And by the way, there are a lot of myths about both sides of the table. Public sector doesn't work, myth. Private sector works like crazy, myth. So there are lots and lots of myths over there, okay, which need to be broken and need to be understood. In all of my time in State Bank of India, in spite of all the lunchtime jokes that you get to hear about State Bank of India, 40 years and 1 month, I never had one single day when I sat down for a proper lunch. My lunch was always at my desk while working. Here, in the private sector, if you look at my calendar, every day there is 1 hour that is strictly blocked for lunch. Now, whether I call anybody during that time and do some work is my option. But there's no meeting put over there. So there are a lot of myths about what we have in our mind as private sector and public sector. You need to understand both have their strengths, both have their weaknesses. But it's great to be able to see both sides of the table.
So many myths busted. A last question from me. You've written a book on notes on life and work. When is the next book coming?
I don't really know. I hope, it was COVID that enabled me to write that book. Because during the weekends, I had to have something, different from what I was doing otherwise. Otherwise, that would never have got written. I don't wish for another COVID, but I hope I will have time somewhere or the other in order to definitely pen that next book. Thank you.
Thank you so much. Thank you.
Thank you. Thank you, everyone. Thank you.
A big round of applause. Thank you so much, ma'am. May I please request for the mementos to be presented to Ms. Bhattacharya? What a beautiful addition this discussion has been to the repertoire of BFSI discussions. And what an inspiration Ms. Bhattacharya has been to everybody here, especially all the women members in the colleague and my colleagues present in the audience. And of course, Ms. Bhattacharya has very nicely, very succinctly put customer as the focus, the key area that everybody needs to work more on, not just in customer service, but as she rightly pointed out, customer literacy is an equally important area which perhaps needs much more attention, not just from the bankers, but also, as Ms. Bhattacharya correctly pointed out, from the regulators as well. With that, we will break for lunch, and we will gather here at in exactly an hour at 3 p.m. for our next fireside chat with RBI Deputy Governor, TB Ravi Sankar. Thank you. Have a nice lunch.
Adaptability to changes. portfolio. That was the first time an Indian insurer reached the
May I
world's
please request my
leading
colleagues to make sure that there's an announcement at the Ignite Square as well. Be the Deputy Governor of RBI, Mr. T.B. Ravi Sankar, and he is on his way to the hall. He has arrived at the venue. So I'm requesting the members of the audience to please be seated. You've been a very patient audience. And I'm sure this session is going to be as engaging as was the last one with Miss Bhattacharya, which I'm sure all of you enjoyed. And we are greatly looking forward to the session with the Deputy Governor RBI as well. It is an important session. May I please request all our guests to please come inside the hall. If you are in the area outside where the stalls are or in the lunch area, please proceed towards the hall and take your seats. Our guest is on the way and will be arriving here very soon now. Please put your hands together for Mr. T. Rabi Sankar, Deputy Governor, Reserve Bank of India. A very warm welcome to you, Mr. Sankar. It is my honor to extend a very warm welcome to the Deputy Governor of RBI, Mr. T. Rabi Sankar, to the 4th edition of Business Standards BFSI Summit 2025. May I please invite you on stage, Mr. Sankar, and also the Editor, Business Standard, Mr. Shailesh Dobhal, to welcome him.
Good afternoon, everyone. On behalf of Business Standard, I extend a very warm welcome to the Reserve Bank of India Deputy Governor, Mr. T. Rabi Sankar, on the second day of the Business Standard BFSI Insight Summit 2025. Mr. Sankar is a career central banker, joined RBI in 1990 and has worked in various positions. He was appointed as the Deputy Governor of the Reserve Bank of India in May 2021. Mr. Sankar is an MPhil in economics from the Jawaharlal Nehru University. Before his elevation to Deputy Governor, he served as Executive Director, overseeing the departments of Payments and Settlement System, Information Technology, Fintech, and Risk Monitoring. In these roles, he contributed significantly to strengthening India's financial system and infrastructure, particularly in areas related to digital payments, technology, and risk management. Mr. Sankar's expertise extends beyond RBI. He has worked as a consultant for the International Monetary Fund from 2005 to 2011, focusing on developing government bond markets and debt management strategies. Additionally, he is the chairman of the Indian Financial Technology and Allied Services and serves on the board of directors of the Reserve Bank, Information Technology, and the Governing Council of the Institute of Development and Research in Banking Technology. Known for his in-depth understanding of financial markets, Mr. Sankar has managed areas such as exchange rates, reserve portfolios, and public debt management. His role at the central bank has also included contributions to monetary operations and the development, regulation, and oversight of financial markets. Many thanks, Mr. Sankar, for joining us today. I may now invite and request Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard, to please come up on stage and start the fireside chat with Mr. Sankar. Over to you, Tamal. Thank you very much.
Very good afternoon, and the first show post-lunch with RBI Deputy Governor. And as Shailesh was telling, except for monetary policy and Department of Regulation and Supervision, almost everything is on his plate. Currency management, external investment, IT, payment, settlement, fintech, forex, everything. And when you talk about India's growth story, when you talk about taper tantrums and all, I think nobody could be in a better position than you to answer what all we want to know. Not answer, actually. I mean, certain curiosity we have, and on behalf of Indian Central Bank, I think is the right person. Thank you, sir. Welcome.
You're making me out as some sort of an odd job man. Probably I am. Yeah.
No? Anyway, so let's start with the external sector, because since yesterday you have been talking about this and all. So your new norm for external commercial borrowing and foreign exchange is liberalizing the foreign currency borrowing by Indian companies, removing the cost caps, widening eligible borrowers, lender, expanding end users. There are so many changes. Raising the borrowing limit you have done to 300% up, you have said that, no? That 1 billion or 300% of net worth, whichever is higher. Then all the end use also you are making a lot of complication. So is it like, are we sort of in a panic? So fast we are opening up so many things?
Yeah. First up, let me just clarify that there is no element of panic or anything, because this is not a short-term measure. If you look at Reserve Bank's stance on capital account convertibility, I think we have fairly consistently been saying that capital account convertibility is a process. it is not an event. It's not any 1 or 2 or 3 steps. So in this spirit, we have gradually been liberalizing capital account. You are in a situation today where, but for a few constraints like cost caps on ECBs or amount limits on ECBs, most of the inward remittances inward capital flows are by and large liberalized. What remains, a little more under control is how much can go outward. And that gels well with the state of development that our economy is in. Now, if you come to ECB, we have taken many steps. I mean, if you look at, one of the major things we did about 4 or 5 years back is we said that you can take any positions in the market for using derivatives as long as there is an underlying cash flow. You don't have to justify anything, suggest anything. So the process became very simple. Another step we took was hedging of your commodities. The process became very simple. Trade and trade flows have a capital account, connotation, because 1, capital account flows can come through trade flows. 2, you have trade credit and other things. Trade we are liberalizing. That is another thing we will liberalize substantially. So our process is liberalize your balance of payments, make foreign exchange transactions as smooth and as convenient as possible to the participants. So the steps we have taken in ECB, not taken, we are proposing to take because it's a draft, we will receive our suggestions, is to say that you see, most of the conditions that were there in ECB were to ensure that only financially strong entities will be able to go out and borrow. For example, you keep a cost cap. Why do you keep a cost cap? You keep a cost cap because if you don't have that, even very weak entities can go out and borrow at very high costs. That affects, if any one of them fails, that affects the cost for everyone else. That affects India's credit curve. To get the same, address the same risk, what we are trying to do now is link the amount that one can borrow to the total amount that a corporate can borrow, linked to your leverage. Linked to your leverage. So if you are borrowing, it doesn't matter. It's your choice as a corporate, borrow domestically, borrow abroad. But if you want to go and borrow abroad, then your leverage cannot be beyond a certain point.
300% of net worth.
Precisely. So once we have those, and all of them are up for discussion and so on. Once we have that in place, then we don't see the need for having a cost cap. We don't see the need for having a cap on how much amount you should be able to, go out and borrow. We have given some minimum because our system is used to a minimum of 750, so we gave some other minimum for that purpose. So that is the idea. The idea is not that there is something that we need to do today. The idea is today or something that we thought of today. The idea is that your capital account transaction should be gradually liberalized. This is just one step in that gradual process, which is decades long.
And what's the deadline like this? Now we're at the discussion stage, consulting stage.
It's a discussion stage. We'll wait for, because there's already a lot of discussion happening in the public space. We are receiving comments. We'll wait for all that. We'll look at it. We'll evaluate them. And accordingly, we'll issue. So maybe in the next, couple of months, we should be, out
now,
with it.
Just to extension of that, capital account convertibility, all the relaxation. And again, I repeat, the backdrop is the global uncertainties and all. So what are the things? Indian rupee is not fully convertible on capital account at this point of time. It's only partially convertible, right? Current account transactions like trades in goods and services are fully convertible, right? Capital account transaction like, say, investment in assets, they are subject to government limit and regulations. This is the broad contour and all. So what would be the next stage in terms of relaxations?
Same. Like I said, trade is by and large, entirely free. Anyone can do any trade. There is no control on it. There are only certain requirements about when you need to bring in your, if it's an export that it has to be repatriated within a certain time period of time, and such constraints. But we will come out with some draft suggestions on simplifying. We had actually come out already twice, sorry. We had actually come out twice. We will finally introduce those things. If you had seen those drafts, you would realize that we are simplifying these transactions so much that when we had more than 100 directives or directions that were there, now we will just have one comprehensive regulation. So anyone who wants to understand what, we just have to read that trade. So trade is happening, ECB is happening. We will look at other areas that might happen, but going forward, like I said, inflows of capital is our first priority. Then we'll look at export, or outflows of capital. We'll look at that broadly in that order.
Everybody wants to know that, we have been so many talk from every forum, from everybody, internationalization of Rupee. So actually what's happening? You have done something on the Vostro account, you have done certain fine tuning, but just for a layperson, can you explain to us, where are we? Is it only talk or something is happening?
It's like this, most of us are extremely impatient. So, we start a policy, we want to see the results immediately. The results that sometimes the steps you have to take might bear fruit, after a long time. You look at your digital payments, for example. We introduced two-factor authentication when? About 15 years back. But digital payments really picked up about 5 years back. So policy making at some level is also taking decisions, keeping the conditions ready so that when the right environment happens, then things really take off. So that is that is essentially what we are trying to do in internationalization of the rupee. You see, earlier I've been asked, are you trying to replace, the dollar or something? Absolutely not. We are rational people, reasonable people. We know what can be achieved. The objective of internationalization is again very simple. We believe two things. We believe that Indian economy, Indian businesses will have less risk if their global transactions can happen more and more in their own currency. This is true of every country. I'm just talking of India. Sure. That's number one. So an Indian exporter who transacts in, who can do his cross-border transactions, his exports, invoiced in rupees, would over the long run have a lot less currency risk on his balance sheet than otherwise. Yes. That's there. You see, it sounds a bit counterintuitive because people say, oh, now I'm earning in dollars, you are saying I should earn in rupees. But if you really think about it, it's good for Indian business. One of the reasons advanced economies are what they are because they can largely invoice in their own currencies. So their businesses don't have to deal with that risk as much. That's number one. Number two, I believe that in the international financial system, we in the Reserve Bank believe that one of the reasons a lot of crises happen and a lot of vulnerability exists in many countries, especially emerging and underdeveloped countries, is because there is an over-dependence on one or two or three currencies. So most of the currency crises happen because there is an over-dependence. If you had an international financial system where multiple currencies are used in global trade and global investment, the absence of any one currency is not going to create global instabilities, is not going to create even regional instabilities. So we believe that for a more stable global financial system, you should have an arrangement where multiple currencies play a global role, not one or a handful. So from both these points of view, we decided that we should now start promoting rupee as a currency that can be used for cross-border transactions. You must also appreciate that we want to be a developed country. We want to be a developed country in very short time. If you go by the length of time that takes other countries to get developed. We are the number 5 country now. We will probably within the next few years go to number 4 and further above that. Can you imagine a country which is developed among the, among some of the largest economies, I'm talking of just growth, but developed and some of the largest economies, when your currency is not commonly used or acceptable for global cross-border trades. That doesn't happen. So we have to build those things now. We have to start the process now. It takes a long time for exporters and importers and cross-border investors to change their mind, to change a currency, to change invoice patterns. But you have to create conditions so that people, actually the numbers are going up. Number of invoicing in rupees is going up, but it is still quite low. But we believe that if you create conditions, eventually you will reach a situation where people start doing them.
So 2147 by that time? Vikshit Bharat?
I expect to see better numbers much before that.
Okay, okay, sir. Okay. Tell us another, I'll not call it sore point, that CBDC. So much of talk, boss, but it's not going anywhere. Where is CBDC? And why should I why should I use CBDC? Because if I'm using UPI, the money used with my bank, I'm earning interest. But CBDC, I'm not earning interest. Yes. But you, with so much fanfare, you spoke about CBDC, then cross-border CBDC and all. But where is CBDC?
Yeah. You asked two questions. Yep. Where is CBDC? And why CBDC, right? You asked two questions.
Essentially, what I am saying very crudely, it has not taken off.
Yeah, no, I understand. So I'll address that issue first. You see, just the question before that was, we started internationalization of the rupee. Has it taken off? And the answer was that in policy making, you initiate a lot of things, not because they need to immediately take off, but you have to create conditions which will help things to take off. CBDC is another such, another such policy initiative. There are reasons why CBDCs are necessary. I will come to that later. Right now, what is happening is many countries, more than, I think, about 76 or some countries, are already experimenting with CBDC. China started a little while earlier, but we have also started some 2-3 years back. Our numbers are also increasing. Number of transactions are, I think about 10 crore transactions have already happened. There are a large number of CBDC account holders, merchants, everything is there. We do not want to rush, or what we have been calling a pilot since 2022, we do not want to launch it full scale for many reasons, but primarily for two reasons. One, that everyone in the, globally is just starting off different use cases. ECB, for example, is looking at wholesale CBDC use cases and so on. There is a lot of interest. They are starting that. But everyone is waiting to see what impact CBDC will have on the rest of the economy. You have to understand so that you can calibrate the way CBDC needs to be introduced. So everyone is, hastening slowly in the sense that everyone wants to know, I don't want to rush through. For example, should CBDCs have some sort of a cap, given the possible risk that they can replace bank deposits? Okay? So we don't know that. So we will have to do those things. So right from the beginning, it was clear in our minds. In fact, I've been talking at least for the last 2 years saying that we are in no hurry. We are in no hurry. It's something we introduced, right? Everything is ready. Technologically, we are by and large ready. Use cases, we are by and large ready, both retail and wholesale. Programmability, which is something that, that will distinguish CBDC from other payment instruments. UPI, for example, we said one, is something that we are trying out now. Programmability, we are trying it out for many government use cases, benefit transfers. For example, government wants to, give a loan which can only be used for acquiring, let's say, irrigation equipment. So government would be, would like to give this money to the farmer, and that money should only be used for irrigation equipment. In fact, we are running a project on that. Similarly, education loans. You want it to be used for buying books or paying a school or a university. So there's some programmability features going on there. So there are multiple programmable CBDC experiments we are trying on as part of that pilot. Again, even today, I just want to repeat that we are in no hurry. If you ask me 6 months down the line, I would probably still say that. If you want to launch, we can. We are ready, but we are in no hurry. We want to go slowly. That's the where part, where we are. We are progressing, but we are in no hurry to launch full scale. Why CBDC was the other question. You say I have UPI. Why do I need CBDC? One issue I partly answered was programmability. You have a lot of use cases which you can do with CBDC because it's a token. Because it's a token, program can be written on it. That's number one. Number two, one of the, in the payment space, domestically everyone is doing well. Most countries have fast payment systems. India's UPI is probably the best. But there are other countries also have them. Domestically, payment systems have really evolved. But in the cross-border space, there is absolutely no improvement as such. It still takes 4 to 5 days for retail transactions to settle. It still takes 6%, 5% for very small value transactions, the cost of transactions. Whereas in the domestic space, settlement is almost instantaneous. Cost is almost zero everywhere.
Free, yeah.
So we believe that CBDC, and our analysis suggests that you will not solve this problem by using bank money. To solve this problem, the best answer, by bank money, I mean transferring money from one bank to another. Because it has its requirement. Banks have their own costs. When you transfer money from my bank, me to someone sitting in the US, it has to go from my bank to that bank's correspondent bank to the receiver's bank through his correspondent bank. Everyone has a cost. So this cost cannot be reduced. Whereas if it is CBDC, there is no settlement, there is no risk. It can just be handed over. So cross-border space, the answer to the problem we have today, on which G20 and everyone else is sort of trying to settle that problem, the answer lies in CBDC. So, no fast payment system can solve that cost issue and time issue. So given these two things, we believe that CBDC has certain unique uses, like in the cross-border space, like in programmability, which cannot be settled by transfer of bank money. And therefore, CBDC has unique uses.
But you have to wait for that.
Well, we have to wait because the global narrative of token money is not very rigorous. Everyone talks about cryptocurrency, everyone talks about stable coins, but not enough discussion.
I just want to understand. Meanwhile, is there any change in your approach, RBI's approach to cryptocurrency? Because particularly when it's legalized now, of course, this is not cryptocurrency. The US, I'm talking about stable coin. So in that context, any change in your approach to cryptocurrency?
No. The simple answer is no, because our stance on cryptocurrencies, both unbacked cryptocurrencies and stable coins, is decided entirely by the way we have analyzed and looked at what the basic character of cryptocurrencies and what purposes they can serve. And the answer we reach, which we have been telling publicly for so many years now, the answer that, our analysis is that cryptocurrencies do not serve any purpose, cannot meet any use case. And I underline the fact any. I'm not using these words loosely. That existing forms of money cannot do better. Okay? So we, for example, feel that unbacked cryptos have no underlying cash flows, have no issuer, and therefore they are no one's liability, and therefore they have no value. It's a different matter. I mean, people are willing to buy things for large amounts, that's their choice. But our assessment is that unbacked cryptos have no value. They are, number one, not financial assets. That has not changed. As far as stable coins is concerned, yes, stable coins, because they are backed, the value of stable coins is not something that is in question. But the risks of stable coin to an economy, particularly an economy like emerging economy like India, is that it carries a huge risk of replacing your currency and your policy sovereignty.
So you have reservations about stablecoin, but not saying no to it.
We don't have reservations.
Okay.
We are very clear in our mind that stable coins do not serve a purpose, that cannot be done better with CBDC. Okay. And introducing stable coins would, not even on balance, would pretty much create a lot of policy concerns and issues that, that are best avoided.
You said it, sir. Now, just want to understand, I have a few more questions on other things important as well. Before that, there's a lot of confusion in that payment space, you know. Till now, so many years, for a decade, I think we are getting into the two-factor authentication. But now we have introduced an alternative authentication also, the OTP, you know. And it's more sophisticated than what it had been. And then the customers and all, there's a lot of confusion. Can you just simply explain to us what is the new system?
Actually, it is, strictly speaking, we probably didn't even need to issue a regulation because this is not something that was required. But what happened was that two-factor authentication pretty much resulted in, largely the use of, standard, simple ones like OTP, etc. They were the only ones being used. There were many other technological alternatives. As technology is improving, the authentication tools can also evolve, and the system should gradually move over to more sophisticated systems of alternatives. You see, you have a particular factor of authentication. There are fraudsters, there are bad actors who try and misuse that. So you'll have to evolve. We'll have to go over to new forms of authentication. Now, the system could have evolved on its own, but it did not. So we thought we will guide the system by saying that you need not just depend on OTP. OTP is fine. It can remain, it can be one of the factors of authentication. But we are not saying any factor of authentication is good or bad. We have just said that you can evolve new factors of authentication. We have given a framework to simplify things, that an authentication is something that a user has, that a user is or the user knows. So that, and we have said that the two factors of authentication will be in different categories. We have, for example, said that a compromise of one should not lead to compromise of the second one. We have said that one of the things can be a dynamic factor of authentication. These are largely by way of guidance so that the system evolves using the evolving technology.
There are many questions and the answer will be predictable, so I'm not going to ask you on Rupee, what is the Rupee level, because I know what is going to do and all, because we are doing activities both in sport and NDF and all. But one thing, I'll not call it a concern, but I'm drawing your attention, and because I know you don't go to bed without solving the crossword puzzle, New York crossword puzzle, that's your thing. So here it's a puzzle for all of us. Just explain to us, sir. In the foreign exchange reserves, we have been talking about this much and all, I'm not getting to the numbers and all. But RBI has churned a substantial portion of the foreign exchange reserves in the past few years. Basically, what happened is this, you are in the buy and sell figures and all. So you are selling it because it was in the old price, you are making tons of money out of that, buying it at a new price and all. And in the process, you are making tons of money. Who's the beneficiary? The government. You are giving the dividend. But I think we have reached a situation here, your ability to make money out of this will be restricted So which means your ability to give that much of dividend to government also will be impacted. Is that correct reading, or how do you sort this out?
What you're saying is factually not, one cannot question. You said that to the extent your ability to make money will change, the amount of surplus you transfer to the government will change. That's factually correct.
Change for lower.
I mean, lower or upper or
Yes.
whatever.
Yep.
You see, the point to keep in mind here is that yes, a central bank, if it makes more money, more will be, transferred as surplus. But a central bank does not function keeping surplus as one of its objectives. It happens in the normal course of its business. You see, all surplus transferred by any central bank anywhere in the world is basically seigniorage income, is largely seigniorage income. And seigniorage income, by definition, belongs to the people and therefore should go to the people, which in this case is the government. Money should go to the government to be spent on people. So that's perfectly fine. Whether going forward it will come down, I have no way of knowing, and I'm being very,
The logic, sir, I said, because you are a New York puzzle solver, so the logic is this: the old stock you have almost depleted, and the new buying at a higher cost.
Okay, that is just an accounting issue you are raising. We follow a standard accounting that others follow, which is that whatever is acquired, we reflect it in our books at the average cost of acquisition. And whatever is sold, we sell it by booking profit or loss against that average cost of acquisition.
Yes.
So, so strictly speaking, what you are worrying need not be a concern, because we have been buying historically. So the average cost is changing. It is going up with time, but it is also changing. So, so typically whenever we sell, if we are selling when the rupee is depreciating sharply, there will be a profit. If you are selling when the rupee is appreciating sharply, there will be a loss. Okay. So you can work out for yourself.
Okay, but you are more active in NDF market, right? Am I correct?
Let me not answer that. That's not an area I deal with.
Okay,
Yeah.
okay. Let's get back to other part is the bond market. You ask any bond dealer, and I'm not talking on their behalf that they have to cut their losses and all, not kind of thing and all. But the interest rate cut, the sharp cut that you had done, and of course then the reversal in stance and all kind of things and all. So this, at the longer end, I'm not getting into all the technicalities and all, but at the longer end, it has not, it's not percolated into their 10-year yield if you are looking about that and all. So it's not that, and there could be many reasons. One of the reasons is RBI is changing the stance neutral so that forward-looking market looks at and all. So what needs to be done? Essentially, what I am saying is this: the transmission has failed in the longer end. Am I correct in saying that, or
no? In fact, I would very strongly suggest that that is not the way to interpret the action that is happening in the bond markets. Sure. You see, all financial markets basically try to factor in their expectations into the prices, right? This is true of a stock market. This is true of bond market. This is true of money market. This is true of every market. So, if the bond market is expecting that the central bank going forward is going to hike rates, they are not going to wait until the central bank hikes rates and then raise bond yields, right? They are going to raise bond yields the moment, they are going to price that in well before the hike in rates. Similarly, if they expect that bond yields are going to go down, central bank might cut, they will reduce rate. Central bank action is one of the factors that they build into bond yields. There are many other factors. It depends on demand and supply for any reasons, regulatory reasons. Businesses might suddenly decide that because of global risk, let's move out of risky assets to bonds. That can be another thing. They factor in everything. Now, we are just looking at one factor of those, which is a major factor, undoubtedly, that what the central bank is doing and how it is pricing in. Now, you are saying that we did not price it in. A lot of that follows from this tendency to look at when the central bank started hiking rates, what was the bond yield then, what was the bond yield later, and what is happening now, right?
Yep. That's how it's. That's how we see.
But if you look at it, let me go from the cycle where we initially raised interest rates. Bond yields were at about 6%. And the peak they reached, if I remember the numbers right, they could be off a little bit, is roughly about 762 or something.
Yes,
right?
yes.
But when the Reserve Bank started hiking rates, the bond yields were already at 712 or something. They were not at 6%. They were already 712. They had already factored in. If you look at transmission, and if you look at where the yields were by the time the central bank stopped the hiking cycle, they were back to around the same levels. So you might feel that bond yields actually were not transmitting, but they were transmitting more effectively. They went up from 6 to 7 well before, and they adjusted because they thought the cycle is over, now we'll have to adjust. Similarly, in this cycle, if you look at that cycle, then bond yields, from above 7 had come down to 10-year had come down to about 620, right? Which is what, 80 to 90 basis points already. It is already there. It is factored in. Only thing is their timing doesn't coincide with policy action because they priced them in advance. So that is what it is. Now they must be pricing in this. But again, as I said, there are other factors which have played a role here. The demand from insurance is a bit soft now. That is something the bond markets price in. A lot of what happens in global interest rates is what they price in. So I do not think that given the information that we have, we can definitely not reach the conclusion that they are not pricing in effectively.
Fair enough.
I believe they are very efficient.
Fair enough. We have 4 minutes, so would you mind taking a few questions? I have one or two. Let's have 1 or 2 questions from the audience. Yeah, this gentleman raised hand first. Sir, first one, this one, just quickly, very, we are running out of time because I have 1 or 2 questions more important for economy and markets. If you would like to quickly, just
my name is
yourself.
Sanjay Shelke. I'm
Very
from
brief.
HDFC Bank. So my question is on currency management. In last 2 years, rupee is depreciated against dollar by 10%, but rupee depreciated against pound by 35-40%. But this depreciation is in nobody's discussion. So what measures you're taking against pound? So dollar to we know, and contrary, India is signing various free trade agreement with European Union. So please.
Thank you, sir. Rupee versus pound, nobody is bothering.
Yeah, I would just try to. Yeah, you're listening. Okay. You see, what you are looking at is the change in the exchange rate between two different pairs of currency, rupee dollar, and you are saying rupee sterling, that's the currency you use, but there is no rupee sterling market as such, right?
Rupee pound. Rupee pound.
Sterling
pound.
Yeah, pound sterling.
Yes.
But there is a market of dollar sterling. So what we are saying is that the impact on rupee pound is more than the impact of rupee dollar and dollar pound. Now, dollar pound is a separate market. Dollar rupee is a separate market. So rupee pound is just a price that you have derived from there. Let's not look at them as separate markets. This is just a combined effect of two different markets. What can anyone do? I think it is very clear. We let the market operate. We don't, our policy on markets is very clear that our market is deep enough and liquid enough to find a level for itself. We will only go in if the volatility is excessive. So the market knows all this. The market will price them in. Let the market price that in. Let the buyers and sellers in the market accordingly behave so that exchange rate, a market-determined exchange rate, will gradually evolve, and participants will adjust to that. If there is excessive volatility, of course, there can be, in such cases, there can be an intervention.
Just quickly, please.
Yes,
Very quick,
good afternoon.
very quick.
My name is Nimish, and the question is regarding full convertibility of Rupee. We've heard you said that Rupee has been fully liberalized in the inflow, but the outflow, there is a non-return wall. My question to you is, in our books, when is the condition right to make it fully convertible?
Okay, I think you have already answered.
Just a brief answer. I didn't say it is fully convertible, on the inflow side, but I said there is a lot less constraint. It is by and large open on the inflow side. But again, I said this is a process. You see, you look at the developmental stage of your country and you gradually take calls. You need investments, so you need inflows more than outflows. So you liberalize on the inflow side first, and then when your economy is strong enough, you liberalize on the outflow first. It's not one after the other, but the level of those liberalization will change. So that process goes on.
Quickly. Yes, gentlemen. Microphone is not working. Yes, please, quickly.
My name is Chaitanya. I am a founder of a company called Perceptive Analytics. My question is on the gold part of our reserves. I think it's about 12% or something, if my understanding is correct. Now that gold retains value over millennia, should we not think of a much higher percentage of our reserves to be gold?
Thank you. Gold part of the reserve.
Yeah, no, you see, we manage our reserves following, the usual portfolio management considerations. For a central bank reserve manager, these considerations are a little different from a private sector or an investment house. Our policies are that you put safety first, then liquidity, and finally you look at returns. So we manage as per that, and managing as per that also involves what should be your exposure to any particular currency. You need benchmarks, you need risk appetites for that. Gold, you can look at it as another currency for this purpose. So what should be your exposure to gold? So this is something, we have our internal benchmarks for various currencies and gold, and we follow those benchmarks.
Thank you. This is the last question. Unfortunately, we have completely run out of time. Last question, please.
Hello, sir. My name
Sorry.
is hello, sir. My name is Namra Doshi,
Quick.
and I want to ask a question regarding the US tariffs, because current RBI trend was 7.8% in the Q1. Sir, do you think that the tariffs might pose an impact on the Q2 results? And does RBI see tariff as a threat or as an opportunity to cater to the new markets? Thank you.
We just look at tariffs that exist in in international trade in every country is a fact that exporters and importers have to deal with. Whatever is the tariff, you see, a country is free to fix its own tariffs. The other countries which import tariff, the other countries which export to that country will then decide how to price it, and if it works out well for them, then they will start exporting to that country with tariffs. So we don't look at any tariffs as a threat or good or bad. It's there. We as a country will have to deal with it.
Thank you. So there's no more question. Time is already up. We have exceeded by a couple of minutes. Just one last question. I had too many, but this time was not permitting. In June, while cutting the interest rate, Reserve Bank of India also cut CRR by 1 full percentage point. And it was one of the rarest of rare occasions when the cut would take effect much later. So there are a lot of speculation, criticism, why it's been done, so on and so forth. Now that's in phases that got over, money is already coming and all, but now all of us are saying that there is problem with the liquidity, despite that cut, because of the elections are coming and the busy season. So probably the time for RBI to do OMO. Essentially, we need more liquidity in the system. 1% CRR cut is not enough. Is that the right approach? And whether RBI will do OMO or not, that's a separate story. But you can talk about that because liquidity is not part of the monetary policy. Sitting in your chair, you can talk about that also. It's up to you.
Like I said, I don't deal with this, so I can't give you that kind of an answer. But let me just tell you this, that we have publicly assured that liquidity will be provided to the system adequately. What the system wants will be, it will be made available. Economic activity will not suffer because of liquidity reasons. So I'm sure it will be done. CRR is one instrument, OMO is another instrument, but short-term liquidity, we have the lab framework.
Yes.
These frameworks would be used as and when we consider necessary to keep liquidity at a level where we think it's good for the economy.
Thank you, sir. Again, I don't want to summarize because everything is crystal clear. Whatever you said, you are extremely articulate. But beyond whatever we have asked, anything else you want to send a message as a central banker to this house? At this point of time, global uncertainties, whatever you call it, any message from the central bank
No,
to this house?
I really don't have a message. I might perhaps say just this much, that things are changing very fast globally. Not just in terms of geopolitics, but in terms of global financial systems, what with cryptocurrencies coming into the milieu, what with different international trade sort of setup evolving now. So it's always going to be a challenge for policymakers, but more importantly, it's going to be a challenge for any economy. The second thing that is happening is that technology is changing, and technology is mutating and evolving at such a fast rate. And we, not just we in India, but people, humans as a race, have not been used to that fast a change of technology, which has an, again, impact on the economy, on the way economic relations are established and carried out. I think we all, we as a country and globally, people need to be very aware of what's happening on the technology side, what's happening in terms of global, geopolitics and other economic policies, and be ready to act at very short notice. So the time given to us to react by technology and global developments is a lot short, which means the challenges are a lot higher. I think we need to be aware of those things, and change, because the way economy and society is evolving is going to change going forward. That is the only message I have.
Thank you, Mr. Ravi Shankar. Give him a big hand, please. Thank you, sir. Thank you.
Thank you, sir. May I please have the mementos on the stage for Mr. Sankar? Thank you so much for your time and for the insights you shared and all the questions from the audience as well. And thank you, Tamal, for that very journalistic inquiry, might I add. Some very important points that Mr. Sankar has made. New ECB norms are to be issued soon. On cryptocurrency also, it's a very interesting thing that Mr. Sankar said, that it doesn't necessarily serve any purpose, that current form of money cannot, and unbacked crypto has no value. And also his views on stable coins were very important too, as to how it can be a risk to sovereignty, and there is nothing that stable coins can do that CBDC can't. Of course, he clarified that CBDC is also a sort of a policy framework which has been laid down now so that we can reap its benefits in the future. We are now setting the stage for our next panel discussion. This is a subject that has come up often throughout our discussions today, and even yesterday when we were discussing the banking sector, and today the insurance sector. And finally, we are discussing this as our next panel discussion on cybersecurity. But let me share some statistics with you. This is according to the data by Home Ministry. Indians reported losses of over 23,000 crore to cyber financial frauds last year. The total cyber crimes reported on National Crime Reporting Portal alone witnessed a 42% increase last year. Therefore, our next panel discussion focuses on trust no one, verify everything, cybersecurity for the digital age. Let me start by inviting on stage my colleague Ajinkya Kawale, Senior Correspondent, who will conduct this panel discussion. And let me start by inviting our Panelists, our first guest, Mr. Malcolm Gomes, Chief Operating Officer at iDefy, where he leads the company's trust and privacy platform, Privy. May I invite on stage Mr. Mahavir Jindal, Chief Operations Officer at Amazon Pay India. Our next guest is Mr. Deep Narayan Mukherjee, Partner, BCG, with a wide range of risk management, with a wide range of expertise in risk management processes and tools across financial and non-financial risks. Over to you, Ajinkya.
Thank you, Ruchika. Thank you, everyone, for joining. Members of the audience, a very good afternoon to one and all. I really want to start by this panel discussion. Today, UPI, for example, has over 450 million unique users, unique transacting users, for example. And with the rise of people participating on UPI, we also saw a rise in frauds. And that is how largely, I think, cybersecurity has become a mainstream issue, to say the least. And even very recently, the RBI in its FSR report, they have also stated that there is a need for a zero trust approach and systems that are AI aware. And largely with that, I want to start my conversation. Zero trust now is being seen as essential, and regulators are also demanding operational transparency. How can security architecture beat or meet these often conflicting terms of you have to be operationally efficient also and transparent also from the piece of cybersecurity? Maybe we can start with Mr. Gomes.
No, thank you for having us here. Like I mentioned, I represent iDefy, and we believe, or we are on the mission to believe, to drive the fact that trust matters. I think I'll keep this short and would love to hear from the rest of the panelists as well. So I think this notion of zero trust has been around for a while. It started with the NIST in the US, and that thought process came from there. At this point, of course, regulators have not mandated it, but I think we've seen it sort of creep into the thought process of organizations. It's also a space that if you ask someone what is zero trust architecture, I think you'll get slightly different answers. It could span everything on how you've engineered and set up your systems. It could span how you integrate with third parties, how do you share data. It could span how employees and partners sort of use and consume it.
Right.
It could also span, for example, how you're monitoring transactions, right? So I think concept is sort of all pervasive in a bank or an enterprise across, in some sense, the value chain. That's at least how we think about it. I think it's gotten more, probably this place it has started to creep in more in that sense is probably on the technology side. It's easier to track, monitor, implement. For example, how do you integrate with third parties on the API side? Or even, for example, how is data processed and sent? I think this notion of encryption, anonymization, all of those creeping in. So I think there are, I think zero trust, very relevant. It can be interpreted in different forms and shapes of how to apply it in an enterprise. I think there's some areas where it's gaining sort of more traction and more currency. But would love to hear maybe other thoughts as well.
Mr. Jindal, how is the interpretation of zero trust, especially when it comes to the implementation of all the systems that are required to ensure cybersecurity?
So I think zero trust is not a new concept. If you're in a financial service business, you have to operate in a zero trust environment. What we believe is that the threat vectors are evolving at such a rapid scale that you need to keep your zero trust capabilities to a next level. And we at Amazon do it it's been absolutely paramount for us. How we do some of this is, for example, data. Now, any data exchange, be it with an external partner or with an internal partner, happens in a zero trust environment, which means there is an exchange of keys. Any data, be it static, be it in motion, is always encrypted in Amazon. Any authentication of an employee is again two-factor authenticated. Plus, there is, of course, a device control. Any customer authentication, again, operates in a zero trust environment. So zero trust to me is all pervasive. While I believe we are doing a decent job on that, but I'm worried about the pace at which the threats are evolving. So for example, we had a case where there was a video call through a deep fake and a couple of years back, and an entity was, lost $25 million. That's the kind of pace that we need to now evolve with. So I think while we have a good foundation, there is a long way to go to address the threat vectors emerging.
Mr. Mukherjee, your comments.
Yeah. So ZT or Zero Trust Architecture, as Mahavir has said, it has been for a long time. And just so that all of us are on the same page, and my two co-panelists has really mentioned that, but just so that all of us are on the same page, prior to ZT, a Zero Trust Architecture, the cybersecurity used to be perimeter dependent. So if a request or ping to an internal server was coming from outside the organization, so to say, there would be a requirement to validate, verify. Under Zero Trust Architecture, the core concept is doesn't matter whether you are an employee, whether you are off premises, outside of premises, whether you are a vendor, you would have to go to the same level of authentication and verification. So that's because what often happens is that in a cyber attack, the penetration starts through phishing, and when the malware is actually into the system, then it starts spreading. With a ZTA-like architecture, even if there is what is called an exfiltration, where an external entity using a malware has infiltrated your organization, if it starts moving out data, this would be stopped. It is a very, very essential, critical requirement. Obviously, there are trade-offs in speed of internal transactions, etc. But clearly, that's one of the best practices if one is serious about limiting the impact of a cyber attack.
Right. And also coming back to Mr. Gomes, largely there is always enough stress that is being put on, KYC, for example. And since you come from, the background of verification, of privacy, etc., I just want to get a sense of beyond KYC, what are, or even in addition to KYC, what are the other requirements or, processes that should stay in place when it comes to the security of infrastructure that companies would have?
Yeah, so I think the two parts to this, right? I think you talked about the KYC and that portion, and then there's an infrastructure portion. So maybe I'll cover the KYC piece. And I think I want to maybe make the connection to what Mahavir said. I think that process has been existing for a very long time. I think it's been beaten to death. But I think what we're seeing is some of these trends that we spoke about, right? Tampered documents, I think you might have read, interestingly, a few weeks back, a fully artificially generated passport went through full, I think a visa process or certain process, right? Completely artificially generated. So I think that's where the challenges are. To say there are either tampered documents.
You can use this.
Sorry about that. I think we had a, non-zero trust moment. Anyways, so tampering, deep fakes, impersonation, and again, we work across industries and use cases. Somebody applying on behalf of someone else, and a lot of those upstream, if not handled the right way, lead to then downstream challenges. Part of the mule issue, mis-selling issues, incorrect sort of product issues actually stem from a lot of these challenges up front. Right. So I think that's sort of where we are seeing this on the authentication validation side, the scenario evolve. I think people are getting smarter. It doesn't help that some of the AI tools are getting much more sophisticated, right? Because that's what people with sort of malified intentions are using. On the infrastructure side, which is a very different part and probably the different conversation altogether, I think what we're seeing is as with the anvil of the Data Protection Act, etc., right, how this customer data comes in, is stored, how it is passed on to employees, in what form is it retained, how is it shared with third parties. I think we're already beginning to see that changing in enterprises. So in terms of, when I know Mahavir alluded to it, so how many replicas of that data exist? Why does it exist? Or why does certain kind of data exist with employees in the first place? How is the data shared with third parties? It could be the card printing guy, it could be the contact center guy, the courier folks, right? Or frankly, collections agencies. How do you actually do a collection agency, if you take, for example, needs that information to eventually reach there. But after that task is done, how do you ensure that, for example, it is done away with, purged, right? And I think with hopefully the rules getting notified, some of that will get tackled. But we're seeing on the infrastructure side, technology and solutions emerging in that space to be able to handle, deal with, manage, and build sort of trust with personal data.
Right. And Mr. Jindal, you also alluded to investments when it comes to these cybersecurity areas. What could be the major sort of areas where more investments are required in 2025 and as we move in 2026? Again, from the perspective of a lot of these things, AI, deepfake, documents getting tampered with. What are the sort of major areas that more investments would be required to? And again, why?
Lots actually, because lots is happening. But I think what we are realizing is KYC is just a gating criteria and it's never going to be sufficient. So we need more tools which allow us to do continuous monitoring. So like things can change very rapidly. There could be sign-in pattern shift. There could be the way you're browsing your app. There could be shifts in that behavior. There could be shifts in demographics. So shifts in IP address from where traffic is coming from. So what we believe and what we want to do is from protecting our customer lens, we want to make sure that there is rapid investments in our ability to continuously monitor the account at risk and then protect the customers where we see that there is a threat emerging. On other areas that I would love to see investments on, and we are already making some of those choices, is on the risk which AI is creating. Now, I'll give you a very simple example. Let's say today, I'm very worried about a zero-click threat. So earlier, you would be aware of phishing, etc., where there was a customer action being involved. Now, what we are seeing is there is a emergence of tools and malwares where there is no customer action involved. And I'll give you an interesting example. Let's say you receive an email in your inbox and you have enabled Microsoft Copilot suite of products. Now, the Copilot suite of products has an ability to read an email and then act on that email. And you have provided agency to that. Now, a bad actor can embed a malware by creating a prompt inside that email, which is not visible to you because it's in white over white. But it's a prompt given to the AI engine to ignore everything else and do X, Y, Z, and again, exfiltrate all the data which you have. So we need to make sure that the output which our AI systems are generated, because everybody is using AI systems at scale now, is protecting the organization, and there are guardrails around that. So I'm worried about that as being another vector. Third, I'm very worried about my customers being frauded. And that's where we believe that passwords are passé. Passwords do not give any protection anymore. OTPs are being compromised at scale. So I think relying on a second factor authentication, which is agnostic or which is protected from man-in-the-middle attacks and driving adoption of that at scale amongst our customers is the third big priority for me. Yeah.
Right. Mr. Mukherjee, also, again, coming from the investment angle, and since you interact with a lot of these entities broadly, I just want to get some sense, what have been the learnings for the sector when it comes to investments in different areas, and have those been made over the past few years?
Yeah, so I think it's difficult to generalize. So there are a lot of Indian organizations which absolutely in letter and spirit give a high priority to cybersecurity. To that extent, they make what would be considered the correct investment in infrastructure, people, policies. But if one sort of moves out of that pocket of excellence, there is still a lot of scope. To the extent, this goes basically to the payoff profile. See, if I do not invest in cyber or do not invest it to the extent that is the bare minimum. If there is a compromise of my customer data in that unfortunate event, I per se do not lose a lot. Now, if I just focus, and let's assume that the governance standards are not that much of such organization. If I do a blind IRR NPV calculation that should I invest in cyber, the answer will be I should not invest in cyber because I do not face a downside.
Right.
So that's where regulators need to take a huge role and just penalize enough and sufficient amount to such instances so that it will nudge the calculation of such companies that it makes sense for them to invest in cyber, because if there's a data breach or there's another cyber incidents, they face a downside. Right. Of course, one should be balanced over here and not go to the other extreme of having a regulatory stringency that you have X% of your revenue where X is very high and it sort of destabilizes or can push the organization into bankruptcy. There should be a balance so that it nudges. Now that's what we are waiting for. Because if I have as we have seen in the evolution of data privacy rules in India, I think we had an initial version which was very stringent.
Correct.
Then after a lot of time, we did have a data privacy bill passed, but we are still waiting for the notification. Now, the on-ground implementation also needs to be happen.
Right. No, and in fact, again, coming from the DPDP perspective also, how do you see that completely evolve? You know, this cybersecurity space evolve based on the notification that comes up. Well, I understand it's yet to be implemented. On-ground implementation has to happen. How does that evolve for customers and for companies as well together?
So I would say Indian financial services customers are I would say relatively safer than other industries because of the banking regulator being there even before some of the rules and having really stringent asks on how the customer data can be used. So it is not that the customers are unprotected. Right. But let's sort of data breach, data privacy breach is just one aspect of cyber attack. The other is ransomware, which is not related to your customers. And there are enough and more instances globally in the last 2-3 months where non-customer centric organization or customers or organizations which do not have huge customer data, they're getting impacted by ransomware and their businesses being stalled. So cyber attacks are becoming multidimensional.
Right, right. And you know, as we also discuss the multidimensionality of these cyber attacks, there is this threat of AI, and there is this threat of, again, deep fakes. And I think the most weakest link at these points becomes the human link, wherein there also needs to be more focus on the customer awareness bit. As companies, as entities, what lies in terms of your responsibility towards at least awareness. Again, this comes from the non-technical side of things. Mr. Jindal, if you could help us understand.
So you're talking of awareness from a customer lens or infrastructure within the organization?
Both ways.
So customer awareness is not an easy one. I think all of us, I'm sure all of us have used AI tools on our desktops or on apps. I don't know how many of us would have really thought about what could be the risk of using it there. What is it that we are exposing ourselves to? So I think educating customers is going to be a long journey, but it's a journey that we need to start now. We are still at the base layer where we are talking customers on phishing, vishing, and how to prevent themselves against this. We're talking about two-factor authentication adoption. Some customers still don't do it. So to me, it's a long pole. But to mitigate the risk of AI, I don't think we have created a playbook internally as to what we want the customers to do to prevent that. As an enterprise, we have clarity. But as a customer-facing proposition, I don't think we have even scratched the surface there. So I admit we have a long way to go.
Right, right. But broadly, again, from that perspective, again, Mr. Gomes, if we have not scratched the surface to date, what more is required to sort of handle that AI challenge? Because again, this is at scale, this is on everyone's fingertips, and everyone is in many ways prone to deep fakes, problems coming out of AI.
Yeah, I think continuing on the customer side, I think I'm sure all of us keep receiving these emails, education emails. I think some people have gone a step ahead and sent videos. But I think that the point that Mahavir made is I'm not sure, while even all of us in this room probably receive it and understand it, I've heard of it, digital arrest scams or deepfake scams, and so on and so forth. I think the challenge is India, as we know, is there's in India 1 and 2 and 3 and 4, right? So maybe that caters to some fraction of the customers. There's some awareness with probably some subset. But there are highly vulnerable populations, right? There is the elderly, I would say young, semi-literate, perhaps people who do not fully understand mainstream languages. So there are highly vulnerable sections of the population who are not perhaps as savvy. So I think, I would say some of the basics have been done, but I think there could be a lot more done, for example, to reach out to people through perhaps different means, like video, WhatsApp channels. I think obviously everybody's doing their fair share. The RBI does, banks do. But I still feel that it has not got to perhaps the most vulnerable sections of society. People who, in some sense, either do not trust, do not understand, unable to get the ramifications of some of these things. And I think it's also where some of the more recent problems are. So if you look at the source of where a lot of the mule problems are, or some of the newer issues we've identified, it's really channeled or it's really affecting these more vulnerable parts of the population. So what would work? I think it's hard to say, but I think if there's a real movement and effort and time behind this, I think there could be a lot more to do.
Right. Just want to add to that. So at least our focus is not, while customer education is important, but our focus is to provide an environment to our customers to operate in a safe zone, in a trusted zone. So how do I make sure my product is simple and secure so that the least common denominator feels protected and safe? That would be my approach right now. That's what we are focused on.
Got it. And Mr. Mukherjee, as companies also build for scale, I'm pretty sure there will be some blind spots, again, in terms of the infrastructure that is being built out. How do you sort of provision for these blind spots since, once these breaches, come or do happen is only when they get detected? How do you sort of, again, coming back to provisioning for blind spots and understanding them better?
So, as any organization, there is like multiple competing priorities, and needless to say, cyber for most organizations is among the top priorities. But where it often sort of becomes a bit fuzzy is how much do I invest in cyber initiatives or cyber risk management initiatives, and how do I measure the outcome? Now, measuring the return on investment for cyber is complex and difficult. It is not that it is not possible, but measuring cyber risks should be a significant initiative that should be started. Otherwise, a lot of the things are either proactive, and a lot of dependence still remains on things like, and they should remain. It's not to say that firewall, customer sensitization, employee sensitization, but you should appreciate a lot of the major cyber attacks typically are from organized cyber hackers. Correct. Sometimes they are quasi-state actors. Right. So you have to match in sophistication to track the attacks when they are happening and to respond. On an average, a data breach is identified 250 plus days after it has happened. Right. And appreciate this data which is lost. We often feel, what do they do with that data? Right. They are not, using that data to call you on a Sunday afternoon, ke sir, ek real estate le lijiye. With 1,000 faked IDs, with 1,000 real IDs with name, date of birth, I can create millions of synthetic IDs and then ask for a digital loan. And some of them may actually slip through it. So the risk is much more structural, and it goes way beyond simply, and it should be done, but it goes way beyond awareness of the customers. We need serious cyber muscles in the organization, which goes beyond cyber reporting to actual, for lack of a better word, a cyber warfare.
Right. Mr. Gomes, your learnings from, any sort of blind spots that you may have encountered while scaling architecture.
Yeah, so I think at least if you were to ask where, and again, some of this may be obvious, but I think the real blind spots, I think, is definitely on the employee side, whether it is training, awareness, that's a real blind spot. It could be as simple as BYOD devices, printers, but anything at the front end, the front line, I think is a significant blind spot. I mean, we know attrition rates in organizations, we know people's awareness levels, but I think that's a definite weak spot, which therefore it comes back to the point is what controls what sort of, checks and balances you can put in place. So that's one. I think the second is, and when people eventually scan their full estate of technology assets, I think you'll realize there are all these backups and archives and, so quote unquote things not necessarily in live or in use right now. Shadow apps, these are things that have probably not been patched, not been updated for a long period of time, right? So this, if you look at the entire estate and somebody does a full sort of check, you'll find there are a lot of these sort of vulnerabilities sitting there. So that I think is the second blind spot that sort of we've come across. And the last, which I think is more pertinent now, especially with, privacy, etc., getting more critical, is your third parties. So you can, to the point Mr. Mukherjee made, you can invest internally, you can have the best team, you can put the best tools, you can build a fortress, right? But the point is you're operating in an ecosystem. You have a set of upstream partners, you have a set of downstream partners, we spoke about some of them. How do you secure that, right? An average bank works with tens of thousands or thousands of partners, right? How do you secure that? How do you know what passes to them? How do you know what they do with it? How do they know they have sort of purged or gotten rid of data once it's the purpose has been served, right? So I think working in this ecosystem and therefore being very careful about who do you onboard, actually assessing whether they have some of these capabilities, two, the way you engage with them, the contracts, the way you exchange data, and third, how do you monitor them, right? Because at the end of the day, and I think in several of the incidents in the past year, these have not actually happened in that organization. It has happened in external organizations. That's where the sort of the weak spots are. But I think these are the three blind spots in my view. The employee, I think parts of the estate that are sort of overseen, neglected, and I think third parties is my view.
Right. And before I open the floor for questions, one question for Mr. Jindal. From a payments perspective, today payments is regulated. You have sponsor banks who are again regulated. There are continuous audits that take place. Even in such a situation, what do you think are gaps that still need to be identified and fixed before they turn out to be, overblown disasters?
So I think what gaps that need to be fixed before they blow up, one threat, like I said earlier, is the threat of AI. We want to drive innovation, we want everybody to experiment, and yet we want to retain control and protect. So that's one thing which I think we need to do a little more better job. Second, on the employee piece, we want to provide all the access to employees. Like traditionally, if a bank would not even allow an external email or an internet access, we maintain that access because we want to provide a good working environment and yet protect our data. That's the second area which I would worry about a little, especially in the cyberspace. Third, like I said, I want to make sure that my ability to protect my customers while retaining convenience is going to be a third pillar for me to invest behind.
Got it. Any questions? Yeah, please. Please identify yourself.
Myself, Vikas Pandit Rao. My question is to Mr. Malcolm and Mr. Jindal. First to Mr. Malcolm, can you tell us, because you have worked in McKinsey as well, can you tell us between fintech and bank, who is better prepared to handle cybersecurity and KYC? Suppose there is a hack which happens, which industry is better prepared? And second question is to Mr. Jindal, are you thinking in your organization a probability of a complete blackout of payment systems for say 10 days. And in that scenario, because today, I can create a photo in this panel sitting next to you and circulate to anyone. Okay, I can clone any one of your voice and show that, whatever I want to do that. I can have videos created. So the KYC, the fundamental KYC layer can be easily hacked by anyone using simple AI tools which are available to general. So the risks are phenomenal. So from that perspective, these are the two questions.
I think on your second point, how we prevent that is exactly what we do. But I'll let I'll let Mahavir answer that. But to your first question, I think I think the way I look at it is a bank has a much larger surface area of risk and attack. Smaller, perhaps player has a much smaller, I think, reason, surface area. At the end of the day, if you think about what someone is looking to attack, they're looking to get something out of it, right? Like, why would you attack someone? And therefore, I think the natural sort of immediate, I would say, target are usually banks, because I think there are many more reasons, points, areas, and it's just a much larger surface area to attack. And maybe a smaller fintech, an LSP, or a credit card provider, whoever it may be, probably less of a reason to attack. And also there are many very controlled businesses, very defined value chains. So I think each of them has to, therefore, to the point I think Mr. Mukherjee made, invest differentially. A bank has to invest much more in terms of people, capabilities, technology, processes. A smaller organization will have to invest obviously lesser proportionately. From whatever I've seen, I think both sets of folks are gearing towards this, right? It's not like somebody is, are they commensurate? That we can debate, right? I think I would say on both sides, everybody's made, I would say, base investments, base level of efforts. But are they, to the point Mr. Mukherjee made, are they really fully geared up? I would argue probably on both sides, they are not.
On KYC and the vulnerabilities with the coming age creates a very valid point. But just like bad actors are using AI, we are also using AI to detect the bad actors. So for example, in case you try to do your KYC and you have a simulated image using deep fakes, we also have AI and algorithms which help us with a certain level of probability, whether this is the right customer or this is a fake image. So it's a cat and mouse game. So you keep running to an extent to stand still, but yeah, that's the lever we have. But like I said, KYC is not the only control we have. You need to have an arsenal of controls to make sure that you protect your customers. So this is the gate, but you need to have post-gate monitoring, which is more continuous. I hope I've answered your question.
Any more questions?
Yeah. So on the blackout piece, when you say you blackout means there is no ecosystem available for a customer to operate. And how do you make sure in that scenario the customer is protected? So if the ecosystem itself is not available, which means no merchants, there's nothing that can happen. So I don't think we are planning for a catastrophe where India goes or India is not available. When we design our disaster recovery, we make sure that there are plans which protect our infrastructure, which protect our data, which ensure availability for us, which make sure there is a people loss plan. But if the entire country goes down, I don't know whether there will be a customer left to interact also, or there will be a merchant left to accept the payments. So, but what we do make sure is, when it comes back, we are there immediately.
If I may just take a 30 seconds. See, I think the question you are asking is a topic called operational resilience and tech resilience, and that's a different discussion. But for whatever it's worth, a lot of large organizations have operational and tech resilience plan to handle such 1 in a billion event of what if the whole electricity grid is down for one day. So that's a different thing altogether. And large essential services more often than not have these disaster scenarios in plan. But it's a different discussion.
Just to add, for example, if the entire electricity is down, we have generator backup, primary, secondary. We have fuel, which can last us for at least 72 hours. We have back-to-back contracts on top of that, which provide further assurance and standby generators. So we have multiple layers of redundancy. But if the entire country is out, to what extent will it work?
Right. Mic there, please, behind.
The question here.
Good afternoon, everyone. I'm Prachiti. I'm from Sydenham College of MSc Finance batch. And I wanted to ask, being a consumer, being a customer, and from a non-tech background, what things we should take care of for not falling prey for these frauds or any such scams?
Okay. So firstly, first and foremost, I'm sure you have used, you must be using multiple online sites and apps. And I'm pretty sure you would be having similar passwords being replicated. And I'm sure your password would have a predictable logic. So first advice I would give you is to make sure that you don't rely on passwords alone. Adopt a second factor of authentication, which gives you that layer of protection. Don't do that. For your core financial apps, separate the passwords. That would be my first advice. Second is phishing, wishing is a very, very prominent scenario. So don't click on unknown links. Don't click on files which get forwarded to you in WhatsApp with APKs. There are lots of training I can give you, maybe separately. But yeah, protect yourself is going to be very important by making yourself aware of what the modus operandis are. In addition to that, think about what you're revealing about yourself online, because everything is available for everybody to consume. And with the models, I can build a persona, I can tell you where you went for vacation, I can spoof a call with your dad and get money. So make sure you're careful about what you expose about yourself online. These are the 3 tips, but there's a long list I can take you through separately.
Thank you, everyone. Thank you so much. With that, I think we are running out of time. My major highlights from the discussion are cybersecurity remains at the core, and even as you sort of provision for these blind spots, you need to continuously keep investing to sort of avoid any cyber breaches, any cyber disasters. Thank you so much for joining us today. Thank you.
Thank you.
Thank you.
Thank you to all the panelists. Mr. Jindal, you should probably share that list for the good of everybody. Through, this was the first time in a session that we heard about risks that go beyond customer action. And therefore, the risk is really serious and alarming. And we all need to be better educated, better aware. And some very important points that have been made is KYC alone will not be sufficient. Continuous monitoring is required to protect customers and their account. And of course, the zero-click threat seems real. And guardrails need to be built around AI. Password and OTP are passé. We need to think of 2-factor authentication, and we all need to protect ourselves. As we're doing the group picture and handing out the mementos, I'd just like to make one announcement that as I had promised you earlier, that you will get sufficient time to explore the stalls outside. It's a 30,000 square feet area with a lot of things to see, explore. For those of you who have those little passports, if you want to collect your stickers, now is the time. We'll take a break, a longish break, but we assemble back here at 5:20 for our discussion, panel discussion on private equity and VC funds. So take a break, enjoy, explore, but please be back here sharp by 5:20. Thank you so much. Hello, ladies and gentlemen. The panelists have arrived at the venue and they are going to be with us shortly. I request all those standing in the back to please take their seats and those sitting at the back of the hall to please move forward for a better view, for a better audio, and for better engagement. May I please request you to move forward and sit in the seats in front? And all those who are outside still at the stalls, please come back to the hall. This is the last panel discussion of the day in this hall. There is a parallel session going on in the hall on a level below. We've covered quite a lot of area today, and between yesterday and today, of course, there is so much content that has come through, so many ideas, and I'm sure it has been very enriching for all our audience members as well. This session is also quite unique because this is the first session we will have the private equity and venture capitalist firms taking part in the discussion and addressing the concern that we all as journalists also keep asking PE funds, that why are they sitting on so much unutilized capital? Hopefully we will get some interesting answers. Our panelists are arriving now. India's private credit market has been growing. Major global investors, however, have remained cautious. And a lot of reasons are often given for this cautiousness, whether it is that the deal sizes are very small, the IBC ecosystem to resolve debts is still very complex, the reduced dollar-denominated returns. There are a lot of reasons. And we will find out much more from an very, very esteemed panel that has gathered here today. For our next panel discussion, dry powder versus deployment challenges. Are PE funds sitting on too much unutilized capital? Let me start by inviting on stage Business Standards Executive Editor, Ms. Nivedita Mukherjee, who will be moderating the session. And our first panelist, Mr. Hari Gopalakrishnan, Partner, Head of India and Co-Head of Services at Swedish private equity major EQT. A very warm welcome to you, Mr. Gopalakrishnan. Please welcome on stage Mr. Abhishek Kabra, Partner at Samara Capital, where he plays a pivotal role in the firm's operations and investment strategy. A big round of applause, please, for Mr. Kabra and Mr. Gopalakrishnan. Our next panelist, Mr. Manish Kejriwal, Managing Partner and founder of Kedara Capital, a leading private equity firm focused on control and minority investments in India. Audience, come on. A big round of applause. Don't lose energy now. Our last panelist, Mr. Sanjay Nair, Chairman and founder of Soren Investment Fund. Okay, sorry. Mr. Nair is not joining us, so that is our panel. Thank you. May I now invite on stage our last panelist, Mr. Gopal Jain of Gaji Capital. I think it is Gaja Capital, I'm sorry.
Good evening, everyone. And a very warm welcome to all of you. Ps are making headlines every day, but this group of people that we have here, they will decode for us the India story and what makes Ps the big headline makers. Yeah, I'll start with you, Hari. Can you just decode the India story for us, Ps? What has changed for India? Why are they making headlines? No, there is a mic here. There is a mic here.
Yeah, thanks, Nivedita. I would start by saying that private equity has been in India for more than 25 years now, and it's it's one of our biggest contributors to foreign direct investment as well, and creates so many jobs. For private equity specifically, India is underpenetrated. India is the fastest growing large economy in the world for the past 3 years. And we expect India to be a driver for demand globally for private equity. So we still think it is many years of growth for private equity in India.
Mr. Gopal Jain, I'll come to you next. You are making headlines for a different reason. I know you are in a silent period, but what does the PE scene look like for India without mentioning your company IPO specifics?
Well, thank you. For many years, India has been the fastest growing alternative market in the world. But that's also because we're starting from a small base. And private equity, as Hari said, in India, punches way below its weight. But I think we have enough data. We have a strong trend to show that private equity in India is on its way towards becoming a mainstream sector. So just as banks are mainstream, insurance is mainstream, mutual funds is mainstream, we have $2.5 trillion of bank deposits in India. By comparison, private equity in AIF is a small fraction, but now we can see how private equity, venture capital, we use this term alternatives, are on their way towards becoming a mainstream sector. And the second big aspect of this story is the emergence of domestic capital pools. So yes, private equity is a US product. It's been exported successfully by the US to all over the world. It works in large economies. India is now a large economy. Every large economy basically sources its capital from its domestic economy. And we can see that the next phase of growth, the mainstreaming of Indian private equity, will be on the back of the emergence of domestic capital pools, which is how we connect our domestic savings ecosystem to private equity, venture capital alternatives. Thank you.
Abhishek from Samara Capital, mainstreaming of the PE sector, do you agree that it is come into mainstream from being a niche sector earlier in India? Are we coming of age?
Yeah, I would tend to agree that if you look at globally, across 25 years, private equity as a global private equity pool has outperformed the public markets by 6.7% if you look at 10-year rolling returns. So it's a proven form of making investments, parking capital and generating returns out of it. And that's at a global level. In the last 4 years, we've seen 3 years where $2 trillion were invested in a given year. So it is certainly mainstream when it comes to the global level. In India also, what we are seeing is that the number of deal flows have started to go up. There is a very vibrant ecosystem, which Gopal also highlighted, that there is domestic pool of capital that is now being made available to the AIFs and fund managers in India. Just to put this in context, if you look at ultra HNIs and family offices whose wealth is getting managed by wealth managers, just about 7 to 8% of the allocation, as per an Avendus report, is towards AIFs. And the report itself predicts that it will go up to 15 to 16%. So it's not just the ultra HNI pool of capital that will go up, but the percentage allocation towards AIFs will go up. And for anything to become mainstream, fundraising is, the first port of call that, can you raise funds? Can you generate, enough capital that can be invested? The second part is the deals itself. Are there enough deals that are happening? And so if you look at, again, whether it is the VC ecosystem, which is very vibrant because of artificial intelligence related themes, there is, EV related themes, a lot of innovation that the government is also encouraging. And on the other side, there is growth capital and buyouts, which are also taking prominence. So there is a lot of deal flow that is also available. And the last thing is exits. So to complete the entire ecosystem, you also need a vibrant exit mechanism. So traditionally, we've had IPOs, which remain as buoyant, at least for the last 2-3 years. We've seen that consistently. There are domestic M&As that have become more prominent. There are new pools of exit with secondaries fund that are coming into play. There is an SME IPO that people can opt for. And as more capital gets raised by alternate investment funds, there is a financial sponsor to sponsor exit that one can look at. So if I look at fundraising, deal flow, as well as exit, that completes the entire ecosystem. And India is really headed in that direction where we will see record deal flow, capital getting raised, and exits also being availed.
I'll come to you, Manish Kejriwal of Kedara. Do you think India is in a sweet spot as far as the PE sector is concerned? And how long will the good times continue?
Well, I think from our perspective, it better continue forever because we don't know how to do anything else. But on a more serious note, first, thanks for all having us here. It's great to be back on this panel. But I'll say, so far, the reason why it's in a sweet spot, you've got the GP perspective so far, but you've got to look at the industry a little bit more broadly. The reason, I think Abhishek touched on this, there's a term called DPI, which most of us didn't know what the word meant 15 years ago. India was very good at attracting capital around circa 2010. We almost didn't have returns to our LPs. And that's what gave the country and private equity a bad name for most of the middle of the last decade. That has fundamentally changed. The IPO markets obviously are a very important component, but to what Abhishek said, we have sponsor-to-sponsor sales. We just, in the process of selling a few companies, we sold a housing finance company to a firm called CBDC. We sold Manjushri to Advent. We've taken 9 companies public. So it's a very robust exit market, and unless you return capital to your LPs, they're not going to reinvest it back in India. So that is a fundamental change that's happened, I would say, in the last 10 years. And the IPO markets also have a big role to play. But the other, if you step back, Namita, the real driver, making these minority investments we used to always do, and we will continue doing it. That is a large component of what all of us do. But the other big change in India, which is, you can look at it positively or negatively, depending on which side of the coin you're looking at. Many of the writers in your newspapers, take umbrage at the fact that the next generation are managing family offices. We have lots of articles by Uday and Harsh and all that on that. One of them owns your newspaper. But for us, the fact that selling your companies is no longer a mark of shame, but is widely accepted, is phenomenal. And that actually, if you talk to each of us, has been the real reason why many of us have managed to do controlled transactions. The ease or the acceptance of that truly drives the number of companies out there which we can take large stakes in, and increasingly many of us are taking controlling. We also do minority, but increasingly, if you're putting in all this effort, you want to take as large a stake as possible. So the fact that there are increasingly a number of families who believe that selling out to PE is the best way to maintain the family wealth and encourage them to do other things, including running a family office, at least from our perspective, nothing to be ashamed of. So those to me are fundamental drivers. The second one, even more important, I mean, we've started, I really think, I wasn't joking, we're at the top, really the top of the iceberg in a sense, in terms of what we've done so far. And most of us, our investments are Bombay, Gurgaon, Bangalore, maybe 20% outside of 3 cities. There is an incredible amount. I mean, India is a country of entrepreneurs. So whether we're supporting them to grow in minority deals or taking on ownership from them to sell to somebody else, we're at the very, very start. I would say we're a cottage industry right now, and the best years are yet to come.
Thanks, Manish. Coming back to you, Hari, how do you think the India market is behaving vis-a-vis the global market in terms of PE and VC? Is there any difference, or are they in sync?
I would say that, as Gopal mentioned, we're starting off on a low base, which means that we've had many years of growth. And as Manish said, the market has also shifted to buyouts. I remember when we did our first buyout in 2013, it was only 20% of the overall market. Today, buyouts are 50% of the overall market. And with the size of the economy growing and more families open to succession, both the overall pool will increase and the proportion of buyouts will increase. So we feel that both of them will rise. And with all the challenges in the rest of the world, there is more attention to Asia and India. If you look at Asia again, India is one of the fastest growing countries in Asia. And so global investors are looking more to Asia for growth. And within Asia, India is a bright spot. So incrementally, I would expect India to grow ahead of everybody else. But it's also of a small base, and it's also accompanied by a shift to buyouts. So I would absolutely say that on a percentage basis, India will grow much more than other markets for PE.
Gopal, I'll come to you. Do you think there's greater confidence in the India market? How do you look at India as a destination market for PEs?
Well, Indians have been optimistic and excited about India for a long time. But sometimes the answers to very complex questions are very simple. Private equity works in large economies, period. It works in large and sophisticated economies, period. India, until now, recently was neither large nor sophisticated. Thank God we are now a large economy. So actually the term global is a misnomer. India is the 5th largest economy on the planet. The other 4 large areas, which is US, Japan, the Euro area, and China, essentially account for 90 to 95% of global private equity. Now that India is a large market, and with large markets come a large economy, a large IPO market, large supply of entrepreneurs, large consumption base, all of that, private equity is set to grow and catch up to where it should be in the economy. So as I said previously, in India, private equity punches below its weight because private equity worked only in part for the last 30 years. Last 5 or 6 years, it started to work better, started to produce returns. The machine is working. As Manish said, we're no longer just investing, we're also exiting. Earlier, we only had growth minority. As Hari said, we now have buyouts. We now have venture capital. We have all kinds of products. And as we become a larger and larger economy, as we become a more sophisticated economy, and being a large economy is very rare. The last time somebody broke into the ranks of a top 5 economy was 15 years ago, when China broke into the ranks of the top 5. So it's a global event, and with that comes this private equity surge, this private equity efficiency. It is here to stay. For as long as we can stay a large economy, a globally relevant economy, and a rapidly growing economy.
Abhishek, carrying on from there, do you think any further reforms are required to make it even more vibrant for PEs and VCs? Do you expect anything?
Well, as industry, we will always encourage more pools of capital coming our way. Just to give again some data, there are global institutions like insurance companies, pension funds, endowment funds, who invest roughly about 13 to 14% of the capital that is available to them in private equity instruments. And that's, this is the global number. So for evolved geographies like US, the number is much higher. Unfortunately, in India, there is still a lot to be accomplished in this. I think there are very few institutions who are actively seeking investments into AIFs. Not anything against them. They've had their own set of experience because as any industry evolves, as was being pointed out by Manish as well, the industry struggled initially for exits. There were also pools of capital which could not sustain and create a franchise. Now that this industry has reached some sort of stability, we will see some established franchises who will keep coming to the markets on a regular basis. And that is where certain institutions who are currently not active, we would expect them to become more active. And any encouragement from the government towards that can go a long way in terms of solving for that pool of capital that, as I said, is the most important thing before anything we can go ahead. Nothing to complain in terms of deal flow mechanics, in terms of we have access to almost every industry. In fact, as private equity, we have access to some of the most emerging sectors that we can hope for through the VC ecosystem. There are, through AIF mechanisms, we are treated as domestic pool of capital. So again, there are no restrictions when it comes to FPI. So deal making is something that is anyways happening. I think it's rather, the fundraising aspect, which I would encourage the government to look into and create a more proper framework around it.
Manish, I'll ask you about the sectors which are doing very well vis-a-vis Ps, and are there any new sectors that you're seeing in this sphere, where Ps are getting attracted?
No, but I think if you look at all our portfolios, in India, typically there are 4 broad sectors. At least as Kedara, we've historically focused a lot on financial services, initially in lending companies, now increasingly insurance, asset management, so many sub-verticals within the broader one. But financial services, I've always believed, whether it was at Kedara, before that at Temasek, it's the best proxy for the growth of a certain industry. It's also a very well-regulated industry in India. So that's always been our largest area of focus. We've also done a lot in consumer, whether it's consumer or consumer tech, companies like Lenskart, which we're IPOing tomorrow, Vishal, Megamart, Manyavar, are all companies that we were invested in, added, I believe, grew them a lot. And then the 2 other sectors have been healthcare and healthcare services, and then technology and tech services. Very often, people in this group will have a 5th one called industrials. In us, industrials is either a proxy for consumer or healthcare or so. So we don't have a separate one, but those are the 5. I think the big wave affecting every sector is both digitization and AI. I mean, I cringe when I hear the word AI because, it seems like the whole world supports. So I don't think India will ever be, at least we want to invest in the what's going on in the valley with huge billions of dollars going into a single company with doing LLMs. What we have decided to do, because we fundamentally don't understand and we don't believe we're on top of the game on what's happening in AI, being so far away from the center. So we've always believed in investing in the shovels rather than in the gold mine. So we don't think we're smart enough to predict what's going to happen in the future in terms of a product. But very simplistically, we know in order for normal companies to adapt to AI, they need to get their data, for example, well structured. So we've taken, after paying $300 million, almost $300 million, a controlling stake in a company called Impetus as an example, which basically does data structuring, right? So it's a services business. It goes to companies in healthcare or financial services, so sector agnostic, but it's a horizontal to help in that. So I do think, and also the whole digitization space, moving from bricks and mortar onto online, how the revenue model of a Manyavar or a Lenskart has completely changed from what was online, from what was brick and mortar stores to online, and how do you do the interplay between each other to maximize revenue? So I think the historical verticals are quite similar. I think time will tell how the AI mania affects India. We're still sort of a wave behind. At least for us, we've said we're too far from the center of the action, so we'd rather be playing on the shovels. But I do think at the end of the day, as I was telling someone yesterday, the sectors, you have to be very thoughtful at a certain time, because it's just not what is a good sector. It's the right sector at the right valuation. So today, if you look at the consumer space, extremely high valuations. So, you know, you would rather, and if you do a company in a high valuation, your degrees of freedom are much more restricted, right? So how you play it is not exactly a science, it's an art. And then what you really need to succeed with is not, you can't be smart in everything. You've got to be able to build a team which is, I would say, empowered enough to make the decisions, because the historical perception of private equity were these great giant leaders in every firm. The reality today is the Blackstone may have a Schwartzman or a John Gray, but the real work is done by 40 other thought leaders. And for each of us, the challenge is to build our next generation of leaders who can take on what we started doing and be able to adapt to areas and new developments where we might be dinosaurs.
Manish, since you mentioned AI, I'll ask you the next question. You are saying we are not at the center of things. India is not at this point. But how long can you stay away from AI? Is that something that's bothering the PE players at this point when the world is going somewhere else?
No, not at all. In fact, I think when there are manias like this, the best thing to do is go to sleep and wake up after 2 years and you'll be fine. I'm joking, but I'm saying, how does AI, I'm not actually worried about missing the next wave of investments in AI. We'll never get that. I mean, there are leading firms in the valley who should be grabbing that. It's more VC-esque than private equity. We wouldn't take the sort of business risk that VC guys do. We can't afford to take losses. They can. They can also get companies to give you a 30 or a 40 or a 100x. That's not what we play. We don't understand that space. So we're not insecure about that at all. For us on AI, the more bigger worry is, how will our portfolio companies be affected? Are we sure that the cost structure that we have in a, let's say, tech services company remains relevant when AI can wipe off half your cost and half your revenues? So our immediate focus is to protect the portfolio rather than worry about what new investments you might be missing or not missing. So, and actually in that case, we've been learning more. One of our companies, Purple, has done a great job in adopting AI. And we've taken their learnings to other portfolio companies. The answers won't always come for us. Then the second degree question is, as a private equity firm, what are you doing to adopt AI into your decision processes? And that we're doing a whole bunch of stuff also. But am I worried that we're missing the next phase? No, because, you know, frankly, 90% of those, you will not, it's like the dot-com boom, right? There will be a bust, and there will be some who will be great winners. But we aren't, what's the word? We're not taking risks here, or we'll continue doing what we know well, and we'd rather do the services around AI than the big bank's product itself.
Abhishek, do you agree with what Manish is saying, or do you have a different view on whether to use AI in your services and in your functions and investing in AI differently, as in?
Look, I think we are all coming from the same breed, which is, private equity, which is looking for either buyouts or, larger deals which are profitable in nature. So the ecosystem of AI that is getting built around chip manufacturing, LLMs, which is loss-making, is not something that, we can support. In fact, even VCs in India will not be able to support because we are talking billions of dollars of investments. So that's happening in the Silicon Valley and, in China. But the way we see it is, ultimately, this is an intelligence revolution that is taking shape. And there will be what we call as electrification sand and math would be at play. So, when I say electrification, people are talking about electricity generation, how to power this entire, computing ecosystem. So there's a lot of investments that is going there. Then there is, the sand, which is, the chip manufacturing that is happening. And then there is math, which is, the LLM where people are. I think these are all the basic foundation that one needs to get right over a period of time, which is, again, drawing a parallel with, the internet ecosystem. A lot of, cables that were laid out and, in order to make, broadband available, in order to make the infrastructure available. Our view is that ultimately this infrastructure is going to get commoditized because the governments across economies would want everyone to have access to these AI applications, just like how internet and broadband is. I think what is important is to focus on the intelligence that is going to move on this particular scientific innovation and infrastructure creation that will happen. So again, taking from the internet boom, ultimately it is not Cisco's of the world or the IBMs who have made money. It is actually the likes of Google, Netflix, who used that innovation and applied that for their business model. So the way we are going to focus on is that how do we look at the second, third order derivatives of this entire AI ecosystem, where they are using this intelligence to power their business. There could be native companies that can come from the VC ecosystem, but there would also be established and emerging companies which are going to embrace this entire AI in a very material way, as well as to create moat. So let's call it EM square, which is embracing materially as well as to create a moat. And those are the companies that we believe are backable, and that is what we would be chasing, not just to make sure our portfolio companies are up and running on that, but wherever we believe we can power that.
Gopal, intelligence ecosystem and AI in Ps, what are your thoughts?
Until very recently, India was not even an entrepreneurial economy. We are now a highly entrepreneurial economy. We are on our way towards becoming an innovation economy, but we are not yet an innovation economy. AI is another example where we are behind the curve as a nation, as a society, as an economy. But historically, we have always done a good job of catching up. Right? You have a telecom background. Right? None of those telecom innovations came from India, but India is a great place for application of some of the best telecom technologies in the world. Again, when it comes to .com, very little of .com came from India, but we did a good job of leveraging those technologies. And when we're talking of .com, which second 2 or 3 generations later we all refer to as digitization, today I don't think we'll invest in a business which is not leveraging digital technologies, right? So I think we are 2 or 3 years away from saying that it'll be difficult for us to look at businesses that are not leveraging AI technologies. India will do a good job at the application, solutions, services layer. When it comes to models, etc., it's a highly CapEx intensive world. Huge amounts of CapEx. And in the US also, this CapEx is not really coming from venture capital and private equity. 80% of this CapEx is coming from corporate America, the large technology companies that have hundreds of billions of dollars on their balance sheet, maybe trillions. We don't have that tech sector here. In China, where model work is happening, this large amount of capital is coming from the government's balance sheet. We've made a start in India in models. I think Bharat Gen AI is a wonderful start. We've allocated $1 billion to it. We are closely following what's happening. Many people, I went to a college which had lots of smart people. So, if you're not, that's the next best thing you can do. Go to college with smart people. And so I have a sense of what's happening inside there. And I think we're going to achieve with $1 billion what many other countries maybe achieved with 4 or 5. But where you will see some, some immediate progress is the whole solutions application layer. I can't talk about what we've done because of the fact that we are in a silent period, but that's how we have invested in AI so far. Yeah.
Thanks, Hari. Your last words on AI. What are your thoughts?
I would just say that in our view, AI is an infinite game. It's going to be with us for the rest of our life. It's not going to be a 2 to 3 year trend. It's going to be with us for the rest of our lives. We are never going to have perfect AI. It's going to keep continuously improving. And so, how do we all adjust to this in our working as well as in our personal lives? I mean, it's going to be a constant game of adapting and innovating. So I would still say it's not too late to get onto that. And at EQT, we have this word called future-proofing. We're looking at all our businesses and saying, how do we position them better for the future? And AI is a part of that. We have a special team working at the investment stage, post-investment stage, positioning our companies, adapting best practices. And it's so much to do. It's really an exciting technology that can do a lot of interesting things. So we really think that that's the best way to adapt to it. Yeah.
Thanks. We have a few minutes left, and can we take a couple of questions from the audience? Anyone wants to ask a question? Yes, I can see lots of hands. Yeah, can they? Yes.
Hello. Yes. So my question is, in this discussion of AI, we saw that PE is looking at it in a way that companies who are adopting AIs, we will be backing those companies. I'm borrowing this analogy where someone said that LLMs and these foundational infrastructure is going to be like a refrigerator companies, and there will be Coke and Pepsis of the world which will be created on top of that. But the existence of those Coke and Pepsi companies only comes from the invention of those refrigerators. So is the Indian PE sector willing to invest in those companies which is completely dependent on this LLM infrastructure?
Who wants to take that question?
So maybe I can take a first shot at this. See, I think we all have to create certain hypotheses as we look at any sector, when to invest, where to invest. And our view is, the world has seen many revolutions, and AI is one of such scientific, innovation and revolution that we are going to witness. I think Manish had called it out that he would rather, wait it out for 2 years and see how things are evolving rather than jump into it. Today, a lot of action is happening in the US market, where private companies who are working on some of these foundational things, the valuations that they are getting is extremely high. And it is a very risky investment for anyone. So that's the domain of venture capital, where they can look at maybe 20 such investments and then hope that one of them really succeeds, right? So that's one aspect. Now, the amount that is required in order to keep infusing, to reach a stage where you can challenge some of the best companies in this domain is significant. And in India, we currently don't have such pools of capital in our VC ecosystem, right? So while definitely there will be, I would say, monopolies or duopolies that will get created, they will have a very big share of the overall pie and the revenue as well as the market cap. But we also have a view that over a period of time, they will become commoditized, because the government itself would want everyone to benefit. And the cost of compute will come down as more and more usage will happen. So the return on, and they will have to keep investing to create that infrastructure. So the return on capital employed for such companies over a period of time tends to come down once it's become commoditized. On the other hand, the companies which are using that as an application and building their business models can be extremely high on return on capital employed. And that's the business intelligence that perhaps is worth betting on from a private equity mindset.
Thanks, and I want to welcome Mr. S. Raman, PFRDA Chairman, who's here with us for the next session. And so we come to the close of this session. Thank you so much for being here, and we had a great discussion. Thank you so much.
Thank you, Nivedita, and thank you to all the panelists for sharing their thoughts and insights. And may I please have the mementos on stage for all our panelists, please. So PE is on its way to becoming a mainstream sector, and India would grow ahead of other markets due to a lower base and, of course, the size of our large economy. A lot of interesting points have been made about artificial intelligence and how PE funds, VC funds look at it. One very interesting thing that was said is that India is an entrepreneurial economy, not yet an innovation economy, but on a positive note, we have a great record of catching up. Please give a big round of applause to our panel. Please remain seated for our next and our last fireside chat of the day with none other than the Chairperson of Pension Fund Regulatory and Development Authority of India, Mr. S. Raman. We are highly honored to have him amongst us today. May I please request the audience to please be seated? We are not going to waste any more time. Let me please invite on stage Mr. Raman, Chairperson of PFRDA, and also may I please invite on stage Business Standards Editor, Mr. Shailesh Dobhal, to welcome Mr. Raman, please. Over to you, Shailesh.
Good evening, everyone. On behalf of Business Standard, a very warm welcome to Mr. S. Raman, Chairperson, Pension Fund Regulatory Development Authority, on this second and the penultimate day of the Business Standard BFSI Insight Summit 2025. Mr. Raman is an officer of the 1991 batch of the Indian Audit and Account Service. Mr. Raman became the chairperson of PFRDA in June 2025. He took charge at a time when the government is doubling down on expanding insurance for the financially underserved and strengthening the social sector cover. Under his leadership, PFRDA has begun work on new pension schemes targeting gig workers, MSMEs, and farmer producer organizations. Efforts are underway to introduce more flexible withdrawal options under the pension schemes. Before becoming PFRDA's chairperson, Mr. Raman served as the Deputy Controller and Auditor General and Chief Technology Officer in the Office of Controller and Auditor General of India. He had previously held various leadership positions, including Chairman and Managing Director of the Small Industries Development Bank of India and Chief Executive Officer of National E-Governance Services Limited and Principal Accountant General of Jharkhand. From 2006 to 2013, he served as Chief General Manager and then as Executive Director at the Securities and Exchange Board of India. Mr. Raman holds a bachelor's degree in economics and an MBA from University of Delhi. He holds multiple professional and academic qualifications, including an MSc in Financial Regulation from the London School of Economics and Political Science, and certified internal auditor credentials from the Institute of Internal Auditors, Florida, and a postgraduate diploma in securities law. He also has a Chief Digital Officer certification from the Indian School of Business. Many thanks, Mr. Raman, for joining us today. May I now invite and request Mr. Vikas Dhoot, Resident Editor, Daily Business Standard, to please come up on stage and start the fireside chat with Mr. Raman. Over to you, Vikas. Thank you very much.
Thank you, Shailesh, and thank you, Mr. Raman, for being so gracious and in accepting our invitation and arriving on time despite peak Mumbai traffic. We started the day with insurance. The insurance regulator was here this morning, Ajay Seth, and we are closing the day with pensions. But if you look at it philosophically, in the BFSI industry, it's a bit akin to saving the best for the last. Pension, in fact, is probably the last product in a financial industry consumer requires and uses in his life. He earns income, he puts money in his bank, he starts investing in the markets, he buys insurance. Pension is often the last thought of thing, but also the most important thing, so that you have a good sunset in your life after years of working hard. So, unfortunately, in India, it's not a top-of-the-mind issue yet, and it's something that I'm sure Mr. Raman is working to change the narrative about. When I started reading about pensions and social security in India about 25 years ago, I read a book called Banking on Death. People were literally banking on the fact that they don't have to have pension after they stop working, they just die, right? And it was a bit morbid, but in a way it was also true. If you look at India's social security system, it is mandated by law for everyone to be covered by the Employees Provident Fund Act of 1952. So we had the idea right at the outset. Unfortunately, the way the labor force evolved was that 90% of the workforce did not fall into the qualification for the EPF Act. So only 10% of India's workforce is still in the formal sector. Everyone else is informally employed. Once there's no employee-employer contract, the EPF law does not apply. So we have a bulk of the population not covered by social security. Of course, the government employees get hefty social security, and that's a different topic. Partly, again, managed where reforms are happening, critical reforms have been happening, steered by the PFRDA. So I think it's also an opportune time to have him here is because 25 years ago is when India's pension reform journey started, because most people wouldn't realize it was not the finance ministry or the labor ministry which initiated this. It was the Ministry of Social Justice and Empowerment. And the minister at the time was Maneka Gandhi. She had set up a committee on old age social and income security, which gave a report in 2000, early 2000. PFRDA is how it was envisaged by the committee as an Indian pension authority, and it had a raft of reforms and suggestions, and PFRDA was born out of that under the Atal Bihari Vajpayee Sarkar. So, but I will talk about some more of these issues and the evolution of the reform journey so far. But I would like to give Mr. Raman a chance to give some context for the audience on why pensions matter and why we need to pay more attention to this subject going forward.
Thanks, Vikas, and thank you to Business Standard for having me here. Very, very briefly, let me just pick up where you left. The NPS is really the National Pension System, which came into through a notification in the Atal Bihari Vajpayee government, yes, and the act finally got passed only in 2015. Now, 13, and it really was meant for getting government out of a very sort of, difficult corner where government was only into defined benefit pensions, and it was clearly understood that this was fiscally completely, impossible to maintain going forward. And I think that was the brave decision. And therefore, a concept of national pension system came in with a regulator's office, because the entire system was an unbundled architecture where you would have private sector pension funds dealing with the money of government subscribers who were mandated to whatever those percentages are. They've moved, but it's roughly now 10% of employee pension and 14% contribution from the government. So it's a pretty healthy contribution that comes as a co-contribution. This money gets invested in a mix of assets. The regulator's job was basically to ensure that the pension funds are sort of strike the right balance, probably the most difficult thing ever to do. But that was really the good decision taken, such that we moved to a defined contribution system. And that has been running exceedingly well, with that government kitty giving us a 9.2% year-on-year return over the last, I think, about 15 odd years. Now, that has really caused people to look at their accumulated corpus and feel pretty happy about it. On the heels of this was really making this available to the citizens of the country. But this never really happened, because I think it was too much of attention to the government pension and how to deal with that. And I think that's really where we stand today. Though it's been 20 years, but the ratio of the total AUM, which is roughly about 16 lakh crores, 16 trillion, is 75% government subscriber money and 25% others. This is the ratio that needs to be probably reversed. And that's really the challenge, I think, is what's before PFRDA, that can we make it 25% government subscribers and 75% the rest of the country, for which we have this huge challenge of creating a distribution network, or let me say, using the existing distribution networks that exist in the country. We've got a very well-developed financial sector. And it's for the pension funds to actually come in. And today there are 10 pension funds. There is a backbone of it's called a CRA, a Central Record Keeping Agency. So we have competition amongst them. It was earlier only one, now there are 3. But this interoperability between the CRAs is already established. So I would say we are sitting on a good architecture. We just have to exploit the natural or the animal spirits, if I may say, of the private sector to go out and get that business. And the business is not easy, because trying to tell somebody, let me now focus entirely on the informal sector, because people like you and me don't need too much of education, though I still think I'm illiterate. But the fact is that the informal sector is not very happy parting with money which they can't see. And they have no sight of what's going to happen 15 or 20 years from today. And that is really the biggest challenge, I think, that the distribution network faces, because this is not a mutual fund. And I therefore, once again, sort of make that point very clear that mutual funds are used for a particular purpose. The pension fund is used for an entirely different purpose. And that is why the power of compounding has to be seen to be believed. So I was just telling Vikas that my own cook at home said NPS is all rubbish. I have no interest in it. And you have to actually sit him down with that pension calculator, which is there on the NPS Trust site, and show him that if I put 3,000 rupees every month for you for 20 years, we're saying 7.2 lakh rupees collected at the end of 20 years, you actually have a number that gets thrown up on the screen at 32 lakhs. It's a number that the poor fellow would never have dreamt of. But that is the kind of education that we need to provide. And in fact, it is probably even surprising to many of you sitting here that you can actually get 32 lakhs by contributing 7.2, but that is really over a 20-year period with the kind of returns that we have today. So, educating people about about the fact that they need to grow rich before they grow old. And I think that's a lovely mantra which I've stolen from some speech of Nandan. But I think it's a wonderful way of telling people that this is why you need to invest and you cannot touch that money. So there are restrictions in the NPS system for you to withdraw money. It's a very difficult balance. We're actually going through several reforms. So, the reform is really directed to the non-government sector. And that's, I think, entirely what we're trying to do, is to make sure that if we have about 1 crore non-government subscribers today, we need to get that number up to, take your pick, but 25, 30 crores is, some respectable number, which we need to look at over the next 5 to 6 years. And it certainly is possible with the digital rails that are available, with the kind of, let me say, the databases that have got created over numerous financial institutions. So if I were to just look at SBI, they've got 45 crore bank accounts. Now, even if, 1/10 of that gets converted to an NPS by just using the same KYC that already exists with the bank, it's just a press on a YONO screen for the guy to say, yes, I want to enter NPS. That is really how we need to go about creating that, sort of cascading effect or a multiplier effect, and making people realize that get into NPS and there's probably a much better future for you. So it's about, and just a comparison with what happens internationally. Most of the jurisdictions, pension is a mandated feature. If not mandated, it's certainly helped by tax incentives. Unfortunately, in the new tax regime, all the tax incentives that existed for NPS disappeared, and we have 70% people under the new tax regime. So, there is a bit of a challenge. I think the regulator really has to do that little bit of extra work to ensure that we have that ability to bring the flows of money into the NPS. And again, internationally, the pension funds have funded infrastructure and funded startups. Now, that is really the productive way. I can see you smiling over here, but I think we have in a way, a moral duty to channelize that money to the productive sectors of the economy. And let's be honest, it's also a matter of giving the subscriber a better deal. So, we've just been reviewing the pension funds, and Suashish is here, and we've realized that money is just chasing those few 30, 40 stocks on the equity side. Now, we really have to diversify. And that's, I think, the other role that pension funds would have to play, is to go into areas which, because you are long-term, you can sustain the sort of, cycles within those particular industries. So I'm sorry you asked me to set context, but I've just gone way beyond that.
So that's a really helpful context setting, actually, because it also helps me get into my first question in a way. When you talked about global pension funds, having the kind of scale and diversification of assets, you said they fund startups, they fund critical infrastructure. I think anyone tracking financial markets for a while knows that when a fund like CalPERS or when the Ontario Teacher Pensions Fund starts investing in a stock, that stock is doing well and is bound to do better because they're getting long-term sticky money, not some overnight, capital that is going to come in and get out. So I think one is, of course, when can we expect Indian pension funds to achieve the kind of scale and size and intelligence in the investment strategy that CalPERS and the likes deploy? And secondly, can we also expect, maybe global expertise in pension fund management, the vanguards of the world and others, can we expect some of them to be allowed entry into, I know you are allowing private funds already, but can we expect
some of that? I think that answer is already there because we are joined at the hip to the Insurance Act. Right. So if the Insurance Act allows 100%, equity for a pension fund, foreign equity for a pension fund, mutatis mutandis apply to pension funds. So we're completely clear about that. And I think the insurance bill is yet to get passed. So, that we were just waiting for that to happen. But there is an interest from foreign capital to come in. But I think the interest of foreign capital is more to get the returns from India, which is why you have all the, CDPQs of the world already over here, and they're making excellent returns out of India. So I would believe that for the Indian pension funds, we probably need to look at how to get more pension funds into the system. We are a very large country. I mean, I wouldn't be surprised if we have requests from people located, in tier 2 cities, probably tier 3 cities, where there is a catchment area. You have large cooperatives, you have, areas where, there is a greater wealth, MSME clusters where there are large clusters with lots of people working in that. We never know where that demand comes from, and we need not also just stick to the existing structure of a pension fund. So, today it's a 50 crore capital that you need. Can we not look at having small pension funds, if I were to take a leaf out of the small finance bank? So, you're dealing with a community, you're dealing with virtually no risk, because the entire flow of money is on digital rails. And I think that is really where we need to leverage the fact that we've got the best payment system in the world. So why are we not able to bring in more people, have distributors who are probably not the regulated entities as we demand today? Because we just need to ensure that we are testing for the data flow in that particular system, and ensure that there is a complete digital flow with no sort of, leaks anywhere there. So I think we should be certainly able to look at how the pension funds collect more money from within the country itself.
Right. That's very interesting. In fact, what you mentioned just before we entered, that, even before Mutual Fund Sahi Hai campaign was launched, I think NPS Zaruri Hai campaign it predates the Amphi campaign. But somehow I think it needs a little more championship and, some evangelists to do this. Is there something that you have in mind now that you've got a sense of how PFRD is doing things?
No, I think it's a great question. I think it's an issue that cuts across financial products. So I would really see financial literacy as the bulwark or the bedrock of a lot of buying of financial products, and we still need to get that literacy going in vast amongst vast numbers in a lot of regions. So, we are so urban focused today that we've forgotten what it is, to be able to do a small business in a reasonably small town. And yet, I can assure you, having seen it during my SIDBI days, that there is such a high aspiration amongst those people to grow their wealth, to get their children better educated. So, we need to have financial planners. And that's really the point where I'm saying we have to cut across, the sort of turf between mutual fund, insurance, pension, have the large number of persons who are already there as a distribution workforce, ensure that we have a minimum certification program for each product which already exists with the likes of NISM doing an excellent job, and therefore make that into a viable business. So a planner need not be, someone who's always in a suit, but who's there. I mean, I would even go to the extent of saying that the bank Sakhi is somebody who is so useful in the work that they are doing today amongst those, those set of people who have emerged from the self-help groups and today are so keen on improving their business prospects, because every household runs a bit of agriculture, runs business. You never know when the next person, improves their business prospects. So we really have to look at literacy going down to the grassroots. I think it's a huge area. And again, with the kind of digital rails that we've got, with the kind of reach of the mobile phone, a lot of content could just get targeted better to these particular people depending on who the user is. I mean, that's also happening. So I certainly believe that is something which the regulators should entirely do. I mean, it would be unfair to expect the pension funds to spend large money on that, but this is really where the regulators should be putting their effort behind this entire literacy campaign and to be able to reach the right audience with the right, content.
I think one thing that struck me is that, typically, as we all know in our personal lives and, professional lives also, that women are called better halves for a reason. There's a reason they are smarter about things. There is a reason insurance policies, advertisements now talk about women cursing their late husband for not getting a term insurance when he could have. So maybe pension could also look at, evangelizing first with women, because then they're the best effective transmitters of such information, and making sure that men get convinced of the need for a product. So that, John Maynard Keynes said that in the long run, we're all dead, but you need pension just in case you're not. So, but on a more serious note, I think the other regulatory issue I'd find in pensions is that in India, there's, apart from PFRD and its, reason of existence being to, spread the pension culture, there is a dichotomy. I mean, there's a multipolarity in terms of pension products availability. I mean, if you look at it, the insurance industry offers a lot of these unit-linked insurance products, which have some kind of an annuity element. There are some other products which they claim will come handy for you when you turn 60. There are a couple of mutual fund products that are marketed as retirement benefit plans. There is also, of course, EPFO, which we talked about. And so is there a need, for instance, to have some cohesion in the way these products are viewed, regulated, maybe some dialogue with other regulators? I don't know.
Great question, and that dialogue is actually happening. So there is a regulatory forum for pensions which has already been instituted. But I think the larger issue is that we've had financial products emerge over the last, say 150 years. And each one has come in for a particular purpose, has served the purpose very well. So, we should not look at EPF as if it's anything inferior. It's brought a lot of money to a lot of people in this room. So we need to ensure that products are serving that particular purpose. So the pension part of EPF, which frankly nobody in this room probably even knows it exists, but there is a sliver that goes towards something called a pension, and suddenly when you retire, you have some 2,000 rupees coming to you and you don't know for what reason it's coming to you. But that is really where we need to strengthen the pension product, and therefore work has already started around that. But I would say that given the need of all these products, we need to have a simple definition which everybody adheres to. So in order to sort of reduce the possibility of mis-selling, what does a pension product mean? According to us, it is at least 15 years of being in a particular product and saving towards that. So we have something called a reasonable corpus that builds up. Again, the power of compounding, nothing else. But at the end of that, there is today the law says that you have to forcibly put it into an annuity. Now, an annuity is again a very good product. I mean, there's really nothing wrong, but given the fact that it has to deal with uncertainty of life, anyone who has designed that product will ensure that there is enough capital buffer, there is a solvency ratio that you ensure that you are in a position to meet the longevity risk as and when it happens. So, we have to provide alternatives in terms of the pension payout product. And that is, I think, what PFRDA has already, started. We've got a consultation paper out looking at the possibility of, with annuity, can we add something further? So one of the models is that you push an annuity to the age of 70 or 75, you have a sort of systematic unit redemption plan, which runs for a period of time before that. But at some point, taking an annuity does make sense for some people. The others, in fact, one of the speakers in that conference said that I'm sure, given my health, I'm not going to make it past 75, so why do I need an annuity? Let me have another way of enjoying the wealth that I've accumulated. So I think the job really is for the regulator to put across a set of products that finally it is for each customer to choose what is suitable to him. And that is really what I think we are doing, and we have another innovative product in that sort of consultation paper is about, can we create a standardized pension credit such that through my working journey, I am accumulating pension credits, which I know will give me a particular fixed sum of money at the time I retire or for every year in the future. So we're talking about 100 rupees per month that a pension credit will give you 15 years from today. You may accumulate it through a conservative, moderate, aggressive, asset allocation. So that's really where the pension funds need to come together, understand that how do we create other products where we don't necessarily have to force people into annuities. It's one of the options. And does everybody want to take out money as a lump sum just because there's a tax advantage to it? So the tax bit also is very important. We need to understand that if there's a 60-40 tax ratio today, where 60% is tax-free and 40% is taxed, that 60-40 ratio could even apply to whatever income stream I'm getting as a pension payout product. So this is really what we're trying to work on, and understand that for the regulator to be seen as not only a regulator for the accumulation phase, but what we call as for the decumulation phase also.
I know, I mean, of course, some of these initiatives are intended at expanding the universe of people who will have some retirement security. But I mean, it's a question that if Manish Sabharwal, my friend, would have been here, he would have asked me to ask you. And it's something that I think even Arun Jaitley alluded to, the late Arun Jaitley in one of his budget speeches said, can we work out a system where Indian employees have a choice between the EPFO and the NPS, and basically create a demonstration effect that makes sure that people are making better choices. Of course, that has not yet taken off, but even today we have young people who enter the workforce in the formal sector, as Mr. Sabharwal describes, hostages of the PFO. So is there I know you've got this new regulatory forum. I am sure you're ironing out some things. Maybe you can tell us a little more about that. But can we envision a future, near future, where when I join a new job, my employer can give me an option between EPF and NPS coverage?
Once again, I'd just like to reiterate that EPF is a provident fund, which is an accumulation stage. Pension is both an accumulation and a pension payout stage. So the product is, let me say, different. The EPF, for good reason, because there was nothing else in this country, the pension sliver started in '95 and it's running. Unfortunately, it was targeted to everybody and not just those below the threshold of income. So it's something which we, going forward as part of the regulatory forum, we're talking about how these pension products could come under a single regulatory umbrella and therefore get tied up together in some possible way. But I would say if you have something called EPF, you have something called PPF, these are in a particular genre. So let those products remain. It's for the understanding of the customers, given their tax profile, that what is those or what is that particular set of products that I should put my money in, which is best suited to me. So I think that's really where I would really look at how we move ahead with the concept of accumulation. EPF again has, I would say, a rate of return on its corpus, which is maybe a tad below what the NPS has got, but it's also a very good rate of return. So we should have competing products. I think that is really where we're moving forward. I mean, if EPF ends up putting its money tomorrow, say potentially through another set of funds, which could even be the pension funds, which could be other funds, it's really for the funds to make sure that they are giving reasonable return, and that level of competition really is what we should be looking forward to.
So time's really flown past, though we were talking about an allegedly boring subject. But if you don't mind, can we take a few minutes to take some questions from the audience?
Sure.
So maybe the gentleman here.
Hi, sir. So you touched upon a good subject of NPS, and there has been a lot of government push also around that product. We see the new tax regime also pushing that front. My question regarding that is that we are facing a lot of challenges, economic uncertainty regarding job losses and all of those coming with AI and stuff. Do we see regulator coming forward and allowing the pensioners who are depositing in NPS, allowing them to take out their own money, which they feel they should be able to in this scenario?
Thanks. That's a good question.
So let me answer it very, very quickly. Our philosophy is that do not take out your money before you reach a particular age where you are not actively working, where you don't have a stream of income from your work. So we would not like to allow for too much liquidity in the product. And I think that's really why we will be regarded as a pension product and not just another savings product. Having said that, we fully recognize the fact that between education and health, or even housing at times, you have a need to withdraw some money. So we are working on that. We'll be coming out with an amendment to the what we call as the exit regulations. So it should be out fairly soon. But let me assure you that it's not going to change the nature of the pension product. And that's, I think, very important.
Perhaps one more question here, just here.
Yeah. Good evening. I'm Praveen Dwivedi from Evoke India Foundation. So my question is just simply two things. One is how to simplify this communication, as Vikas was asking that about NPS Jaruri hai. So that what PFRDA per se is doing to make this communication transform into a space which, like, this has been done by mutual fund sahi hai. Number two is the digital infrastructure currently. You know, like there are apps which are like grown multifold, like Grow app or Zerodha, whatever. Is there any plan how some startups can be onboarded to take that route? And I think because I have been going to PFRDA, not going actually, twice I have been to PFRDA office in Delhi. And I have been working in the area of financial literacy for last 10 years after my corporate career. And I've seen that not much of the work, I think thought process has been there in that, you know, in terms of escalation or outreach.
I'm sure that's about to change with
That's the thing which I think,
So
I'm sure.
I thank you, Praveen, and frankly, we'll use your services. But it's really about, you know, everybody going back from this session saying NPS zaruri hai. And I think we have a long way to travel down that, in that journey. We have to be able to create that brand recall in everyone's mind so that there is that immediate understanding that this is something which every youngster, when he starts his working journey, it's there in the mind saying, I have to start my NPS product and my NPS account. But I think the education, the awareness, it is very important. Using the digital tools, so as I said, if we can get Zerodha and Grow and people who have captured the, you know, sort of imagination of the Gen Z, now along with what you do in the F&O, which I don't want to look at, but you should also be ensuring that you have your NPS account and you put money into that. So I certainly feel that there's a lot of education and literacy that we could probably get from such large platforms. And I'm totally with you. We're already working on that.
Thank you, sir. I think I know there are more questions and hands raised, but I think we're running out of time. And I think we must realize that there is a premium to be paid for pensions. So whether it's a discussion about pensions and or coverage in the newspapers, which I hope you will be reading Business Standard more often to, we'll also like to endeavor to make our readers more help them make more informed and better choices on how they plan their lives beyond their working lives. And we hope to have you back with us more often and at suitable points at the reforms that you're working on as they reach closer to fruition. So we hope to have this dialogue going forward. And I'm sure your audience will be back next year also to listen to what has happened since today. On that note, thank you, Mr. Raman, and extremely
Thank
glad
you so
that
much.
took time out.
Thank you indeed, Mr. Raman. Thank you, Vikas, for that very engaging discussion. May I please request for the mementos for our guest? Vikas, can you please hand over the memento to Mr. Raman? Grow rich before you grow old. That's a very important takeaway that we're all going with. Good reiteration. And very interesting points made about how the coverage in the non-formal sector of pension from currently at 1 crore is expected, we want it to go to 25 to 30 crore in 5 to 6 years in the non-formal sector. Mr. Raman made very important points about pension funds needing to diversify from just 30, 40 stocks more towards equity. And also the point about the requirement of minimum capital for pension funds be brought down. And of course, the big theme about financial literacy and its importance, especially in the rural sector, and the role of bank sakhis in this exercise has been immense. Please remain seated. We've had a very, very active day. We've discussed so many things from insurance, from AI and insurance to regulatory hurdles. We've heard from 3 different regulators today. And to end this day on a happier, on a lighter note, we have lined something very special for you. So do not go anywhere. Please remain seated. Because next up on stage is the man of the evening, the one and only Rabi.